private sector. We started with the 1 lakh ton of aluminium production from Bharat Aluminium. Now we are producing 30 lakh ton and going to produce in 3 years' time 60 lakhs ton. Cost of producer, that story doesn't end there. We will create 1,000 industry downstream. We are creating an industrial park because aluminium users are tremendous. So all the downstream 1,000 industry will be developed. So people will come and set up the industry and we'll support them in every respect. Then we have oil and gas. Oil and gas, my heart and soul is there. India has tremendous reserve and of oil and gas, hydrocarbon, and we were the only people in India producing oil in private sector. It was not an easy job. We are looking for producing 500,000 barrel to spend $5 billion in three years' time, 3 to 5 years' time, to produce 500,000 barrel at the lowest cost. We will have producing sweet crude, we have a complete pipeline, we have every kind of opportunity. We have a tight oil, I have a shale gas, I have a shallow water, I have a deep water, I have a big block in the Assam northeast where the first oil was produced. We are in the process, we are looking for government to give us a lease, long lease. So we are comfortable because then we can make a big investment.
Okay.
So aluminium, oil and gas, power is very, very important. At the moment, our power company produces about 4,000 megawatt, going to produce 20,000 megawatt. For that, all brownfield. All brownfield. We are looking forward. One of the best company. We have all coal linkage. Coal is not going anywhere, and we should be very proud of our coal. Coal, we have coal. What India has is sulfur free, and I have always been advocating that coal is not going anywhere. We are a poor country. We are going to make sure environmentally we 100% take care of that. But we will make a power company about 20,000 megawatt power plant. That's what we are looking at. We have a iron and steel company, which is a phenomenal company. It is around Tata Steel, Bokaro Steel. It has infrastructure. We have a gas pipeline to produce 15 million ton of steel. At the moment, we are producing 3 million ton. We have another million ton in Goa, so 4 million ton we are producing. And we are going to produce 15 million ton, all green steel, electrical steel, or special steel. So we are the largest producer of iron ore. We will 100% backup of coke and the iron ore. So looking forward, this steel company still has a great demand in India. And then we have Vedanta Limited, which will have Africa largest zinc company. Very, very, very proud of having a zinc company. We have a 65% of Hindustan zinc. We have a FACOR, which make we also critical metals. So this is a Vedanta Limited, again very flagship company. So these are the company demerger. All the share will be in the process of issuing. By next month, all these 4 companies will trade by themselves. It will have a very strong management. And this will be company which is what we require, natural resources in India. And we will proceed in that direction.
I don't want to come in there in the middle, but that's an important clarification that you're giving. Can we take it as a confirmation that perhaps by next month we'll see these individual demerged entities also being listed?
Absolutely. By next month, all the individual entity will be listed.
That's fantastic. You've given us a very comprehensive roadmap about how each of these companies in their individual spaces can grow up to be bellwethers. You talked about subject to support from the government, you're looking to make big investments. So tell us, can you give us some glide path, some indication as to what is the kind of capex that you're looking at, say, over the next 3 to 5 years?
They're looking to spend about $20 billion, and we have a very good internal profit generation in the company. Internal accruals are very, very good. Some equity, some debt we might have to take, but $20 billion investment will be there, and probably we will increase our production by 2.5 times of everything.
But you're saying mostly through internal accruals. Any numbers that your team has done by you?
No, we will be having about $10 billion EBITDA.
Okay.
$10 billion EBITDA. So I don't know that financial detail, but I was not ready. But $20 billion we spend. Fund will never come on the way. Government is with us, and this all will be India. And by this, I'm looking forward at least 5,000 downstream industry to come in with our product. For me, most important, which give me joy, to develop the downstream industry.
You've talked about previously, we've heard you speaking when you say that Make in India push has been very good. It's yielded results when it comes to smartphones, electronics, even the defense sector, it's done very well in terms of indigenization. But that you classify as above ground Make in India. The question that you asked previously is, what about below ground Make in India? Again, tell us, is there a need for perhaps a Make in India push even for below ground resources that you manage?
What we're talking at is self-certification, what government... I'm very thankful to Prime Minister Modi, Amit Shah ji. They always think how the business can be developed, the employment can be developed. And what we are looking at, simple policy, trust-based policy. Trust-based and court also has to... What Indian courts are there is worldwide, people are very proud of. It's very important. The time is the essence, because India can't wait now. Time is the essence. All economic, whether it's a court, whether it's a regulator, more and more trust-based it be given. Entrepreneurs should be given a recognition. Manufacturing people must be given a recognition. You know, because they pay the highest tax. You will not believe, every year I'm paying 60,000 crore tax. When I set up all this industry, I have raised $35 billion abroad and brought the money here and invested all the money in all these companies. So these are the... And it's not me. Every individual is like me. Because we have the DNA of entrepreneurship.
Right.
We have a DNA of the women working very differently. So these things were being encouraged nowadays. Tremendous opportunity. We will, as far as Vedanta is concerned, we are very clear how we demerged identity will work. Very strong management. For me, it's a very inclusive.
Sure.
Because for me, last person working in my company, I cannot ignore him. He's also very, very important for me. And I'm very proud of my people and my team. We are ordinary people. Vedanta means what? Ordinary. But we deliver extraordinary result.
Well, you are anything but ordinary, Mr. Agarwal. But let me follow that up with another question that's close to your heart, what's on import substitution. I came across some very interesting numbers. We have an import bill of roughly around $800 billion. Half of that below ground resources which we end up importing. So whether that's oil, gold, bauxite, for example. So we're talking about nearly $400 billion every year. What is the missing from our picture? Take oil, for example. We've not been able to build up capacity here within the country. What is the rationale? What's required from the private sector, from the government?
We have to be very, very careful of the world. World does not want us to produce. They want India to be a market. Middle East, all world they develop 2 hours away to supply into India. The Gold Council, they just want to supply to the gold, whether it's a copper. We have a tremendous bauxite. I just read in the newspaper, you know, the largest company has gone to Guinea to produce alumina. Why? India has the largest deposit and the best bauxite, because we have to simplify our policy. Land is required, everything to be digital. Seller is ready, buyers are ready. We have to address I'm just thinking big way, is our system.
Okay.
System. Our bureaucrat officers are very qualified. They are most intelligent people, but they have to let go. They have to rethink inclusive. How do we recognize is very, very important. Your government companies, what is it called? All the government companies? Public sector. Public sector, very important. Government has to take a decision. Everything has to be privatized.
Okay.
Everything has to be privatized. No one person will be retrenched. I can see 5 times more production can come up. It is very important that we take decision. In fact, I'm for gold company, nothing producing, copper company. I'm ready to take challenge on anything. Let the parliament decide and trust. And I will do everything for my country. So, and the court. Courts are, judiciaries are very important. Time is the essence. We have no other in the world, the judiciary, what we have, nobody has. But for the, to take country forward, to create job, to develop the economy,
Sure.
is very important. The decision, we don't waste time, we move forward. Where else we'll find Prime Minister like Modi, Amit Shah, these people, what they have done in West Bengal. West Bengal was the hub for the industry. Hub for the industry, what they don't have. It is all, everything, Bihar, this, you talk about Assam, these things, what they are addressing now, will develop.
You spoke of reforms. I want to get in your reaction on one particular aspect. You've previously spoken of how this 50-year lease that we currently have is not quite working. We need a lifeline. As long as the life of the mine is, that should be the duration of the lease itself. Are you calling for a complete overhaul of the current mechanism that we have for auctioning, for allocation of mines, of resources, of natural resources?
Beautiful question. You know, government has all the powers. Give a long rope. What is this short leave, 50 years taking back? People will run away. Nowhere like this is in the world. You are unnecessarily hanging the short. Tata Steel, we will, huge plants are there. And then you make a policy that you'll take back the mine and you re-auction. Does it work? We have to come out with a long lease, whether it's oil, and there should be one policy below the ground. For the oil, you have a different policy, and for mineral, you have a different policy. Below the ground, simple policy. For us, only one objective. How do we stop import and start producing? And this can only produce by the private sector. It's very important. And public sector must be privatized.
Okay.
And the court must be very conscious that time is the essence, whatever it comes to, whether any NCLT or this, they're doing a fantastic job, but time is the essence.
Okay. Okay. You've mentioned privatization twice, so I'll just labor on that point. You talk about completely privatizing as far as all the PSUs are concerned. Will you be...
There can be exception. I'm saying generally. Because no democratic country government doesn't run the business.
So if the government were to take up on your suggestion, which is greater divestment, greater public sector assets put on the market, would you be in the market in line for perhaps some of these government assets?
My shop is open. I'm not going to go to hunt. But something comes to my shop. Any customer comes, any opportunity comes, for my shareholder, I will look at.
Fair enough. Just a couple more questions, Mr. Agarwal. One question is that you've talked a great deal about privatization. You've talked a great deal about regulatory reforms. One low-hanging fruit, to your mind, that you will recommend to the government can be put into action as early as tomorrow. What would that recommendation be?
Anything which we are importing.
Okay.
Anything which we are importing, and there is a black and white, there is nothing left. What entrepreneur can do, you know, we have proven from, one example is Bharat Aluminium. One example is Hindustan Zinc. They are the only two companies I have taken. Anything, and if you see the privatization of the airport has happened, privatization of anything, then you have trust. I really salute all my industry. They were from where to where, whether it was a telecom, whether it's airport, airline, any steel production, anything you entrusted to the or corporation, whoever trusted, they have delivered.
Sure. That brings me to my one final question. I'll end you by asking, we're living in tumultuous times. There's geopolitical sensitivities. There are factors, some beyond our control, some in our control. With all of these multiple moving parts, one commodity that you're bullish on for perhaps the next decade or so?
I'm very bullish on aluminium, copper, oil and gas. All three critical metal, very, very important. And fourth is, we can be the largest producer of arm and ammunition. The kind of factory we have, massive, if they can be modernized and privatized, we will be the largest producer of today's digital technology given. But we have to be, Parliament has to be together. Everybody has to be together, one way, one goal, to make sure that we will produce arm and ammunition here. And we run our, whatever strength we have, we leverage that 100%.
Fair enough, Mr. Agarwal. We'd like to thank you for joining us, for sharing time with CNBC TV18. You've given a lot of insight as to the recommendations for the government, but clearly close to your heart, import substitution, and of course, perhaps some form of regulatory changes as well. Mr. Agarwal, we'd like to thank you for joining us and sharing time with our viewers right here on CNBC TV18.
Thank you very much.
The week is done, but the news isn't. I am Sakshi Dhingra and this is Newsmakers on Storyboard 18. Let's go. We start with the story everyone in advertising is talking about this week. Piyush Pandey has been awarded the Padma Bhushan, India's third highest civilian honor, a recognition that goes beyond advertising. For decades, Piyush hasn't just made ads, he's made culture, from Fevicol to Cadbury to Asian Paints. His work has shaped how India sees itself. This one means something. Now let's talk about the numbers. Brands are spending and the signals are getting stronger. Colgate nearly doubled down in Q4. Ad spend up 10.5% to 200 crore as sales growth accelerated. Nykaa up 20% to 380 crore, profit up fourfolds. Emami up 12% through a tough macro. Info Edge up 19% to 118 crore. And the ones to watch, Ola Electric. Bhavish Agarwal has signaled an advertising push in the upcoming month to expand EV adoption. A brand that builds itself without traditional advertising is now ready to spend. And when Ola Electric enters the room, the EV marketing story changes. And then things get competitive. You can't cut, so you show up. Now let's look at the CXO moves this week. 3 moves and 1 loud exit. Mahindra creates its first ever CBO role and brings in Unilever's Purnima Lamba from September. Reliance appoints Sandeep Karwa to lead Ajio as quick commerce circles fashion. Truecaller brings former Meta India head Sandeep Bhushan onto its board. Monetizing is the mandate. And Javier Champopiano exits Omnicom post the IPG merger. The global creative chief gone. He wants to make things again, and in this industry, that takes courage. The big story. Meta launches Forum, a Reddit-style community app built on Facebook groups. A direct play for community at scale. If this lands, it reshapes where brands' conversation live online. Every social media strategy in India will need a rethink. Now let's talk about the segment in this episode. Brands are spending more, hiring sharper, platforms are shifting, but do they know who they are actually spending for? We got into this, the attention, the authenticity, and the generation that is about to become a $2 trillion consumption force in India. With Snapchat India, L'Oreal, and a creator and an agency who lives it every day. Take a look.
In a world overloaded with content, attention has become the most valuable currency in business. But what really captures Gen Z? What shapes their culture, influences their choices, and drives commerce? In partnership with Snapchat, we launched Gen Z Trend Check, Attention, Culture and Commerce, a new quarterly intelligence series decoding the trends, behaviors, and shifts, redefining the future of marketing and consumer culture. Listen in on the first in a series of conversations exploring the influence generation, and head to Storyboard 18 for deeper insights into what drives Gen Z, how they shape culture, and what brands need to do to truly capture their attention. Let me just ask each one of you, what does attention mean today? And I'll come to you first, Pulkit. In your context, in your role leading Snapchat in India, what is the definition of attention for you?
Thank you, Dilshad. I think the fact that the environment today, especially the internet today, is so cluttered. People have so much enormous amount of data that's coming their way, and brands and businesses are trying to take a sliver of their pie in terms of how they make their business or brand work with them and get them to purchase a product. I think attention becomes significantly important. And what we did with WPP Lumen recently was to take this very critical aspect in the current context where there is enormous amount of data that people are exposed to. We showed them that a 5% increase in attention drives 2x brand impact. And in the context of Gen Z, where their attention span is actually less than that of a goldfish, it becomes even more critical because they're really sifting through so much of content that they take less than 2.5 seconds to decide whether they should really see this content or they move on.
Or move on.
And therefore, in that context, to us, we thought that we should take a proactive approach in telling brands and businesses that it's important to really pivot from a very traditional way of speaking to or communicating to these Gen Z audiences and move away to a very valuable metric, which I think will become increasingly even more valuable in times to come. So therefore, we see attention as what we call the future of marketing in many ways.
And although I'll disagree with you on one point, I don't think it's just Gen Z that's struggling with attention these days. And I'll come to you on that, Muskan. But let me get Maya in on how she sees, essentially, how do you define attention for L'Oreal for the job and the role that you do today?
In today's world, with all the clutter, and I'll allow myself to say, especially in India, where it's massive and you need to stand out, attention is about making sure that you link a very engaging story, so massive on storytelling, but also creating an impact so that you create a strong connection with the consumer, so that besides just standing out, you want them to come back to you. So it's about the love that we try to create behind the brand.
Absolutely. You have to get them coming back, right, Shekhar? Shekhar, with WPP, right? And we've had this conversation before as well. How do you see it? Before I ask Muskan, what's the Gen Z take on it?
Yeah, I think often when we talk to our advertisers, our clients, or in general also to consumers, we often get this feedback that many ads are today a blind spot. We are doing a lot of impressions, GRPs, many things, but they don't get noticed. I think that's where the question came into that, why it is not getting noticed, and there's a play of attention there. And that's how we're seeing it. So let's put it this way. Most of the marketing ROI sits at the cusp of how efficient you are and how effective you are. This attention actually works at the part where effectiveness comes into play. So the more attentive as an ad it is, it's likely to get registered more and therefore remembered and recalled more in later. So that's where, in my definition, I will put attention as.
You're absolutely right. I mean, there's no other context, right? And only when we talk about in relative terms to a previous generation, do we think of it as perhaps, like you said, it's not something bad. But let me ask you this. You mentioned, Shekhar, you said that, how the basic currency, the primary currency of media planning is changing. Dig into that a little bit deeper, because as Pulkit also mentioned, the data shows that attention is 8x better than VTR at predicting recall. And even a 5% lift can double brand perception. So is this that inflection point, right? Are we looking at that switch in the currency for media planning?
My answer will be yes and no, because we are scaling it up a lot, and this can be a big build on top of pure reach. The passionately that we chase reach, it can be a great build on top of it, for sure.
Let me switch tracks to when we were talking about how we can engage with Gen Zs and how essentially content and advertising as we know it is changing. Do you feel that ads as we know them right now, are they being redefined in this context of Gen Z and attention on platforms like Snapchat?
Yeah, there is context to how advertisers have traditionally been thinking. I mean, if you look at advertisers, most marketers today still cling on to VTR as a metric. The very definition of advertising is still a 15-second or a 20-second creative. The future of advertising, or I would say not just the future of advertising, I would say AR advertising, for example, is right here. So when you club video plus AR advertising, as we see on our platforms, the power of storytelling increases multifold. And we've seen this in campaigns. We've seen this, how L'Oreal recently launched one of their flagship mascara brands, 1.2x more attention and almost 2.7x higher product association. We've done this with Agio, we've done this with Swiggy on a Friendship Day. A lot of entertainment companies, when they, OTTs, when they launch their, flagship labels, they use AR advertising where they want people to know about what kind of next big show they are launching. A recent example last year was the Netflix Squid Games. So AR is definitely kind of allowing brands to make their storytelling more immersive.
Engaging, immersive. Those are the key words there, right? Maya, do you want to come in here with a few examples? It could be something something that you've seen in India or something L'Oreal has done globally, specifically trying to attract, engage a Gen Z, a younger audience.
For sure. So we do have many. The last one I'll recall is the colossal snap lens that we're talking about. And when talking to Gen Z, we make sure to grab the attention, have them try it so that they relate to it. It's actually their best friend, so that it's part of the story. And that partnership that we've done with Snap last year, if I'm not mistaken, was an amazing immersive interaction for them. They are actually sitting at their sofa. They're not just getting a tester, messing them up, or their perfection self that is projected on screen. They're able to, in their comfort, at their home, try a product, try on several shades instead of having the go-to shade that they're used to, so that they can diversify that persona that they build to themselves in the different situation they bring in.
Shekhar, why do we think there's this battle of storytelling on these new formats and platforms?
You're right. I also wonder that because, see, any of the creator work, they tell great stories.
Yeah.
They tell great stories. They have an opening hook that they are able to build. So absolutely, it's doable. I think it's a bit of a rediscovery that we are going through. Means, like Pulkit was mentioning, many of us are trained in a particular design of doing the story. That rediscovery is happening, and I must mention and give a lot of credit to L'Oreal. Like, for example, you have to see the vertical format ads that L'Oreal creates globally or in India when we advertise. It's there, they're subtle changes, but they have huge impact. For example, models are looking up because the screen is like this, rather than the screen right in parallel. They make a difference. So these changes are already happening. So it's not a battle. It's just a rediscovery of how you tell the stories. And the conflict, maybe the conflict is more in the mind than actually there.
Yeah, absolutely. Pulkit, when it comes to measuring success on some of these campaigns, what are your conversations with marketers like? What are they looking for in terms of success when it comes to the work that they're doing, whether it's on the immersive frontier or if any of the other technology that's happening on platforms right now when it comes to sort of grabbing attention and then seeing that convert to action?
I think there is a concerted effort in making this shift happen. It takes time. For example, attention to me is going to be one of the most valuable currencies in the next few years, right? And it's probably going to take different forms. It probably is going to replace CPM it could be an attention per mile, which we've introduced along with the Lumen and WPP research that we've done. So as of now, it's a hard conversation, but I do believe people are lapping up to the idea of what it means to really change advertising in the modern world, where people like Muskan and Muskan, both sides, the influencer and Muskan, the shopper.
Right.
How they behave and consume content and how they see my ad and therefore how they shop. So these conversations will become even more critical. And it is upon us. It is upon us, all the platforms who are there, to go and demonstrate value so that people understand.
What separates content, in your view, that earns attention organically versus something that is just chasing trends or algos or trying to game the platform, the system? What makes truly engaging organic content?
You don't feel alone when you imitate, but you feel alone when you create. And I read this today and it hit me, and I realized that everyone is just trying to be a version of everyone else around them. And that's exactly where most of the creators or people coming in any sort of phase in their life are going wrong. So I feel like that is really important if you talk about authenticity. And that's when your audience connects, because we are too smart. We can tell who is lying, who is pretending, who is pretentious, what are you trying to sell me. They can spot it from a mile away. So the minute you have a person doing this with the product, they just know that like either you're getting paid for this or something like that. And as the generation...
But that's fine as well, right?
It's
that's
absolutely fine if the brand is becoming a part of my ecosystem. Like a brand cannot always be the star, right? Because you are coming to my platform. Let's co-create something. Let's not talk about your brand for 40 seconds. Let's find a way to sort of stitch it together so my audience feels like this is good. And I feel like, okay, this is actually that will work, in the kind of content I create, in the life I live. I work a lot with L'Oreal, Maybelline. They have given me so much creative freedom. They are like, Muskan, you are doing a get ready with me with life updates. We want our products somewhere there if possible. You can say however you want to say. Things like these matter a lot. You don't always have to show your product in the first 3 seconds, because then I will scroll. People around me will scroll. My audience will also scroll. And I get it. I think I'm listening a lot of technical terms. So I know this is, serious business, of course. But then again, right, if you're trying to crack a generation which is so used to being sold, you have to find a way to do something better. I feel like just everyone trying to sell a product or an insecurity might not work anymore. You're always targeting my insecurity and making me feel bad about myself. I figured it out. I no longer care. I am very fine with how I am. And if you want to sell me a concealer, don't send me a concealer saying that my dark circles look bad. Just let's change the narrative a little. I think, that's what is important.
So many fascinating things you said in this
So
whole
true.
sort of piece that you said right now. Tell me, Shekhar, like what was the standout thing for you from what Muskan said right now?
What struck me is definitely that people are coming, or advertisers are coming to her platform. She treats it as a platform. She is a brand, and we are a brand. When you are bringing a brand there, we have to understand that how the brand actually works in her ecosystem, and that's something which is a great notes back. And to be fair, I think most advertisers who work with creators, for example, L'Oreal to start with, Mondelez we work with, Colgate I work with, Red Bull I work with, they really know how to actually bridge that gap. I mean, some examples I'm giving, but yeah, they always know how to build that bridge where they coexist and at the same time not on the face of it. But the reality is that you have your advertising, which you can put your hand up like this and show the product. And then there is a creator ecosystem where you have to leverage it the way it works. And you have to be authentic.
Yeah.
And like she said, it can be spotted from a mile.
Yeah.
And what is a sales and what is a true recommendation.
Absolutely. You can't essentially use creators as billboards.
Yeah.
Just, Maya, any thoughts on what Muskan said?
She is right. It's a partnership, in fact, because it's what we know as a 110-year-old institution, global institution, is brand equity and brand image, which is key and religiously respected. And in today's world that is so advanced, so fast, so automated and diverse, again, especially in India, we need to connect better with our consumer and make sure that we listen and co-create with them, so that besides creating impact and thumb stopping, we're trained to do, we need to be authentic so that that thumb stopping becomes that go-to destination or our battle of brand love.
Can I add something more also? But another thing is a realization listening to this happened is that as brand custodians, we have been designed to protect us as the holy cow. We have to be very, very safe. This is how the brand does, this is how the brand does not do. The world has changed around us. Now it's not anymore what I project and that's just received. There's a two-way communication now happening. Like immediate dialogue, it's a comment, there's a like, everything. In all, you're getting feedback. So you have to lose a bit of control. And that's I think the starting point of it. Means if you have to do great work on Snap, you have to lose a bit of control. And then only you might be able to do great work on Snap, or you can do a great work with Muskan.
Lose control, Pulkit. Could that be your message to your brand partners that you work with on the platform?
I think my message would be to just play with it to start with. Trust me, it makes a lot of difference. When you get to know the platform, you play with it, even for 10 minutes, you understand what the nuances around who the consumers or the audiences who are on the platform, what they're doing with it. And therefore, it becomes more relatable. But yeah, I mean, come to think of it, you no longer have control. So what will you lose in this world, right? The manifestation has to be instant. The gratification has to be here and now. And nobody is going to hold back their comment, whether they like or dislike your brand, and be gracious about it. Everything is like out there. Once it's on the internet, it's always there.
Absolutely.
And what Muskan said, she doesn't like jargons, but what I picked from her is that if you come to think of it, trust is very inherent to this generation. And how they trust, it's all very real time. It has to be relatable. It has to probably embed in their value system.
Right. Today, as we know how the ecosystem functions, everything functions, who ultimately owns attention today? Is it the platform, the creative idea, or the media strategy? Any thoughts on that, Muskan, about who owns attention? Give me your take. Forget I gave you options right now, but who owns attention today?
For someone like me who is at home most of the times doing work from home, there are bits and pieces of my day where I feel the crash and then I use my phone. And then my attention goes there, I get that dopamine hit, I watch reels, sometimes I'm taking an action, sometimes I'm just mindlessly scrolling, and it dies down there. So I feel like you think that you have control over what you're trying to consume, but eventually that dopamine right now is at an all-time high. For me, I feel like I'm going to miss out if I don't watch my social media every day, because I'm getting my IPL news from there, I'm getting my PM Modi speech from there, I'm getting my Maybelline news from there, I'm getting everything from Instagram or YouTube, or like I am no longer even going on traditional platforms to sort of check what's happening around the world. Most probably it's going to be on my feed. If it's worth knowing, it's on my feed.
Wow. Wow, if it's worth knowing, it's on the feed.
Yeah.
One misconception that you had about Gen Zers that was dispelled, or a myth busted recently. If there are any thoughts on that, like we said, sweeping generalizations about who Gen Zs are and what they do and how they consume.
One of the myth busting piece, she did a fabulous myth busting one, but one of the myth thing that I often, when I talk to more researchers and also behavior based studies, we need to step back and see this Gen Z phenomena and all. Maybe we have just changed the name of generations and looking at it. Just go back in time, which teenager or a young adult was any different from them?
Yeah.
I think we are just typecasting them for no reason. They have the nuance because they have grown in a different generation with different exposure. They have the nuance, but it's a life stage. It's a life stage, and often, sometimes we step back and see that we were no different in their age.
Yeah, maybe in aspirations and all, maybe different. Yeah.
Yeah, just the tools have changed.
Yeah, tools have changed.
And but the life stage is the same, and we behaved in a particular way with the access we had. They are behaving a bit different with the access they have.
Thank you. That was eye-opening from you, Muskan, and thank you for putting that out there. And thank you to all my panelists.
A sharp sell-off on Friday dragged the markets lower, leaving the benchmark indices in the red for the week. The Sensex and the Nifty both ended with losses of nearly 1%. However, the broader markets continue to show some resilience. The midcaps outperformed the benchmarks, while the Nifty Bank too managed to close with some gains. Over the next 30 minutes on Editor's Roundtable, we will decode all the action, the key triggers driving markets, and what investors should watch out for in the coming week. Hello. Roundtable. I am Reema Tendulkar. With me are my colleagues Prashant, Nigel and Nimesh. Here with us in the studio is Ravi Dharmshi, CIO, ValueQuest Investment Advisors. Hi guys.
Hello.
Very tough Friday, particularly the last 30 minutes. And today is yesterday, marked 3 months since the conflict started.
Oh, yeah. Nobody thought it'll go on for 3 months, right? So that's the way, that's the nature of the market. So, but I guess markets have been quite resilient, right? I mean, initial hiccups, but seems like we are back to normal. We started ignoring the war sort of news as well. Ravi, what's your call on the market now?
No, I think you're right. See, once market gets a sense of if you can quantify what is the risk, what market tends to react to is what is unknown and unknowable. If you don't know how long this conflict will last, the bombardment continues, the crude goes up 120, 130, you don't know where to put a cap on things and you can't quantify the risk. That is where the problem lies. But now some market has come to terms that, you know, worst in terms of hostilities is over. The red line for US might be here and Iran might be here, and it might take some time to bridge that gap. But at least we are not going back to that kind of hostilities, and also at both of them want the Strait of Hormuz to open up. And it also, there is a invisible line, essentially the midterm elections for US, where he basically needs to, you know, the president needs to show a win. And for that, he needs to ensure that this conflict ends, because the longer it drags, it's negative for him also. And the bond yields have also started reaching the point from where he starts listening to it. So I do believe that the conflict, unless we see a new spike in the crude, which takes it to beyond $120, $130, I think we are, for the moment, done with this whole thing.
Otherwise, you're constructive, Ravi?
So, you know what, it is a very, very bipolar market. There is a, if you see the index, you feel you're not going anywhere. On bears feel it is not crashing in the way it should for the kind of crisis we have. The bulls feel it's not rising the way it should because we are in the cyclical recovery. You look at the credit growth, you look at the, you know, monthly sales number, the quarterly results were not bad. So everything economic-wise, we are on the cusp of a cyclical recovery. But because of the global uncertainty, we are kind of capped. So indices, the headline indices are not headed anywhere. But there is clearly a segment in the market where there's a bull market going on. And it is a stealth bull market because it is not coming on the radar. And we might categorize it as mid-cap. But even within that mid-cap, specifically where the bull market is going on are the industrials, the manufacturing-related stocks. And it is not only in India, it is happening worldwide. In fact, I do believe that we are in a global industrial, you know, super cycle in terms of capex.
Actually, the list is long. I mean, actually about 10 names, right? There's an absolute bull market, all-time highs. The GE and the Hitachi and the CG Power is back to all-time high. Siemens, there's ABB, there's Cummins India, which has seen massive moves. The cables and wires, perhaps, I mean, they've not really, they've not started.
No, they have. Even they are at a new all-time high. You can
so
go
this
and
is the
check.
pack that you're referring to, right? Or,
yes.
Or
so this is, okay, let me just take a step back and paint the whole picture to you. This is but one segment. So, you know, since 1990 to maybe till late, you know, early 2020, the world was running on a principle of building cost-efficient supply chain. Essentially, the world was flattening. There was globalization happening. Suddenly, in the last 4 or 5 years, things have happened which have kind of turned it on its head. We are no more focused on cost and efficiencies. We are focused on resilience, redundancy, on safety, security, those kind of things. First, it was, you know, COVID, which kind of made us realize that supply chains are vulnerable. Then there was a semiconductor shortage that panned out. Then we saw Russia-Ukraine war broke out, which led to energy prices going through the roof in Europe. And then, of course, there was a tariff war, trade war, which made us realize that if you are too dependent on a particular country for your needs, then they can possibly weaponize it and use it against you. So there is a trend towards building this global supply chain resilience, energy security and independence, your own nation's sovereignty and security, and become part of the crucial technologies that are coming up, and you become part of that supply chain also. And this is what is driving the global capex super cycle. And that, I believe, is the whole world is. I mean, why is Taiwan, Korea, why are they doing so well? In fact, if you over there also, if you see, if you strip out Samsung and if you strip out SK Hynix and the likes of it, you will see that the rest of the market is going down. The foreigners are actually exiting in those countries also, in the other side of the market. Similarly, it is happening in India also. There is a pocket which is actually doing very well, and there is a other market which is nobody is interested in. And all this money is essentially drawing more towards US, because US is where the bulk of the action is happening in terms of, the technology companies are out of there, and the hyperscalers are driving this entire capex super cycle. So I do believe there are two different sides to the market. If you are looking at indices, you will feel there's nothing in the market, and if you are looking at this pocket, you feel the valuations are going berserk.
But Ravi, because all the capital is chasing such few names, the industrials that you're talking about, stocks have doubled, valuations of 50, 70 times. Can you make a bullish argument from here on for these stocks that you were referring to?
So you, no doubt about it that the valuations have become expensive, and no doubt about it that market has recognized it is not an unknown theme anymore. However, I think where market might be underestimating is the length of the cycle, the kind of value and the the opportunity size, and how this value can accrue to few players. So you see, in this is a kind of opportunity where on every sector I look at, let's take the example of transformer. There are only handful of companies that can actually manufacture those high-end transformers, which is the need of the hour. If you are going to electrify, if you are going to move towards AI data centers, you need those transformers, whether it is medium voltage, high voltage, HVDC. There are only 2-3 players. And when that kind of a huge opportunity meets a monopoly or an oligopoly kind of an industry structure, the valuation tends to go crazy. And it has been so the case for the last 1 year or so, but I don't think we are at the fag end of the cycle. You have to focus on the cycle rather than the valuation. If you keep valuation as the decision point for entry or exit, then you will likely miss out on the cycle.
Even if you buy right now a transformer, 1 or 2 transformer companies, you will make money comfortably?
I will never say you should buy at this valuation, but at the same time, the cycle is not ending. See, the 9 lakh crore capex cycle in India itself is still ahead of us. Also, the entire data center capex build out is ahead of us. I think by 2032, I think almost 150 gigawatt of data centers will be built. Now, if you were to just when will those risks come about? Is if this everybody has so I think all hyperscalers combined have a operating cash flow of about $300 to $350 billion, and their capex this year is going to be $700 billion. So already they are going to start leveraging their balance sheet to fund this capex. This number from $700 billion goes to $1 trillion the next year, and it sustains for a 4-5 year period. Now, at some point of time, if they don't start seeing the return on their investment and their balance sheets are leveraged, and the interest rates go through the roof, that is when the bubble boom, current boom will become a bubble and it will start bursting. Are we at that point? I don't think we are at that point at this point in time, and a lot of the capex still needs to happen. The balance sheets will still probably get even more leveraged from here before we start seeing the problem. But yeah, I mean, that is a discussion probably for a later date, not today.
Okay, Ravi, let's talk about another theme then that you all have liked, the renewables theme. I mean, it's public knowledge in terms of the companies you'll have. But at one point of time, you all were the so-called lone warriors out there, because the street was doubting. There is module production, maybe there is excess. Then they were going to forward integration. There was cell production, but maybe there is excess. How are you feeling about this renewable themes with regard to the listed players here in India? Because suddenly there's a resurgence out there.
Yeah, so Nigel, I'm going to take a step back and again explain that first of all, in this larger global industrial capex theme, energy security and energy dependence is the larger theme. Within that, energy transition. So we are not only trying to become energy secure, we are also trying to move away from fossil fuel towards renewables. And in this renewables also, solar is but one part of it. There are many other things to it as well. Hydrogen, nuclear, wind, battery. So many other technologies will also come. It's not like solar is the only one. But solar definitely is the largest because it is the cheapest form of energy that humans have created at mass. So it will have the largest adoption. The size is huge. But the problem for this is that when this whole revolution started in India, we were completely dependent on China. Today, you take the same case for batteries, we are completely dependent on China. In fact, the entire world is dependent on China, not only us. So now one has to understand the strategic intent of the government. If you are trying to become energy secure and you are trying to become energy independent, then you are not going to start thinking that, you know, if I buy this from China, then it will be cheaper. So I should rather import from China and do this. But if you do this, you are actually giving away the leverage that you have, and you are in fact going to become dependent on a rival nation for your supply chain, and that can be weaponized at some point of time. So you want to avoid that situation. So government, what it is doing is, it is keeping the profit pools protected. So they started with providing, ALMM to ALMM1, which is essentially only the local guys can sell modules. Then they give added incentives of PLI. They also added customs duty to make the imports expensive. Now that was the beginning at the module end. But if you go through now, their ALMM2 comes into effect. In fact, from 1st June onwards. Now, what that will essentially do is move the profit pools from only a standalone module guy to somebody who's integrated with a cell plus module. Then from June 28 onwards, this will move to wafers. So essentially government is saying, make your money in that window of opportunity when I'm giving you protection, use that cash flow, backward integrate, all the way they will go till polysilicon. So that is the way, that is the pathway that government has adopted in ensuring that we have a supply chain. See, an entrepreneur will not put money unless he has some kind of guarantee that they will make money. And we are not the kind of state like China is, where you don't have to consider the ROIs, or you don't have to worry about the land or many other things. So our entrepreneurs have to think about making money. Now, if they are given a window of opportunity to make that money and they use that to backward integrate, I think that's the right way to go about doing this.
I must say, there are still, Nigel put it right, you were the lone warriors, it's worked out beautifully, but there are still those who are kind of on the sidelines, institutions especially, on this theme. And the worry, we hear it often enough with analysts, etc. also, that maybe overcapacity is the
returns,
in 2 years' time. And by the way, I got a call today and maybe I should put this to the management, and you're a shareholder. With regards to Wari, I think there was a news item that they're raising 7,000 crores.
10,000 crores.
And somebody called me and said, well, you should ask, why are they raising equity? They're not highly levered. They can raise debt. Why do equity?
So I think...
as I said, I should...
No, it's not a question for me, but as I understand, and I'll just answer it, not only for this company, any company, I think the capex is 4x, 5x larger than the equity raise that they are doing. So equity will still be only 20-30% of the total fund that will be required. It's a 30-40,000 crore kind of a capex plan that they have. So, I mean, but they are first raising the equity and the debt will come in later.
They have some ambitious plans that they laid out in the analyst meet, at least Wari, earlier last month. Ravi, stay on. We need to slip into a very short break. We'll come back and continue this fascinating conversation on Editors Roundtable with Ravi.
Welcome back. You're with us here on Editors Roundtable. You know, one of the things, and we've discussed lots of stuff with Ravi in terms of what he likes, his bets, etc. But now this is not a bet, but this is the wish list that many have, especially the equity folk. I mean, all of us, that equities taxation perhaps should be reduced. I mean, this has, of course, been a constant demand since the time it was introduced back in 2008. But I guess it's gained more momentum with what has been happening on capital, with capital outflows, etc. So we had, you know, Bank of America's Amish Shah earlier today, and we put that same question to him. So just we want to play that soundbite out, and then we'll ask Ravi how he thinks about this question.
Has taxation lopsided allocations of retail savings towards equities? Completely yes. Has the capital gains discouraged foreign investors, especially when rupee is hurting, especially when, you know, earnings growth is low? Valuations for India are high. So therefore, is India out of my radar as a foreign investor? The answer is yes. And given that large part of the rupee problem right now is also lack of capital flows, I think it makes sense for us to do it. So the answer that I'm trying to give is that, you know, logically, if you think about it, we must do it.
Ravi, your thoughts? Amish says we must do it. Logically thinking, we must do it. Your thoughts?
So you know what? If this crisis has revealed, it is our vulnerability. And vulnerability is not only on the energy security and supply chain security, it is also on the fact that we are dependent on, you know, our foreign currency. And we have been kind of caught up in a downward spiral over there. FIIs are exiting, rupee is depreciating, balance of payments is going for a toss, current account deficit, fiscal deficit, both are ballooning up. And if we want to get out of this vicious cycle, then there is only one external injection that can help, which is essentially attracting foreign capital flows. So in terms of what is the need of the hour is very, very clear. We need to attract capital. Now, government can adopt any playbook they want, but essentially we need to attract $100 billion next year. That will stabilize the rupee. That will make our macros fall in place again, and we'll become an attractive destination again. Will they cut LTCG to attract FPI flows? I seriously doubt that. I do believe that their government is making a distinction between long-term, attracting long-term sticky money, and FPI flows are considered as hot money, and that is definitely not a priority for this government, as I understand. Now, I could be completely wrong, and I'll be very pleasantly surprised if it was to happen. But I think I will be more you know, probably hoping that something on the bond market side, something on the attracting FDI in some of the larger sectors, like probably what they have done for data centers, where they have given a 20-year tax holiday. I expect you know, at least $25–30 billion kind of inflow coming in for data centers. So those kind of more larger avenues will open up, and we have to take steps to attract capital. This will be a cherry on top, not something that I'm expecting.
Not the baseline, but you'd be happy.
Who will not be? I am anyway 100% invested in the markets.
You know, there was two on this question of how to stabilize things, and maybe it's already stabilized. We don't know. We'll be wiser in hindsight. But the fixed income guys were saying maybe we need a rate hike, and the counter to that is we're not a large foreign-owned debt market. This is an equity. I mean, it's an equity market, not debt market. I mean, when rates go up, it leads to selling, not buying. So I don't know if that does the opposite. So that's the other debate, which, I mean, the classical economics says increase rates. I mean, you know, bonds get firmer, rupee gets stronger, et cetera, et cetera. But I don't know. I mean, if that is something you've thought about or not, but at least on the fixed income side, we've heard that a couple of times.
No, I think, see, we have to think longer term, and I do think government is thinking longer term. And we have to correct this whole situation. Next time there's an energy shock, we should not be vulnerable to it, and we should not be vulnerable to capital flows going out. And how do you do that? First, basically, the biggest problems are we consume more than we produce, and we import more than we export. We have to correct those situations. So we have corrected to some extent on the electronics import side, but I think there's a lot more to be done on the energy side. Energy is the next big item. Gold, unfortunately we can't do anything about. Maybe we can do something to monetize the domestic gold that we have. We have tried and failed over there, but I think still more can be done. But on the energy front, I think that is where that is why I get that confidence that this energy transition theme, it is not only about moving away from fossil fuel to renewables, but it is also moving away from spending dollars to get our energy requirement. So we should have a domestically produced energy, and that is what will make our country far more stable and secure in the future. But that is a 10-year story. From a 1 year perspective, we need to take care of what is urgent and important rather than what is more strategic in nature.
Other theme which you've been very bullish on is the defense theme. I just put out some data. I was looking at for the last 4 years, the entire defense pack market cap has gone up by 6x, but the top line and bottom line has gone up only by 1.5 or 2x maximum. So, are you seeing that in many of these companies, market is overpaying the kind of valuation that they should pay? For example, today BDL was a classic accident for the day. For the 7th year in a row, execution has been a bit of a question mark on that company. How do you look at this opportunity? I understand big, long term there is a big TAM, but near term, you think there is a pain?
No, so first of all, let's understand what this long term is. Because of the events that I mentioned, which is leading to this global industrial capex super cycle, defense or the security concerns are definitely a part of it. We used to have US security cover, the NATO nations used to have that. That is not available anymore, or at least it is available at a price. It is not available for free anymore. So in that kind of a case, Europe is rearming itself. Japan, which post World War II, had pledged that they will never rearm itself, is again giving a boost to its domestic defense this thing. So there is a new wave of rearmament that is happening across the world, and the skirmishes that have happened everywhere has made everyone even more sensitive to that fact that we are also still spending only 2% of the GDP, and the other nations are spending 4-5%. So we need to increase our budget also. So I don't think the defense capex cycle is over, but it might undergo a transition, or it might undergo some kind of a change. Valuations can ensure that there are no returns for a year or so, absolutely possible. I think the big change that is happening in India is that we are moving away from a PSU-led defense capex cycle to now more a private sector-led capex cycle. Now the private sector capex, private sector has been opened up to defense. If you see the last 2026 DAP, the defense acquisition policy, a lot of the R&D where the DRDOs of the world were kind of monopolizing this. Now the private sector will be able to do that. Yeah. And the way this is structured is that first the MOD or DRDO gives the order to the large system integrators, who in turn give the orders to the large tier 1 vendors, sub-assembly guys, component manufacturers, and that is the value chain. So that value chain down the stream is where the opportunity is still opening up. Okay. So I don't think the defense cycle is over, but the large listed defense PSU defense companies, I don't think can be a large multi-bagger from here. They will be a compounder at best.
There is a sign of things that I think the founder of Solar Industries got, I think, one of the nation's highest civilian awards, right? I mean, so yes. which is quite incredible. We've not seen that.
Yeah, but I mean, that's a great example. But let me point you also to a fact that we've been tracking this company for the last 15 years, since 2010. It used to be an explosive company. Yeah. It still is an explosive company. It has a almost 1.2, 1.3 lakh crore kind of a market cap. The order book for defense is 7,000 crores, which is a big jump. But 7,000 crores and 1.5 lakh crore market cap. So the defense opportunity tends to come about slowly. But once it comes, then the runway tends to be much longer.
No, and just on this one only, I think 10 years ago, there were around 11 crores from defense. And in the coming year, they're talking about 4,500 crores of defense. So we'll have to see where this goes. But, as you're saying, the defense book is just 7,000 crores. So thereabouts. Time to wind down, guys?
Yes.
Absolutely. Thank you, Ravi, for coming down to our studio. It's been a great conversation. Thank you. Thank you. Well, with that, it's curtains down on Editor's Roundtable. Thank you very much for watching.
Hello and welcome. UBS is holding its Asian Investment Conference 2026 in Hong Kong. It kicks off today and runs for the next 3 days. Joining us now are Divya Nagarajan, Head of India Research UBS, and Sunil Thirumalai, who's the Executive Director, GEM Equity Strategist at UBS. Divya and Sunil, great to be speaking with the both of you as we kick off. I think 3 days of pretty interesting conversation. And of course, this is the first in a series of conversations we'll have with many from your teams. Well, there is so much ground to cover with respect to what is going on in the investment world. But let me just sort of start by getting a FII temperature check, if I can call it that, with respect to Indian markets. The temperature surely isn't running high, but how far below normal are we right now? Divya, why don't you go first?
I would say about 45 to 50. I think what we are beginning to see is that the earnings season has been pretty good so far. And I think people who have stayed away are now trying to see, can we look at some bottom-up ideas? So we are definitely seeing pockets of interest emerge, especially from an FII perspective. They're looking at value bottom-up stories that can be earnings compounders over a long period of time. So it's still early days, but I would say I would put it at an optimistic 45 to 50 compared to where we've been in the last couple of months.
Sorry, I said the range was 90 to 100. When I heard 45, I had a mini heart attack. I think you meant it in. You're saying it's picking up. That's basically what you're saying. All right.
It was.
The trajectory.
I would have put it lower a couple of months ago, but I think with the strong earnings season coming through, we're definitely seeing more incoming requests from foreign investors.
Yeah. And, guys, we're speaking to you on a morning when Taiwan has overtaken India's market capitalization. So we just looked at the live numbers, 4.95 trillion, and we're at about 4.92 or so. So it's quite incredible, right? But there's one stock there, and TSMC, which is outsized part of the index. Same thing with Korea as well. Actually, both a few weeks ago, both Korea and Taiwan were within 10% of India's market cap range. And Taiwan, of course, has now bridged that. Sunil, so come in there. Is that the main challenge? This entire AI trade and all these large stocks like TSMC, which feed into the big AI boom in the US? And so far, we don't have a foot in the door there, at least in the listed universe.
Yes, so I think just to take a step back and get a broader perspective, for the last 2 to 3 months, we've actually seen meaningful outflows of foreign money from all of EM, all of Asia, not just India. It's, Korea has seen big outflows, Taiwan has seen big outflows as well. But the drivers for those outcomes, in spite of that, we've seen, as you mentioned, Korea and Taiwan have done well, and India has, kind of underperformed. So there are a few, angles to that. AI is a very important aspect, as you mentioned. There does not seem to be any letting of demand from the US hyperscalers in terms of their capex, and hence the demand for the upstream companies in North Asia. And yeah, of course, India is kind of missing out on that. And added to that, is also the oil price spike and then the Iran conflict. While even the two markets in the North Asian markets that we are discussing are also dependent on imported energy. They're not energy surplus economies. They are importers. They've been able to manage it probably a bit better, and for sure for these specific industries, they are being considered as strategically important, and a lot of support being given to those. So yes, I think AI trade is pretty important for this divergence where India has underperformed. We're not sure if that's dying out anytime soon.
Sunil, the reason why there have been large outflows, actually, out of markets like Korea, Taiwan, etc., is it? I read that for large active EM investors, there is like a 10% limit on a single stock. And because these are essentially, such large trades, TSMCs, right? So is that the reason why perhaps there has been some selling out of those? So occasionally we see these kind of sharp outflow numbers, and then they come right back.
Yeah. So absolutely right. It's not that I think it's because of the single stock limits. TSMC is beyond 10%, and Samsung is less than 10% for an EM investor, but it's catching up pretty soon. So there would be some funds which are above who would have been overweight Samsung, for instance, and they are being forced to sell. So I mean, I think that is definitely there. So it's not that. So which also means that if there is any correction for some reason in some of those stocks, you could see some buying coming back immediately. So that would also provide some floor to those stocks. So there is this technical factor at play as well.
Sunil, can India have a bull market in the absence of an AI play or the AI ecosystem? What is your own view?
Well, okay. So I think a bull market for India is an absolute return concept. It's not a relative return. So it's possible that EMs do well. India may underperform because of whatever AI trade that's happening elsewhere, but it can still have a positive return year, right? So I think the two are not really mutually exclusive. If you have decent earnings, if you have it is a domestic story for India given the way the index is. So if you have decent earnings growth, if you have you're beginning to see banks pick up on credit growth after a while, they're gaining market share against the bond market. And if they are, able to, manage their margins, and probably see some increase in margins in a rising rate environment, all of that is good, right? You have other themes like defense, renewable energy, etc., that are picking up across the market. So I don't think, and importantly, keep in mind that after COVID, the foreign investor, the impact of the foreign investor in determining the direction of the market has kind of reduced a bit. It's not gone away, but it has reduced a bit. And if the domestic money is supportive and if the earnings start recovering, there's no doubt why India can't have a positive return year. And outperformance versus underperformance versus the rest of EM can be for various other factors.
Okay. Divya, you said that the foreign interest in India is picking up, albeit slowly, but it's still picking up. There are certain themes, bottom-up ideas that they're looking at. Do you want to tell us a little bit what is catching their interest? Are there any sectors or themes?
I think as Sunil spoke, Rima, I think financials is definitely an area we're seeing a lot more interest, both on the banking and non-banking side, surprisingly. And again, it's for the reasons that he mentioned earlier. I think the credit growth is picking up. We were also, I think, just coming out of a few years of cleanup on the NPA side. So the sector is actually in a good place and in a much better place, I would have said, than if this crisis had happened a year ago. It would have been a different story. But now the sector is actually in a much better fundamental space. So I think banking financials is definitely a place that we are seeing interest. But also smaller mid-cap names, which have been, again, out of favor from a foreign perspective for a while, where there are compounding stories, sustainable earning stories. We're definitely seeing interest. There's a lot of questions around what's going to happen around energy security. What is India doing on renewables? Will you fire up thermal? Will you fire up nuclear? So there's definitely a lot of interest around energy security as a theme and renewables as a theme. So definitely in areas of interest there.
Divya, you'll also believe as a house that the AI theme has still a lot more legs to go. How long do you think this can run? Can it run for another 1 year? We're talking about 3 years, because that in a way determines India's relative performance. What is your own view, or the emerging market view at UBS? Divya?
Yeah, so let me sure, let me take that. So I think the way we would look at it is that the timeline or looking at when this trade ends essentially depends on when the revenue monetization hope for the US hyperscalers disappears, right? I think there is some level of monetization that's happening today. Not a whole lot, but it is picking up. Every new model release that comes out and disrupts a particular industry, like we've seen the legal industry being disrupted, consulting industry, and so on. Every new model release that comes out is basically a motivation for those model developers and the infrastructure providers behind them that there is revenue to be made. As long as that hope is there, I think money will continue to flow into those markets. Now, at the end of the day, keep in mind that the entire AI value chain from the hyperscalers to the providers at the semiconductor providers on the upstream, they're actually making, as a group, a lot of free cash flow. So they're not burning money in the traditional sense. They're not. It's very different from the dot-com period when the cable make companies were investing a lot of money, getting into a lot of debt, and so on. That's not the situation. So that basically means that this could have some room to go. The opposite scenario, which would be relatively positive from the Indian market's perspective, would be if the very quickly these companies realize that the revenue upside is just not there. People are not willing to pay, and the token budgets are getting exhausted, but the token costs are not coming down. The unit costs are not coming down, just like technology costs normally fall, and hence there is a big challenge in revenue monetization. I think that's what I would watch out for. Right now, it seems like they are making decent FCF as an ecosystem, and that should give them some room to continue with this.
Well, interesting point there. Hold that thought. We're going to take a quick commercial break here. Come right back and continue this discussion.
In the straight.
Welcome back. We are in conversation with Divya Nagarajan and Sunil Thirumalai of UBS. The UBS Asian Investment Conference kicked off in Hong Kong today, and we are talking to them about all things investing, particularly with regards to where India finds its place in this big AI boom, which is underway globally. AI boom in India is not a prerequisite for markets to do well, but let me flip that. Is a AI sell-off elsewhere a prerequisite for foreigners to come back in a large way to India?
So to a large extent, global equities are kind of geared up and leveraged to this AI trade. So if you're talking about a serious unwind, that would be bad for equities globally, right? So you could see a relative outperformance of India, but I'm not sure we can be very confident of India having big upside.
It's not my case that we see a global sell-off in India is up, but generally, relatively, we'll stop talking about this for a bit. We'll start talking about, the good old, all the sectors that there are top sectors here. That's what I meant.
But I would just add at the starting of the of this question you mentioned about the AI trade not being there in India. India can still benefit if AI diffusion and adoption happens 100%. At an economy level. It's a very solid 5-year story. And hence those things will start showing up in our market in other sectors over time. But I just want to point that out.
Yeah, no, 100%. Divya, so run us through, so banks is one, right? You said that energy security comes up, and I think you've got positive views on names like ONGC and some of the others there. So just talk to us about where to kind of, which are pockets you'd pick out and sort of look deeper, study more for ideas.
So I think there are two parts of this conversation, right? The here and now versus what happens if the conflict drags on. So let's leave the conflict dragging on situation aside for now. So I think banks we've talked about, energy security we've talked about. Actually, if you look at the consumption stories, I think consumption's also been picking up. I think if you look at the consumer sector, especially the big staples names have actually done pretty well compared to our expectations. So that's another bright spot right now, assuming that that story doesn't get derailed. But I would argue that if inflation comes back, then some of these big, large consumer names could be a little bit more resilient. We also like the short cycle industrials because there's been inventory replenishment, and I think we're seeing that inventory ordering pick up. And that's, I think, a place that we like as well. Long cycle capex could get pushed out more because we have uncertainty going on, but I think the short cycle industrial capex is where we expect to see continued positivity. The last place I would also say is defense. I think we are in an increasingly uncertain multipolar world, so I think that continues to be a secular area of spend for governments across the world, and the Indian government, I think, is no different there.
And Divya, on IT, not in the near term. In the near term, the market narrative is very simply put that Indian IT is an AI loser. But we've seen the Indian IT industry navigate through various technological changes. And if, as Sunil said, that AI diffusion takes place, then and AI adoption picks up, maybe the Indian IT companies do have a role to play. Which side would you bet on, Indian IT over the medium term, valuations aside, just purely on the basis of a business case, on the kind of growth numbers that we have on account of AI 3 to 5 years down the line? Would you be bullish or bearish on IT?
That's essentially taking a call on whether generative AI succeeds on its promise or not and how it plays out. But I think taking a balanced view here, I would say that the companies are much more faster this time around in preparing themselves and disrupting themselves. So you have many large companies have already started reporting AI revenues. So you can see how they're investing in it, how those revenues have started to grow. We're seeing very healthy double-digit QOQ growth in what these companies report as AI revenue. That being said, there will be some disruption on the existing base, which I think will have some impact over the near term. But overall, I think the companies are definitely preparing themselves to see how they can stave off being disrupted to the extent that they can. The caveat here is the technology itself, because the technology, as I said to you when I was there last, is still very young. And as the technology evolves, I think its capabilities seem to be evolving by leaps and bounds. And that, I think, adds a little bit of uncertainty to the level of preparedness that the industry can have on this. So net-net, I would say we are slightly cautious and we like the smaller names because I think they're a little bit more nimble and agile compared to the large caps.
Sunil, say the same. I mean, I just want feedback from foreigners on IT. What do you hear? IT services in India.
I think that's a uniformly negative view right now from a foreign investor perspective. Sorry, Sunil, go ahead.
Yeah, I would agree. It's generally negative, and I think there's also a lot of people are looking forward to just the IT companies themselves messaging and clarifying what their strategy is better. And I think that would really help if over the next, let's say, 1 or 2 quarters, their own strategies are more clearer and put out there. But yeah, I mean, I think there is a lot of skepticism.
Divya, at a slightly high level, I mean, if you pull back a little bit, right, with if AI really is going to change the world, I mean, we thought technology will change the world, now AI will change the world. AI technology did change the world. So if, there's generally, we don't know, right? I mean, it's a debate. Will it create more well-paying jobs? Will it sort of, create, what will it do to effective demand, right? Demand at a certain price point in countries like India. Is that a question which comes up at all? I mean, it's a question which everyone is there somewhere, but no one is really sure how to answer it or how to frame it, Divya, if you can take that.
So let's look at the bull case, right? The bull case is that the IT outsourcing exports. It's not just the Indian companies anymore. We have these big global GCCs that also export IT services from India. If that story remains intact, we don't have to worry about consumption. The sector adjusts, there's a short-term blip, and then we move on. And then the India story, the consumption story, everything continues. If you go to the other end, the scenario there is that if it disrupts jobs, and the white-collar jobs in India are largely concentrated around some of these sectors, then what happens to the ripple effect on the overall economy? Then you could have second-order, third-order impact. So I would say these are the two ends of the outcome. We would hope that we end up towards the positive end of the spectrum, where the industry and the export services say adjusts, and therefore we find some way. Sunil, I think, please feel free to jump in. But we've also seen how India's leapfrogged technological advances and moved. Like, for instance, I never had a landline because we moved around a lot, and then we went straight into mobile phones and mobile payments and everything else. Could we have something like that benefit India? Could AI actually end up being a benefit for India, where we leapfrog certain parts of our evolution?
Yeah.
I think that's an interesting question as well.
No, I think that's, Sunil, if you want to come in. I was talking to someone in a top consulting firm who consults in the digital AI kind of adoption thing. His perspective was there's a lot of FOMO right now as well, especially if you're listed. What is your AI strategy? What are you doing? So maybe but it's real, but there's also some level of FOMO. But yeah, Sunil, jump in if you want to.
I mean, if I may quickly add, I don't think we have the kind of confidence or visibility that we'll get into a situation where large corporations suddenly come around and say, I'm firing 90% of my staff. No, I don't think that's so that economic disaster where there are no jobs and companies are just focusing on cutting down staff. I mean, that's a very, very far away, low probability event where we stand right now. What is more likely is that companies use the available AI tools and the upcoming AI tools to become slightly more productive. Cost of delivery of products or services to their customers comes down, and hence their addressable markets go up. That's how I'm thinking about it, at the moment, because that's what is visible right now. That's what we are seeing, within the companies that we study or within our own organization. But I don't think we should, start factoring in situations where, 90% of white collar staff in India will get fired and, it'll all be done by AI. No, I don't think that level of confidence we have on the technology right now today.
The way you just briefly spoke about consumption, I wanted to understand about how you approach gold as an asset class, and also in terms of theme. Some of the jewelry stocks, they pulled back because of those duties that were imposed. But otherwise, the gold appeal seems to be quite strong. So your take?
Well, I don't claim to be an expert on gold. I think India has always been a gold-hungry country. But I think the gold is also, as long as there is uncertainty around what the Fed is going to do, I think the gold prices will remain volatile. That's our house view. I think Bhanu Bhaveja, our strategist, when he was here, and I will quote him, he said gold could have, we've seen a lot of volatility and a spike up in the last few months on gold on all these concerns. But we do think there's some upside left, but in the short term, I think the uncertainty around interest rate hikes in the US will keep gold volatile as well.
So Divya, my question was on the jewelry stocks. Do you believe that they fall well into this consumption basket? Some of them are not very, very cheap. The largest player in there, which is Titan. And the other ones, at some point of time, they're given a bit of a heartache. So your view on the stocks?
So I think it's, as you correctly said, very stock specific. There are some that are well-managed companies and have navigated gold prices very well. And there are others who are still kind of finding their feet in terms of managing those idiosyncrasies. So I think it's going to be very company specific there.
Sunil, if the war comes to an end tomorrow, do you think the Indian markets rally hard? Will foreign investors, because energy security is one of India's vulnerable points. So if the war comes to an end, what kind of upside do you see immediately in the markets?
There will be an upside, yes, of course. But I would go back and see how much as the market has actually fallen since February 26th. when we had no clue that this war is going to happen, right? So I'm not sure if anything beyond a 4-5% kind of a upside, based on this. Then you come back to fundamentals. Then you come back to relative earnings growth. India versus other markets, and within India with sectors and so on. So it is definitely a good sentiment positive, but I don't think. Just like tariffs last year, which was a big headline news, but the markets largely shrugged it off. I think that's been, what we've seen in the markets across global markets when it comes to oil price impact as well. So yeah, that will be a positive, movement, of course, but I don't think it'll be a whole lot.
Divya and Sunil, when are we seeing the first AI agent sectoral researcher? At one of the sell-side firms, will it be in UBS? At UBS, I'm sure there is one already somewhere. Divya?
Well, I think the way I would think about it, not to alarm any of our population or sell-side brethren, I think it is definitely a good helper. I think it can definitely help us kind of get to the market faster. And I think we do at UBS have a lot of programs that help analysts kind of publish faster, respond to market reactions faster. And we also have AI avatars. So the next time, hopefully, my avatar is speaking to you and not me. But that being said, I think for regulatory and for whatever logical reasons, I think I would like to hope that human brains don't get replaced, and therefore our analyst community and our sell-side brethren, I think, can rest in peace that there is the human value and the logic that we bring that still continues to be accelerated by AI rather than replaced by AI.
When I heard that rest in peace, no, but point taken. I hope we're all here, a year from now, and you sort of join us for the next leg of the conference next year. Thank you very much. Great start, and wish you all the best of luck at the UBS Asia Investor Conference. Thank you for joining us.
Thank you.
welcome to the Editor's Playbook. Today we discuss something that is hot topic from the White House to the Vatican. Well, it has to be artificial intelligence, but we dive into the India stack and the fuel powering the world's AI engines. Now, foreign portfolio investors have pulled out over $24 billion from the Indian equity markets since the start of 2026. A major driver behind this exodus has been the global reallocation of capital towards artificial intelligence and tech-linked assets. But this, again, is something where the debate is split wide open. But consider this, Taiwan's equity market, where Taiwan Semiconductor Manufacturing Company accounts for more than 40% of the benchmark index, has now become the world's fifth largest stock market, powered largely by the global AI boom. Taiwan's weight within the MSCI Emerging Markets Index has also surged sharply over the past several years. Meanwhile, AI-driven demand has turbocharged memory chip makers like Micron Technology, as memory increasingly becomes one of the most critical components of the AI revolution. In fact, NVIDIA, SK Hynix and Samsung Electronics, three companies at the heart of the AI boom, have each added between $690 billion to $750 billion in market cap just this year alone, as investors aggressively chase AI-linked growth. So which brings us to the key questions. How many trillion-dollar companies do we have in India? To be sure, the Indian government has placed significant bets on semiconductors and data centers, but have we truly unleashed the genie yet? And perhaps more importantly, can an AI deficit eventually become an economic problem? Joining us on the show today, Prashant, Rima, Sriram and Hormuz. Rima and gentlemen, thanks very much for joining us on the Editor's Playbook. Prashant, let's get straight to it. Do the Indian stock markets have an AI problem or not? Where is India placed on the global AI table?
I think we do for now, Shireen. Great to be back on the playbook. And yes, I mean, I think it's very clear that we do have a problem, whether we like it or not. And let me just start with a data point, which I think helps focus the mind. As someone was saying, I guess exaggerating a bit to make a point, there are only three stocks in Asia which are attracting all the capital. There is Samsung, there is TSMC, there is SK Hynix. These three, the foreign holding in these three companies, Shireen, is 750. It's about $1 trillion. The three foreign ownership, foreign value of foreign holding in these three companies is $1 trillion. The total value of foreign ownership in India is $750 billion. So, that just tells you the size, scope, scale, etc. Now, to your specific question, does India have, listed AI plays, especially from a market standpoint? And what I've done really is looked at, the different layers of where, what AI is. Because when we talk about AI, largely, the conversation revolves around LLMs, etc., the large language models. But let's take it from the top, right? So first, of course, is the global AI capex. Who's doing 90% of the capex? It is three companies: Microsoft, Amazon, Google. And when the others like Oracle, etc. But these are the three which account for about 90% of all the capex. One layer down, of course, we don't have a play here, obviously. Second is the AI accelerator sort of layer, which is essentially the chips, the GPUs. The big ones, NVIDIA is the big daddy. There is Broadcom and a bunch of others. Again, we don't have a foot here. Memory comes one layer below. As you were just saying, there is Samsung, there is Hynix, and there is Micron, etc. You come to then you come to the advanced packaging, which is, what we call OSAT here. And, we are trying to build businesses here. Keynes, for example, is listed, and maybe you got one or two other, SEG Power, for example. But, the big ones are Semco, LG, Doosan, etc. These are the big ones, right? Then you come to one layer below, which is the network fabric. And here, again, LG, OE Solutions, etc., the big ones. Here in India, there are companies like Sterlite Tech, maybe an HFCL, which are trying to pivot away from telecom to data, providing network fiber for data centers. But again, very, very few. Then you come to the data center build-out itself, right? Which is, I missed one layer, which is, of course, the package chips have to be put together in an AI server. We have maybe a NetWeb, for example, but the big ones are Semco and some of the others. Data center build out, yeah, we have companies. We've got about 1 gigawatt of capacity. We have ambitions to go big, but again, it's a few here, few there. Then you come to the grid electrification and the power story, and maybe you have a few companies, again, not particularly, they're not Indian companies, at least those who have the technology. We talk about this HVDC technology, but that is Hitachi and GE Vernova, right? Nuclear is one level lower in the US, for example. People are talking about data centers having their own captive capacity. Maybe in India, because of the law has changed, we will get some action happening there. But the point is, if you look across the value chain and the hundreds of billions of dollars flows from right at the top, US, right? And those three companies which I spoke about, and it flows through across the system. And who's sending all the equipment needed? I mean, who is essentially getting all this money? Or the capex. It's not US companies. It is companies largely based in Asia, based in Korea, based in Taiwan, and I mean, whether we like it or not, perhaps based somewhat in China as well. Those are the guys who are sort of, recipients of these, whatever. I think the number for 2026 in terms of capex is some $750, $800 billion, just about 5 or 6 companies in the US.
No, just give us that FII number again, Prashant, the FII holding as far as these AI companies are concerned?
Yeah, just 3 companies, Shireen, right? That is the three Asian companies, TSMC, SK Hynix, and Samsung. The total FII holding in these 3 companies is $1 trillion, $1 trillion. The total stock of FI money in India is about $750 billion.
Well, that tells you the story, but let me bring Hormuz into the conversation since we are talking about $1 trillion companies being minted overnight, 2 of them being minted overnight, Hormuz, and that gives you a sense of the size and scale that we're also talking about.
Absolutely, it does. And, the market is working on a very simple principle, right? You give us the numbers, we'll reward you. And you give them a theme. Whenever you speak about something like this, the easiest example to give is the new age companies that listed in India all the way back somewhere around 21, 22. At that time, they were loss-making companies. Eternal is a case in point. That one point, the IPO price was around 75, 76 rupees, went up to 130, 140. Then when the numbers were not showing up, the street smashed it down to 40. When the numbers started to show up, it went all the way up to 360. Yeah. And that's the case with these companies as well. So it's not as if the street is blindly chasing a theme just because it's the hot topic right now. You take a look at the numbers for these companies over the last 3 quarters. NVIDIA's revenue growth 2 quarters back was 122%. On that base, it delivered a 94% revenue growth in the quarter prior. And in the most latest quarter, it still delivered a 53% revenue growth on that base as well. So it's not as if you would have a company who would grow 20% one year and the next year they would say, oh, we have a high base, so we'll grow only 6 to 8%. They are delivering the numbers quarter after quarter. Same is the case with Micron. Same is the case with AMD. Numbers are coming in, and that is exactly the reason why the stocks are doing what they are. Micron's market cap at the start of the month was $750 billion. Yesterday, it went up to $1 trillion. And that's because UBS came out with a note and they said that the stock can triple from current levels. And they said that their target earlier was 535. They raised it to 1625, which is more than 100% even from where it closed yesterday. So that's the kind of, and at the end of the day, you put your money where the mouth is. So if those are the kind of stocks that are delivering you the returns, it is only obvious that the money will go there. There are 2 stocks that are powering the Korean stock market, that's Samsung and SK Hynix, and 1 stock that's powering Taiwan, and the Magnificent 7 is powering the S&P 500 and NASDAQ to record highs almost every day. So numbers are coming in, and no matter what the doomsayers say, okay, AI is going to be, they are resembling the dot-com bubble and so on and so forth, but till the time the numbers keep coming, the market will keep rewarding them.
Shireen, just one thing.
You're absolutely right. And Prashant, I just wanted to make a point, which is why you see whether it is the Jensen Huangs of the world sitting there and saying, or Jeff Bezos, both who were on CNBC saying, look, we don't believe that this is a bubble. And to Hormuz's point, and that is because the earnings continue to show up there, at least at this point in time. And, you can argue whether this is going to hit a roadblock. Is it overdone? But at this point in time, the numbers are matching expectations. In fact, for many, ahead of expectations as well. Go ahead, Prashant.
No, Shireen, the point about what Hormuz said, right, that many making the comparison with the 99 tech boom. Back then, it was, it was valuations which were absurd and there were no numbers. We were talking about 100p, 200p, all kinds of numbers. Take a P multiple of the latest minted $1 trillion company, Micron. And this is not now. The average forward P multiple for Micron over the last 12 months is 10, right? That is because over the last 12 months, the earnings for Micron are up 10 times. So the P multiple is stayed at 10. And that is
also the company that pivoted to Bitcoin storing, right?
No, that's MicroStrategy.
MicroStrategy, okay.
So that is the point, right? Which is it's valuations, and we've looked at these numbers. I'm actually just take a look at the P multiple for the Korean stock market. It is, I think, about 8 times, 7 times, 8 times or something, right? So it's backed by earnings. I mean, of course, we can ask the question, and it's always good to look over your shoulder and look for signs whether this is getting. Because if the earnings stop coming or the earnings start to decelerate a little bit, look, for example, memory, Shireen, at the end of the day, it was always a commodity. But because there is just physical shortage of it and prices are being, prices have gone through the roof, these companies are making money hand over fist. So if the earnings start coming off for the top layer, which is the 3 companies or 5 companies in the US, then they start cutting back capex. I mean, the entire flow-through will start to look, it'll be lesser. The flow down will be lesser. And at that point, we'll start to wonder whether this is excessive or not.
But at least for now, these companies Micron...
I think the question mark there on the capex continues, but I'll get Rima to weigh in on that. And also, Rima, put this in context of what we are seeing as far as Indian markets are concerned.
Well, just to add to that point about Micron, and all these companies have orders booked for the next 3 to 5 years. Earlier, when Micron was considered to be a cyclical play commodity, you could replace one memory chip with another one in the CPU and work would be done just fine. So it was dependent on the vagaries of demand and supply and commodity prices. But now with GPUs, these memory chips are highly complex, personalized and customized, which means they also command a pricing power. But just to get back to that point about the AI haves and have-nots, and India currently is in the have-nots. We've got about 15 companies in the $1 trillion list. There is no Indian company in the top 100 companies in market capitalization. And since we are talking about the 2 newly minted $1 trillion companies, SK Hynix and the other one is Micron, at the start of the year, in 2026, when we began, 1st of January, the market cap of these companies was about $300 billion. Today, it's $1 trillion, which means they've added $700 billion. India's largest company by market cap is a Reliance Industries, and their market capitalization is less than $200 billion. It's followed by an HDFC Bank at 123 and a Bharti at $118 billion, which basically means that one company, say a Micron, has added $700 billion in this year alone. That is equivalent to 3 Reliances and 1 Bharti in terms of value, which has been created at a valuation level, Shireen.
Well, yes, we'll talk valuations and through the course of the show. But, Sriram, I know you believe that India has a play and India has a right to win in the AI era, despite what the markets may be telling us at this point in time.
Yes, Shireen, it's interesting how you can spin a narrative. I mean, and that's exactly what we are seeing that's happening, right? Prashant explained it in 6 or 7 layers, how you want to divide the AI industry. I would borrow from Jensen Huang, who divides it into 5 layers: energy, technology, infrastructure, LLMs, models, and applications. And if you look at it in that sense, India has a play in 3 out of these 5 sectors. If the argument is that India does not have an AI play, it's essentially centered around the fact that we don't have semiconductor chips, neither do we have foundational models, right? And that is true for every country except 4, right? US and China have models, Taiwan and Korea have chips. Any other country you take, you can make this argument against it. But that has not, for example, Brazil, Taiwan, Thailand, Indonesia, a bunch of these countries have actually seen net inflows into their economy. Despite, I mean, they're not talking about, is there AI or not? Do they have chips? Do they have models? So I think the narrative is that AI is a global phenomenon. And to address what Hormaz is trying to say, right, that NVIDIA has given you a growth on top of 100% growth, and it's 2 years of back-to-back phenomenal growth. That is what happens when you have a monopoly. You have pricing power because you're the only player, and I think that is the one thing that the Indian government is trying to avoid. I think we have a philosophically a different approach towards building AI. Time will tell whether it is good, bad, whether it works or not. But I think in principle, it makes sense to me.
through the start of the year, every time we see something from Claude or we see something from OpenAI, the meltdown that we see as far as the Indian IT services sector is concerned, I mean, that's real. It's been something that we've been talking about, and it's something that's very visible in the markets. Now, again, the question, though, is what does it mean in the near term? What does it mean in the medium to long term for the Indian IT services industry, for this ecosystem that has been a job creator, that has been a forex generator as well?
Well, I just want to point one data. It's HCLTech. So that's the first company, a tier 1 company, in its conference call today, in its conference call earlier, spoke about 40% of the industry is AI disrupted. So that's the only company which has put out a number which can shrink 3 to 5% for the next few years. He said 55% is AI augmented, and that has to play out, and that can grow 10%. And only 5% of the IT industry today is AI native, and that can grow 30%. So as things stand today, what HCLTech is telling us is that 40% of the industry, IT industry, can shrink. Right? And this is an industry which has seen hyper growth. It's slowing down, and this would be the 4th consecutive year of a slowdown. And the problem comes back to jobs, right?
They are the ones to blame. I said this in few playbooks earlier also, right? If you have 500,000 engineers in your team, you should have built a ChatGPT, but you didn't.
Right? Even a Meta is laying off, right? You can always make that argument that global tech companies are laying off.
But having said that, in the same software industry, I believe in them, that, tomorrow when the dust settles down, they will be able to generate more value out of AI, hopefully. Maybe it won't be the same players. Maybe it will be someone else.
But there was a fortune.
And I just want to bolster the point that Sriram was making in the context of what we've seen coming in as commentary from Uber, saying, look, the cost of tokens is not giving you the kind of returns on investments or productivity, and perhaps that is going to be a question mark. And perhaps in that context, with the talent that we have, and with that being one of our strengths, this hybrid workforce that is being reimagined at this point in time, can that be a strength, Prashant Rima Hormuz?
On that token point, Shireen, so there are two impacts, right? One is actually that news that Microsoft and Uber, etc. They say, companies are blowing up yearly budgets in 3 months, right? But there is another way to read it. So the other way, one is of course saying, well, it's too expensive. The other is, well, people, engineers, etc. are loving it so much that they're actually blowing through the annual budget in 3 months, right? That's the other way to look at it. That it's so efficient that. But the cost is very high. That's the point.
And Prashant, you'll have to see it as a life cycle also, right? Right now, the AI is in that age where it needs semiconductor, it needs LLM. And as it matures, these are the things that they are going to ask for applications, and that is when Indians come into the picture.
Absolutely.
So I think there is a point, right? Yeah. There is a cost and there is a value. So yes, the cost of tokens is going up and the cost of using AI is going up dramatically. But the question is also the value. By using AI, if your productivity is going up to such a great extent, your go-to-market comes down, you can do the work instead of 3 months, you can do it in 1 day. So then it adds value at the end of the day. So there's a difference.
We have evidence of that. I don't know if Hassan Karmali is in our production control room or not, but the amount of graphics that we can churn out now within minutes, what would have taken us an entire day or a couple of days, we're being able to do in minutes. So the productivity gains are there for everyone to see. But it comes back to the cost aspect. Yeah, Prashant, go ahead.
So if, say, for example, just to complete that point about tokens, right? The biggest risk is China, which is, of course, maybe a step behind US. They come out with, with significantly lower models, and the cost drops. It's going to be great for AI productivity and everybody who loves AI, but that may actually be the primary risk to this entire AI super cycle, because the industry right now, Micron is priced a certain way. They're expected to make all these, is because there is, it's an industry built for scarcity. Correct. And if scarcity goes away, suddenly this entire thing will look very, the AI will be real and the productivity gains will be real, but what happens to financial markets and this entire big boom we are seeing in AI related stocks, that is another thing. Just one more thing. I heard something very interesting from a consultant who's working in this space. He said, he told me two things actually stood out. One was that there is especially amongst listed companies, and he was not necessarily talking about India, he was talking about companies in the Middle East where he primarily works, and in the US as well. there is real FOMO. Listed companies want to come out and put out a press release saying, well, this is what we're doing with regards to AI. This is our AI unit. Everybody wants to be seen to be one step ahead, right? And not like have a lackadaisical attitude, or at least not seen to be having a slightly relaxed kind of approach here. So that was interesting. And second, he also said that a lot of layoffs, etc., which are happening in the US, and I think Rima has been talking about this for a while, they are showing up in India. Those jobs, for example, someone pointed out and I checked it out, it was correct. LinkedIn just opened their largest campus in India, in I think Bangalore or Hyderabad, right?
Bangalore, Hyderabad,
Gift
City.
The cost is so significantly. You have to pay $100,000 or whatever in the US, and here you can pay $30,000, $40,000. I mean, so it's a no-brainer in that sense. The old story. I mean, the wage arbitrage. But that is also getting accelerated because of everything which AI is doing right now.
DeepSeek moment. You remember January 2025 when China came out with a much cheaper version of ChatGPT? There was actual consternation amongst the US markets, and the US exceptionalism in tech was questioned.
And to add to that cost bit, right? Because the cost bit right now, the market is appearing to overlook that factor, because all of these companies, all the big tech, the Magnificent Seven, all of them are funding this 180 billion, 200 billion capex through their own cash. And they're generating so much cash every quarter that they don't need to. The only company that perhaps went through the debt route was Oracle. They announced that some $35-40 billion debt financing, and the stock got smashed for a couple of days, and then everybody forgot about it. So
That's the problem, Armas. Things people are forgetting in this euphoria.
No, but that's how it is. People forget. Until the times are good, people forget the concerns.
Precisely.
So as of now, till the time the companies are funding it through cash, and as long as they are getting what they want, they are ready to pay that extra premium, and so do we. If we get that, if we have that convenience factor, we are ready to pay that extra buck as well.
This line that it's being funded by cash is thrown quite loosely. There is a significant amount of credit funding that has gone into this AI capex, or not all of it is cash funded.
Even Meta, etc.
And that is a significant risk, again, forgotten by the markets.
Well, when times are good, the market tends to forget. When times are not so good, the market will remember. But, to the point that you were making, Prashant and Rima, about this, ostensibly being a scarcity play as well, which is showing up in the kind of valuations that these companies are enjoying. And many researchers, AI researchers, argue that, look, DeepSeek may not necessarily be an exception, that this model of heavy compute, etc., is probably also in the enlightened self-interest of these companies to play on, to be able to extract the kind of valuations that they are enjoying. So that is something that we're going to have to keep a close watch on as well. Can you actually deliver the same outcomes with less compute, with less costs? And I think that is up for discussion, debate, and evidence. But DeepSeek certainly is one of the companies. But this is not a debate that's over by a long shot. It is going to be a discussion that we will continue to have. But Prashant, the quick final point on India and the markets, in light of everything that we've seen before we close, and of course the Pope getting in on the AI debate as well. We'll end with that. But Prashant, the quick final word.
I just think, Shireen, it is, you don't, as I said, you don't have to make money buying an AI stock, right? But yeah, I think it is. I mean, I'll give you an example, Shireen, right? We are dependent on oil. Our oil hurts India because we import big amounts. I mean, 5 million barrels every day, right? 80% of our oil is imported. But so is Korea and Taiwan. But guess what? They're running current account surpluses. And this year, both countries, current account surplus as a percentage of their GDP was projected to be, last year was projected about 5-6%. It's going to be 20% plus. Current account surplus as a percentage of GDP with oil at where it is, right? So this is so there are all kinds of implications of this.
We're out of time. We are going to continue our conversations on the Editor's Playbook. If you enjoyed watching this show, then send us your feedback and your comments. Tell us what you'd like us to talk about on the next one. Till then, from all of us here on the team, goodbye. Thanks very much for watching, and see you soon.
Welcome to Indianomics. What's puzzling about the rupee fall in the past 15 months is that it is happening at a time of modest current account deficit. Current account deficit, or CAD, is the extent to which current outflows like imports, interest payments on loans are higher than inflows like exports and remittances. Historically, over the past 30 years, India has run a CAD of just 2 to 2.5% of GDP, and we have had enough capital flows to fund it. In 2013, CAD went up to 5% of GDP and we had a rupee problem. But in FY25, India's CAD was only 0.6% of GDP and we still had a problem. Likewise, in FY26, CAD, or current account deficit, is only about 1.3% of GDP. We still have a falling rupee because capital flows are not enough. The problem is, historically, we always had enough capital flows, that is FDI and FPI inflows, to bridge the current account deficit. But in the past 2 years, we are not able to get capital flows even to fill smaller current account deficits. But then we can't do much about capital flows if investors are chasing AI stocks or commodity markets. What we can control is our exports and imports. Hence, the Indian government has signed a host of FTAs to boost India's trade. India signed 9 free trade agreements in the past 5 years, and 11 more are in the pipeline. The question we are asking today is, will more FTAs help us to bridge the current account deficit? Will they increase capital inflows in the form of FDI? Will they give us more services exports? Joining me are 4 experts: Arpita Mukherjee of Eicher, Amita Batra of JNU, Rupa Chand, formerly of IIM Bangalore, and Professor Pralok Gupta of the IIFT, Indian Institute of Foreign Trade. Gentlemen and ladies and Mr. Gupta, thank you very much indeed for your time. Well, let me start with Arpita Mukherjee. Ms. Mukherjee, you know, I was looking at the data from UAE and Australia. Those are the 2 countries with which we first signed FTAs. They become effective in 2022, I believe. But if I looked at it, 22, 23, 24, 25, 26, it is not as if exports have grown a great deal. I mean, they've grown in some years, but, you know, to Australia, for instance, exports have grown by just 3% in FY26, 3.96%. It's not as if the FTAs have done wonders. Are the FTAs taking time to generate exports? How should we look at what to expect from the free trade agreements?
See, basically, the exports happen from the free trade agreement based on tariff phasing period. So you have to wait for 3 to 5 years to see a change. Having said that, the 2 countries that you selected are actually a very low tariff country. So they, any which way, had very low tariff. And the FTA that you selected with Australia is actually a mini deal. It's not a very comprehensive FTA covering wide range of products on both sides. Secondly, after the trade agreement is concluded and signed, it takes time for the implementation, and based on the phasing out, you see the benefits. So if you are entering a zero duty immediately on signing of the agreement, that will show something, or else you are going for like 5-7 years phasing out, then you will see the growth in exports slowly.
Okay, fair enough.
These are 2 things you have to take into account, and don't take all trade agreements from the account of, you know, that they will really boost export. It also depends upon the market. There are markets where you know, the custom duties are much lower than India. In most countries, they are lower than India. So, you know, when you are doing a free trade agreement, India may have to reduce the duty more than those markets. But there are many other gains of the trade agreement, like you bring in regulatory parity and all of that. That we can discuss later.
Fair enough. Fair enough. Professor Batra, would you want to add to this? What's your take? Is my whole premise to look at FTAs as a solution to current account deficit all wrong?
Not at all. Yes, exports are expected to be pushed up because of an FTA. But as has been said already, there has to be a distinctive higher preferential margin that we must be able to access the other market with. In case of Australia as well as EFTA, you see the tariffs on the other side are low, preferential margin is low, the incentive for our exporters is low. Plus, there is also another aspect, you see, which is that when we look at competition in these markets, particularly when we're talking about Australia, there have been some gains, as you mentioned, in the textiles and clothing sector. But these are far smaller than the rate at which you see a competing nation like Vietnam gaining in Australia. So these are, Vietnam is a country that's already present in these markets. It dominates these markets. And so there is existing first mover advantage for certain other countries that you have as competition. So export competitiveness, building that up for us as a prior to export and FTA benefits is very important. The second aspect that you mentioned in terms of the capital account bit of the overall balance of payments, I'd like to touch upon that too, because an FTA is not just supposed to be, I say supposed to be, just export push through the preferential access, but also the linkages that it provides any country in terms of integrating with global value chains. EFTA has an investment promised from the other side, but the commitment is another aspect.
Okay.
And so are the UK and the, the coming in EU, European Union FTAs,
Okay.
With all these, what we need is an additional component which ensures investment is part of the trade deal or as a separately negotiated parallel agreement. And that will come in when we have our own template, that is the bilateral investment treaty model of 2015, worked upon, that was promised in the budget of 2025, but we've yet to see the outcome of that. So it's the trade investment linkage that must be promoted and that must be protected and be a part of the FTA trade deal to give us the real benefits in terms of enhancing our exports and attracting FDI.
Okay, fair enough. Let me get Professor Gupta in. Professor Gupta, as has already been said, I am prematurely looking at the goods data alone. We have to look at investments and services. So if you can enlighten me on either of them, have our FTAs already signed or to be signed concentrating enough on promise of FDI? I think with the Europeans, there is some $100 billion commitment. Can you enlighten us? If we are not able to narrow our current account deficit, will the FTAs at least bring in enough capital flows to bridge that deficit?
Yeah, thank you, Lata. Just 2 points. One, before coming to your question with respect to, because you started your show with linking FTA journey with the current account deficit.
That's right.
So it is very important to note that our renewed journey for FTA, it started in 2020. So at that time, we were not facing any pressure on the rupee. So it's more a part of that. Exports are part of our more growth strategy when we are talking about the 5 trillion economy. But essentially, what I'm trying to say is that it's not that because CAD is high, so we are focusing on FTA. We have started FTA journey much ahead. And coming specifically to your question on the services and investment, yes. On the services sector, there are significant commitments from our FTA partner countries. So from like European Union, we have around 144 subsectors that have been committed by European Union out of the around 160 subsectors in the services side. The same is true for UK also. So more than 135 subsectors they have committed. And one thing which is very important to note in the services, that there is a commitment, there is a liberalization or commitment on a foreign direct investment in the services sector, which is in the trade parlance called Mode 3 or commercial presence. So India has made commitments on Mode 3. That means India has committed to allow foreign direct investment from these countries. So there is an expectation that significant FDI in the services sector will flow.
Yeah.
Second, on the 100 billion in the EFTA agreement that you talk about, the Switzerland, Iceland, Norway, and Liechtenstein, there is a provision that these countries will make 100 billion investment in coming 5 years. And if there is a shortfall, then the balance that have been achieved in the FTA, that could be recalibrated.
Okay.
So it's a more like incentive or facilitative element that these countries, the private sector are more promoted to make investment in the country. So I would say that these FTAs are geared towards having a multi-pronged effect on the economy in terms of investment, in terms of increasing exports, in terms of increasing imports to ensure the raw materials for India. For example, in the Australia deal, we have good provisions for the raw materials like cotton, chemicals, and different kind of raw materials, so that supply chains are completed. Also, there is a mutual recognition agreement, like with the Australia. You mentioned some data on the Australia. So last year only we signed a mutual recognition agreement on the organic foods.
Okay.
And so India's testing is India's standard that would be accepted in India.
Fair enough.
Now, see, where is the market for organic food?
Yes.
The market is in the developed countries.
Yes.
Now, if these kind of things are happening in the FTA, they will give benefit in different to the country.
I take your point, sir. If it has only happened last year, then I'm counting my chickens too quickly. We will have to give it time. Professor Rupa Chadha, thank you for your patience. Can you tell us if the FTAs are geared towards having more GCCs and other kinds of services? Is there evidence already?
Okay, so thank you very much, first of all, for having me on this show. First of all, the whole perspective of looking at an FTA in terms of its benefits is not about reducing deficits. And as previous speakers have said, it is much wider than that. It is about promoting exports, but it's also about increasing inputs and having, supply chain diversification, getting access to critical inputs, reducing manufacturing costs. So there's a range of things that you actually want from the FTAs. They're geopolitical, of course, as well. And second thing is that having a deficit bilaterally is per se also not bad. It could be because you're actually getting access to better quality inputs, and that feeds into better quality exports. You could be increasing your bilateral deficit, but actually increasing your exports to third market. Now, here coming to the services question that you specifically asked, yes, of course, we've seen that our surplus is there in services. We are seen to be competitive in services. However, not a sufficiently broad range of services. So we tend to focus on IT-enabled and professional services. I would look at services much more broadly than, again, just professional services and IT services. And I would look at imports of services as well through Mode 3, which can enhance our overall economy-wide competitiveness. So what do I mean? I mean, for instance, logistics. That's a very important sector. Many of these sectors are actually open to FDI. Telecommunications. So what I'm getting at is that look at the service sector both as an enabler for exports in other areas, as well as our exports, which we already have, which we are doing very well at in areas like GCCs and IT services, professional services.
I have to run into a commercial break. Sorry for interrupting you. We're going to come back and take a more detailed look at all these verticals that you'll have spoken about. Mutual investments, getting into global value chains, more services, more investments, all those questions after the break. Welcome back to this very special Indianomics. I have 4 trade experts, Professor Arpita Mukherjee, Professor Amita Batra, Professor Pralok Gupta and Professor Rupa Chanda, who have invested a lot of their research efforts on FTAs, designed them for India. Some of them, they've been part of the negotiations. They're asking whether at what point in time the FTAs will ensure that we are able to either get enough capital flows to bridge our current account deficit or to narrow the current account deficit itself. Ladies and Professor Gupta, thank you for your patience. Arpita Mukherjee, to start again at what is our current problem. I agree with all of you that we did not design the FTAs at a time or with the intention of narrowing current account deficit, because at that time, that was not the problem. But right now, we have that problem. So by when do FTAs mature enough for us to be able to milk them to give us either exports or higher investments? Does it take 5 years, 10 years to really marinate?
Lata, that depends upon when did you sign the agreement, when the agreement got implemented. So if you sign the agreement, see, there is a gap between the signing and the implementation. If you look at UK, it is almost a year. EU, it will be almost a year. So there is a gap between the signing and the implementation. And then after the implementation, there are trade partners have 5 to 7 years. In some cases, earlier FTA, we had 10 years to actually see the entire benefit. So there is a time period that is there. During this time period, let us understand, if you go back to your question of export versus import, during this time period, you also have to see that these countries are doing trade agreements with many other countries. Yeah. Some of them who have signed agreements before us, like Amita pointed out, and their implementation has already happened, whereas we are in a phase of implementation. So if you are looking by country, you need to also, the other thing is that if I am catering to Australia, I need to actually think what Australians will consume and like. They have a limitation to how much they can consume Indian products. Like, if I am going to sell basmati rice to everybody, there will be a limit to which they will consume basmati rice. So am I able to move up the value chain from a raw material intermediate producer to a final product that is needed by those markets? So this is also very important, and that's what I think Rupa was trying to push, was that whether my domestic economy is gearing towards the need of the partner country and customizing the product that is needed there. Okay. The moment we customize the product that is needed there, you will see a growth in our export. It takes a time for the industry to rethink, understand a new market, look at it from a liberalization perspective, that I'm going to now get a easier access to this market and then move forward.
Fair enough. Ma'am, I'm sorry. I am out of time. This is a small show with too many good experts. We'll have to debate on a later day. But Amita Batra, when we did the ASEAN FTA, we got into trouble with a lot of Chinese goods coming, because the rules of origin were not very clear. Are we now ironing that out? Can we say that the new gen FTAs are better designed to ensure that our goods go to the destination countries more safely and we are not flooded with third-party products?
Thank you, Lata, for that very important question. I'll answer it in 2 ways, and be a little more specific. One, to also your earlier question, I really consider the UK and EU FTA, both of which to be yet implemented, to be more substantive, and I think to be more benefit yielding, because both these have in them elements that can bring us value chain integration and possibility of immediate benefits in terms of 100%, for example, in case of textiles and clothing being brought to, of our tariff lines in that sector being brought to zero on immediate effect. Okay. But as I said earlier, there is competition, and so we need preparation. This preparation is very important. We have time as far as the EU FTA is concerned, and we need to bring our exports up to that level which will be accepted in those markets. There is a lot of potential in these markets. There's a lot of consumption, but we have to remember that there is also a lot of emphasis on sustainability. related regulatory standards in both the UK as well as in European Union. So prior preparation is important, When you talk about rules of origin, I think it's very important, A, that we not be flooded, B, that we are able to send our exports to the right destination in the right manner. As far as flooding is concerned, I have to say what the UK, for example, has adopted recently in terms of reduction of its quotas. India has somehow taken that as an issue to delay the implementation of the India-UK FTA. Now, I wish we had not done that because the issue of there, as far as dealing with the reduction of quotas for steel imports is concerned, should have been taken separately at the WTO, which we are. But we should have gone ahead with the FTA implementation, which was to otherwise come in May, because it has benefits of value chain integration, particularly also in a sector that we are very good at, such as automobile components. Although that would have been phased out over 10 years, but it would have given us a very, very good...
Dr. Batra, I will have to give you more time because this is a large topic, especially our relation with Europe. Unfortunately, the clock is ticking. Just 1 minute each to the other two guests. I'm sorry. Pralok Gupta, what's your sense in terms of when we will start getting the full benefits of these 9 plus 11, 20 FTAs? Do you think India's trade gallops by the time we get to 2030?
I think earlier speaker also pointed out that we are talking about this number 9 and 11 FTA, but only 3 FTAs, UAE, Australia and EFTA. They are right now in the implementation stage. The others are either just signed, not yet implemented, or still negotiated.
Yes.
To say that when they will come into implementation. But I say that their effect come into play in the short period, in the 3 to 5 year, but there are also long-term benefit in terms of increased whenever professionals move to their countries, in terms of increased remittances flow, and also the innovative approaches that we now have in our FTA. For example, in the Australia FTA, we have post-study work visa.
Yes.
Our students going there, they will work and send the remittance here.
Yes, yes. Fair point. Got it, sir. Got it. I'm sorry, I'm out of time. Rupa Chanda, you can add one more sentence to this. Out of time.
Okay, so I will just say that for at least the UAE and the Australia FTAs, we are seeing some increase. Now, to what extent you can say that's due to the FTAs, that's always difficult. You have to look at utilization rates. But really, the benefits will come if you, in parallel, also have domestic reforms, scaling strategies, SME integration strategies. It would take at least around 3 to 5 years, as Pralok said, to see some benefits, but the longer term benefits of leveraging investment, technology transfer, digitalization, integrating services with manufacturing, these are really the things that will pay off in the long term. And there are many intangibles that will come in terms of quality, standards, skilling, capacity building, etc., which you cannot quantify with any bilateral trade
superb.
deficit.
That's an excellent last sentence to wrap up this discussion. We should not be counting them prematurely. It's just that there is this big problem of rupee and current account deficit sitting on our head, and we get these high, headlines of FTA. We try to link the two. We should know that this is a longer term effort. Thank you very much, ladies and Professor Gupta, for joining me. We will invite you for a more detailed discussion later on. That's it on Internomics. Thanks for watching.
Hello. How are you? You wear anything else now?
I don't. If you see me, 99% of time I'm always wearing something comfortable, and hence Bliss Club.
What's been the craziest thing in the last 6 years?
Craziest thing? Oh, so many. The fact that everyone says this one word, which is comfort, it's actually changed everything about how we think about, a large bit of what we do.
Okay, so this is a get ready with me, courtesy Minu Margaret of Bliss Club, and she's ironing what I'm supposed to wear. So we're getting all set. Thank you very much. Thank you. Yes, this is the Bliss Club transformation.
I wouldn't have started Bliss Club. That's the honest truth. Everything that had to go wrong with a business went wrong with a business. We're called Bliss Club because the mission is to spread happiness through movement. We've only seen an ecosystem of low quality synthetic fabrics. So growing up, my mom would say, "Ye polyester hai." Matlab, this is low quality. If we're building it, we have to build it from scratch. And so that's what we did. And I think that's been the toughest part of our journey over the last 6 years. Our first product was called the Ultimate Leggings. This is your one legging that you need in your wardrobe and you don't need anything else. When you say that, hey, hip to waist ratios of women are different, we don't get the right length of our products or pockets, like I don't think they would ever relate to this, right? And like basic things, it feels too basic, but for a lot of women, it's life-changing. If the product is not the center of everything, then your marketing is just packaging something which is not great.
You have your startup, Vidit has Misho. By the way, how did the two of you get together? How did you meet?
We literally met at a New Year's party. 3 days later, we went out on our first date. And 3 years later, we got married.
Menswear, that is the latest category.
Vidit and I have had some very, very fun conversations on the table on, me trying to understand male anatomy
Does
levels,
the focus
right?
group win the dining table?
Oh, much bigger than that. But
the market research has all happened at home.
Some questions I can ask only to Vidit.
For somebody who's looking at building a D2C business in India,
you cannot build 100 ultimate products at once, right? You do one thing, you do it really well. If we contributed to India's happiness index by just even 1%, that would be awesome.
You can eat 5 samosas and still be able to get into very stretchable pants. That should make a lot of people happy.
Or that.
From the gym to the boardroom, performance wear is no longer about workouts alone. It's becoming everyday uniform, and one homegrown brand is sprinting to capture that shift. Hello and welcome to Young Turks Reloaded. I'm Shireen Bhan. Founded in 2020, Bliss Club is a community-first apparel brand that's reimagining activewear for the Indian consumer. The company today has scaled to an ARR of 300 crore rupees, serving over 1 million customers with 16 brand-owned stores and a strong D2C engine that contributes nearly 70% of its business. At a time when most apparel brands rely heavily on marketplaces, Bliss Club is betting on control, from proprietary fabrics engineered for over 12 months to a tightly managed supply chain and a capital-efficient, near-zero working capital model. The result? Differentiated products built specifically for Indian bodies and a brand that's growing fast with nearly 90% year-on-year growth. But the real play is larger. As performance wear blurs into workwear, travel wear and daily essentials, Bliss Club is widening its playbook, moving beyond women's activewear and stepping into menswear, tapping into the global shift towards all-day high-performance dressing. Joining me now is Minu Margaret, the founder and CEO of Bliss Club. Minu, it's great to have you join us here on Young Turks. 6 years on, and who would have thought that a company that was founded in the middle of the pandemic, has today been able to get an ARR of 300 crore?
Yeah, no, thank you for having me, firstly. And it's been a really exciting journey from where we started, which is literally our 2-bedroom apartment in Kormangla and one of the bedrooms there.
Many stories in Bangalore have started like that. Many of India's startup unicorns have started like that.
Kormangla is the place, But yeah, from the bedroom to the offices now to, having offline stores, it's been incredible. It's been super fun and very exciting as well.
Let's wash some dirty lid in public now.
Okay.
What was the reaction when you said, okay, I'm giving up on the PhonePe job and I want to try my hand at entrepreneurship once again?
To be honest, friends, mostly everyone was starting up. So it just felt like, yeah, of course you're going to try as well. But I think with family, everyone is super excited. I mean, to be honest, like that's what Bangalore does to you. Like if you're not starting up, then what are you doing, right? It's almost like that. But everyone's been more than excited and helpful. And I think that's the ecosystem, right? Because I was just telling someone I met just earlier today that in Bangalore, it's just this like bunch of people who are excited to build something, and everyone's so helpful. Everyone, like even when I started Bliss Club, I reached out to at least 100 people. 60 of them probably had a conversation with me, told me about what it takes to build an apparel. I don't come from an apparel background myself. So yeah, I think it was great. And I think Bangalore is very accepting of people starting up. And yeah, I think family was more than excited for me. Yeah.
So, getting to the idea of wanting to get into activewear.
Yeah.
Now, COVID happened. So it was a breakout moment globally for this industry.
Yeah.
But how did you come upon wanting to do that and doing it in an Indian way for Indian bodies, for Indian shape?
I was exploring a couple of other ideas. One of it was in EdTech, but it didn't go too far. I couldn't build conviction around it. The third problem statement I looked at was actually this, which is that, hey, there is traditional sportswear, which is meant for the gym, but there's this entire part of my wardrobe where I just need great basics, but which are really functional. But I'm wearing it to work, I'm wearing it to, travel, casual occasions. But in India, you only have sportswear. So why is this entire category of just, great basics, which are super functional, why does it not exist in India? So I was looking at this. This is my last idea. November 2019 is when I was looking at the idea. December, I was speaking to someone in China, exploring the whole, the fabrics and, how do I go about doing it again, because I don't come from an apparel background. And at that time, she was like, hey, you know what, there's something going on here. There's this, people are falling sick. And I'm like, okay. And then 3 months later, COVID hit. Just the timing really worked out in some way, right? Because at that time, and we're called Bliss Club, because the mission is to spread happiness through movement. So we started as an Instagram page. We were doing a lot of Zoom sessions, WhatsApp sessions of, Zumba, Bachata. A lot of people don't talk about this, but I think it is also an inflection point of people over-indexing comfort in their apparel, where when we stayed at home for 2 years and we realized what it feels like to be in pajamas for 24 hours in a day, you didn't go back wearing, uncomfortable clothes which are so tight on your body, or, it makes you think about your waist the whole day. And I feel like that's the inflection point that the world and India specifically was waiting for, that comfort matters so much more, and hence you are going to index on this comfort for your daily life and whatever you wear. And
you have no experience in apparel, as you pointed out, no experience in building a supply chain. The decision to actually engineer the fabric, to invest in that, where did that come from?
The first time I went to a factory is after I decided to start an apparel. And that's the first time I realized that human beings stitch clothes and not machines. I did not know that every single chaddi in the world, every seam of that chaddi is stitched by a human being somewhere. I somehow thought that there are conveyor belts and things just get stitched in a conveyor belt. If I knew what it took to build this ecosystem around functional fabrics, technical fabrics and technical fits, I wouldn't have started Bliss Club. That's the honest truth, because I think what I realized after I started was that most larger brands in India, most incumbents in our category are all global brands. And most of these brands don't have design or product development teams in India. So they're either based in Germany or the US or Japan. And so India doesn't have talent that knows about technical fabrics, that knows about technical fits, because a lot of our products are very close to body. It has to fit a certain way. Our fabrics are engineered for different degrees of friction, movement. And so I then realized that, this talent is non-existent in India. If we're building it, we have to build it from scratch. And so that's what we did. And I think that's been the toughest part of our journey over the last 6 years. I think we spent the last 3 years, honestly, just building out our supply chain and our sourcing and product development team.
So where does all the sourcing happen from?
So 80% of the sourcing happens outside of India. And that's actually the case for most, technical fabrics. because India is great with apparel production in cotton. India has been a cotton producer, a cotton manufacturer, and hence a cotton producer, consumer, right? But cotton is not the best performance fabrics because cotton does not have intrinsic, stability. It is a natural fiber. It does deteriorate. It fades after some wash. It doesn't take a large amount of stretch. So mostly synthetics and high quality synthetics is where the whole performance fabrics really stays. And India's never had that ecosystem. And so most of production happens outside of India. Most of these are large export manufacturers across, Indonesia, Sri Lanka, Bangladesh. And so that's broadly our sourcing base. And I think that's one thing I've realized, right? Like India, so growing up, my mom would say, ye polyester hai. Matlab, this is low quality, right? And I think India's always seen that we've only seen an ecosystem of low quality synthetic fabrics because we've just been a very rich cotton, manufacturer and consumer. But there's a whole world of very, very high quality synthetic fabrics, which are great on performance, great on durability, great on your skin, are not bad for your skin. And I think India's never seen that. And I think that's the single line opportunity I feel exists in India, that there is a whole world of high quality synthetics and performance fabrics we can bring to this country in terms of quality that this country hasn't seen. And that's what excites us. Like what you're wearing.
Yes.
This
Which
is not
this club.
This is not what typical polyester feels like, because
it doesn't.
We grew up feeling like polyester should feel plasticky, they feel rough, they itch on the skin. We have all of these, and including me, like before I started, I had all of these things that came with it. And now I'm wearing the most high stretch pants, which are super comfortable. I can go to the gym with it. I can go to work with it. This remains exactly the same after 100 washes. This does not, you can't do this with natural fibers.
So many people talk about textile as being the big multiplier in terms of jobs. It is a labor-intensive sector, and how India has lost progressively space to countries like Bangladesh, Vietnam, so on and so forth in the textile and apparel space. What do you believe we need to do to prioritize focus on this sector and ensure that we move the supply chain to India?
I think two parts to it. One is cotton, the other one is non-cotton. And I think with cotton, India is probably among the top 3-4 countries in the world in terms of producers, manufacturers, all of this, right? And exporters. I think one is synthetics is a place where we haven't really evolved to. And synthetics requires also very high capex investments when it comes to factories and manufacturing, because these are naturally, man-made fibers and man-made fabrics. And I think with India and how manufacturing has evolved, I think there are very few high capex, large factories and manufacturers when it comes to, yarn stage and, fiber stages. And I think given how with our joint families and how manufacturing and like family businesses have evolved, it keeps breaking down into smaller manufacturing units, and hence synthetics has not seen that evolution in India. So I do feel like from that lens, there are maybe a handful, maybe in fact just a couple of maybe $1 billion plus revenue manufacturers when it comes to apparel in India. And I feel like there's so much opportunity in terms of just investment into this sector. And I think that scale of investment is required for synthetics to grow.
You know, from idea to getting your first check, getting the first investor on board, what was that meeting like?
So like I said, we started as a community. First 9 months was just the community, and then we launched our first product. So
you launched with one SKU.
Yes.
So that was it.
Yes. That was actually, again, very, very counter anyone's opinion from apparel.
I would imagine, because people would have told you, like, what are you thinking? How can you just launch with one product?
Correct. One SKU, not even a product.
Yeah. What gave you the conviction?
So literally everyone is like, in apparel, people want choice, and you have to launch you have to give them a selection. You have to give them a bouquet of products and let people choose. In my head, I was like, the problem, like our category is a very problem solution category, right? So if there is a problem, we build a solution to it. So you don't really need a bouquet of solutions. You need a single, well thought out, well executed solution. The idea was that if we build this one product and it's truly ultimate, then why does she need anything else? And hence our first product was called the Ultimate Leggings. And it was that this is your one thing this is your one legging that you need in your wardrobe, and you don't need anything else. And so we solve for everything from fabric. How can you build a high stretch synthetic fabric that feels like cotton? How do you give it as much functionality as it possibly requires? So it had 4 pockets, it had the right Indian, I'm 5'2" in height, and so it had the right length. So built for our heights, for our bodies, our shapes, our waist to hip ratio. And so the idea was that if we can solve all of this really well, why not launch with just this one product? So I think it was more of conviction on this is how our category should be built out. This is how we start off. And so the idea was that if this one thing does not solve a problem, then nothing else will. So it was just a little bit of let's go all in and figure out. And I think a large bit of our journey of building and my personal journey of building an apparel has also been slightly contrarian. And so it just felt like this is the right thing to do. Let's do it. And it doesn't matter what.
Do you think, you said that you had support from family and friends when you decided to start up.
Yeah.
But what about investors? And we hear this from a lot of women, that it's harder as women founders to raise capital.
It is harder. And I must say that. And I don't think I would shy away from saying that in any way. And I think it's harder because specifically for my category, we started off as a women-only category. In the recent past, we have now men's launched.
Yes, expanded into men's wear
and now it's easier already, Sharon. Now I'm like, hey, why don't you just try my product? But I think the honest truth is a large bit of the investor VC ecosystem is skewed towards men. When you say that, hey, hip to waist ratios of women are different, we don't get the right, length of our products or pockets, like I don't think they would ever relate to this, right? And like basic things, it feels too basic, but for a lot of women, it's life-changing. I think for me, so I have a woman partner and a male partner, and both Mukul and Shweta are very, very high empathy people, and I think have, so Mukul from Aviation was part of my seed round. I remember the conversation with him, which was, hey, Mukul, can you review my pitch deck? He was looking at the deck and he's like, oh, but these numbers are great. You're already doing this much with just this one product and you're like growing so fast. Like, let's explore this. And I'm like, so that round was mainly supposed to be an angel round, and it ended up being a institutional round. But yeah, I think that time the numbers were just speaking for itself. We were growing every week with just this one SKU, and so that was really exciting. And they happened to speak to a lot of customers and kind of build conviction. But yeah, I think for a lot of women first businesses, it is a problem, and I think it is like I'm hopefully like now seeing some bit of a change, like green shoots of change. But I still feel like it's we have a long way to go on that.
We do have a long way to go. What were some of the most the questions that you think that you were asked that you believe Vidit or any other male founder was not asked?
In the recent past, I've been asked, and especially after I've had a kid now, on if you decide to have another kid, and I'm a single founder. So if you decide to have another baby, how would you manage the business? I'm 100% sure no male founder has ever been asked, if you have another kid, how would you manage your business?
Yeah, Vidit was never asked this question,
never
right?
Asked, of course not. And we both had the kid at the same time. Why are you questioning me just because of my gender? But yeah, that's unfortunately where India is right now, and we have a long
But
way
it's
to
not
go.
just India. It is a global issue.
Yeah,
it is a global issue as well. But and this is what I want to talk to you about, because you have your startup. Vidit has Misho. By the way, how did the two of you get together? How did you meet?
We met 13 years back. We met at a New Year's party. It's actually a very serendipitous story. Yeah, this was, I think both of us were preparing for GMAT around the time we met. So this was right before Misho, 6 months before he started up. But yeah, we literally met at a New Year's party. And 3 days later, we went out on our first date. And 3 years later, we got married.
The conversation that you and Vidit had, when you decided to have a child, both of you are founders running your own individual businesses. How is this all going to work? Who was going to travel? Who was going to stay at home? I mean, did you have a conversation about this, about sharing the load, sharing responsibilities?
We have an Excel sheet for everything. So we had an Excel sheet for this as well. So a lot of things we learned along the way. But I think for the first 6 months, I had to go back and went back to work 3 weeks after I delivered, right? And so we had to figure out, I was breastfeeding, how does this happen? So with it, my mom and my mother-in-law would do night duty. So I never slept with the kid. He's been fully involved with bringing up Ira from day one, including sharing the load on the breastfeeding, which actually is a very, very intense journey, which a lot of people don't talk about because the kids literally depend on you to stay alive. But I could sleep through the night, get up in the morning, go to work. And then, we manage things that way. Even now, Vidit does the groceries at home. He manages the kitchen. I do the rest of the half. So we have a very, very, equal share in terms of how we manage our household.
Menswear, that is the latest category that you've decided to try and disrupt. Take me through what the ambition is. What is the aspiration from here on?
We started with women. We started with women activewear because that was just the larger white space. Like absolutely no one was building for women. Definitely not in the functional apparel space, and felt like this is where we wanted to start from. We wanted to do a few things and be significant for few people before we decide to do everything for everyone. And so I think 6 years in, we've been very excited about building for men. I think men shop a lot more closely to our category as well, right? Functional, comfortable clothes. If they like something, one in every color. We've been cooking menswear for the last 3 years at Bliss Club, to be honest. So the idea maybe 3 years ago, actually fabric 2 years ago, and then product for the last 12 months. But we've been like super, super excited about building for them. Last 6 years has been learning curves and different levels,
the focus
right?
group win the dining table.
Oh, much bigger than that. But
the market research has all happened at home.
Some questions I can ask only to Vidit. But no, I think we're spoken to like 50, 60, maybe 100 men over the last 18 months. We wanted to launch for men exactly how we launched for women as well. So very few products. We launched with a single pair of pants, a jacket, a polo, and a crew neck. So 4 products. And the idea was that let's do these 4 things, but do it really well and solve for specific problem statements that they have. A large bit around fit, which, to be honest, before I started building for men, I didn't think fit as a thing was a big issue for men. I thought most men were pretty okay with fit, and I thought women had bigger problems because of curvy bodies and different shapes. But men have just as much issues as women have in terms of fit of products as well. And then of course fabric is a large bit of it. So even when we've launched for the men's polo, for example, it's a high durable, you can use it for 100 200 washes, but it feels exactly like cotton, though it's not. And it just kind of becomes your go-to polo. And for a lot of people who've spoken about that, they absolutely love it. So very, very excited. Building for men's is a whole new learning curve for me and for the company. So we're kind of building it in our own way and building it the way men we should for men. And I think offline, has been exciting for us, and we've gone through our own journey with offline. I think we're at this point where, and we started offline because if you feel the fabric, you know why our fabrics are differentiated. It's tough to communicate that online. You know, online, everyone makes tall order claims. Like there's nothing that differentiates us from any other brand if everyone's claiming the same thing. But the moment you feel the fabric and you fit the product, then there is no asking why is Bliss Club different from any other brand in the market. And we found that, you know, extremely strong product market fit offline. So our offline stores do incredibly well. They're growing, you know.
How many do you have today and how many do you intend to set up?
We have around 22 stores closed, so 16 live and 5 in the pipeline. But the idea is to get to our next, you know, from 20 to 100 stores in the next 2 to 3 years. So that's what we're working backwards from. That's also why I'm in Delhi, actually, looking at you know, stores. Yeah. So I have a whole hectic day today with a lot of store visits. But I think stores are, you know, an exciting journey for us. And it's that inflection point where we're looking at larger stores and doubling down on offline.
You know, a lot of the Bliss Club story has been about storytelling as well. So let me end by asking you, if you were to tell the Bliss Club story today to somebody who's not really familiar with the product, what would you say?
If you look at India and India's happiness index, we are ranked, I think, in the last 10 among all the countries in the world. And, you know, it always felt like, you know, where we seemingly seem like such a happy country. We have all of this culture, all of these festivals, but why we ranked so low? Why are Indians so unhappy? And it just felt like, you know, 20 years later, if because of Bliss Club, people started moving, and if we contributed to India's happiness index by just even 1%, 1 point up, that would be so awesome.
You can eat 5 samosas and still be able to get into very stretchable pants. That should make a lot of people happy.
Or that. And if we can kind of be part of that journey and help India move in that direction, then that'd be super, super awesome. So that's the story I want to look back and tell myself, that, hey, we were part of that journey and we contributed this teeny weeny percentage to make this country more happy. That would be like pretty awesome. Yeah.
Well, we wish you all the happiness and we hope that you continue to clock all the milestones that you have set out for yourself, as well as for Bliss Club. Meenu, it's been an absolute pleasure. Thanks so much for joining us here on Young Turks Reloaded. We look forward to hearing much more from you in the future.
No, thanks for having me, Shireen. Super awesome.
Movement is medicine, and you heard it from Meenu Margaret herself. We are going to take a break here on Young Turks Reloaded. As always, send us your feedback. We always like to hear from you. Till next week, from the entire team and more startup stories. Goodbye, and thanks very much for watching.
Hello and welcome to CEO Centimeter. I am Ashmit Kumar. Now today, we take a pulse check on India Inc., which continues to remain resilient even as the ripple effects of the West Asia conflict cloud the global economy. Now, the RBI's latest annual report offers a mix of confidence and caution as it states that the Indian economy is expected to remain resilient with inflation in 2026-27 likely to stay aligned with the target. However, the report also flagged concerns similar to those raised by India's chief economic advisor, V. Anantha Nageswaran, warning that a prolonged conflict poses downside risks to the Indian economy. Now, the report further highlighted that geopolitical risks have re-emerged as a dominant drag on global growth in 2026. But how is India Inc. viewing these risks? Well, we speak with CII President Mr. R. Mukundan, CII Director General Chandrajit Banerjee, and BP India Chairman and co-chair of the CII Hydrocarbons Committee, Mr. Karthikeya Dubey, to understand the corporate India sentiment, to understand the corporate pulse. To all of our panelists, thank you so much for joining us. Mr. Banerjee, let me come to you first. And this, of course, is a broad question. I want to begin with this. If the conflict were to end today, of course, neither of us have any clarity when that will happen. We're hearing, of course, reports coming in from Washington that some interim framework may be around the corner. But given that we don't know what the situation looks like, assuming the conflict ends today, business as usual, how many months out is that?
So, I think, number one, we should be prepared for navigating through this with or without the conflict for quite a few months to come. I mean, we have heard many types of months. I mean, September, October, November is what one sees in terms of the time frame through which one will have to navigate through these global uncertainties. But yes, as you mentioned, that there is strong resilience in the Indian economy. But what we really require and need to do is to how do we focus on messaging? How do we take advantage through many steps that one can take in terms of our reforms, so to say, if I can say that. I mean, when the heat is strong, it's good to take advantage and do certain actions which will enable us. But I would really be looking at three quick things. One is, of course, inflation, and there would be a lot that would need to be managed. And as so far we we would see some short-term challenges. Second, of course, consumption, and that can get affected, and there will be some challenges which will come to that. But third, I think there is a responsibility of both industry, pretty much importantly on this, is to see how we are able to focus on discipline when we pass through such troubled times across the globe.
All right, Mr. Banerjee, it's interesting. In fact, just days back when we had the CII annual business summit take place, only a few hours before that, we also heard from the Prime Minister issuing a similar appeal on need for a nation as a whole approach for addressing the situation. But before we come to that and some of the issues that Mr. Banerjee has raised, Mr. Mukundan, let me come to you. The same question that I posed to Mr. Banerjee, is this no longer just a temporary disruption? Is there a longer-term contingency planning that is now required on part of India Inc. to meet this challenge?
Certainly, I think every incident like this leads to how do you build even further resilience. And I think Indian industry is very much focused on it. But as Chandrajit explained already, that we need to work together with all the stakeholders to make sure that we navigate the short term and prepare for the medium term and become very robust in the long term. When I mean short term, it is about 3 to 6 months. When I say medium term, is about 12 months to 18 months, and then the time beyond. What is in our favor, I think many people need to look at, is our proximity to Middle East. Because of being so close to Middle East, we will be the first and the fastest to recover from this as the situation normalizes. And obviously, we built over a period of time very strong linkages and relationship there. I think that's going to come to our benefit. But I think in the meantime, I think we all have to work together to make sure that we manage the demand side as well as the supply side, which government is doing, frankly, as whatever it needs to do. And we all now need to sort of look at what is the long term. The long-term solution, of course, is rapid electrification, rapid change in our energy mix. I think government has done a lot of stuff, including, the whole piece around nuclear energy. All these pieces are all going to come together. And industry is absolutely getting prepared for it. And what I must also commend is in the short term, government has ensured that the impact on common man is sharply reduced and kept in check, even though we hear stories. But in reality, if you look at compared to other countries, we have been less impacted, and that should come in very good stead. But if this conflict is to go, let's say, beyond 3 months into 6 months, which is unlikely because the news we are getting is it's very close to getting resolved, then I think we all need to look at what further measures we need to do.
Well, the world will be holding bated breath as to the announcements coming out of Washington with respect to status quo. But speaking of India not bearing the brunt as much as some of the other countries, Mr. Toubro, let me come to you. We've seen a few rounds of price hikes when it comes to petrol and diesel. You're from the oil and gas space. Tell us what has been the impact in terms of perhaps reducing the burden of losses that were piling up.
The losses that the oil marketing companies and the government companies have been taking has been in support of the common man and the citizen, and they've been covered in the media as well as the government briefings. These are listed companies, and it would not be appropriate to go beyond that. But definitely, the price increases will help with the losses. And the government has also stepped up to contribute in its own way by reducing the excise duty by 10 rupees, which is a massive contribution. I last checked maybe half an hour back, crude price is at 92. So this is starting to look more reasonable. And, the tough times are there, but they don't last forever. So I think, the momentum is going towards the right direction now.
Just laboring on that same point, Mr. Toubro, that we've seen again a few rounds of hikes, but we continue to hear the messaging with respect to under-recoveries and losses. Tell us how much bandwidth, how much appetite is there available with the government, with these OMCs to continue supporting it, and is that what's needed at this stage?
Well, I think, this is a complex question, and really you have to balance the needs of all the stakeholders. The first and foremost is the citizen and the common man. And then there is industry, and then there are the oil marketing companies. I think there are times when we have to step in to support the citizens, and which is what the ministry is doing at this point. And, the changes with excise duty, the SAED duty that have come in, they do provide some flexibility here to do more. At the same time, in various states, they've also stepped in with the permit system to try and moderate some of the shift of demand that is happening, which is also helping in the way this needs to be done. So I think, we are going along as we are. And as I mentioned, we are quite close to hopefully some positive news, which should help curtail this situation.
Sure. Mr. Banerjee, I want to come back to you. In your opening remark, you talked about the impact. One of the aspects that you pointed out was inflation. I just want to get a sense, the situation that we are in, are we looking at a triple strike of inflation when it comes to food, fertilizer, fuel? How severe is the impact that you're estimating going forward?
So, when you look at inflation as a piece, of course, the immediate inflation risk is from what's going on in the energy side. And that's, we are seeing some effect of it. But the concern is not just only fuel prices. All of that leads to higher freight costs, say, for instance, or even affect our food group one. Very, very importantly, the industrial raw materials of packaging, so on. I underline the MSME operation side of it very strongly. Also, we would need to have these increases, but a sustained increase in the crude oil prices, but that would have a measurable inflationary impact. I would think every $10, say, for instance, barrel, can add easily about 30 basis points. So that's apart from pressurizing the current account service. So I would imagine that the first priority of ours should be to prevent an energy shock from becoming a broader domestic price spike. And that requires a type of action that we are seeing, coordination action across the, as you mentioned, fertilizer, transport and logistics. So we have to have calibrated response, and our country does not at this point in time at all need any panic response or open-ended sort of a subsidy situation. What is required, I would imagine, is some of the time-bound measures to protect some of the vulnerable sections, the households, the MSME, essential supply chains, so to say. And food inflations, we need to keep that watch, and it is, as you heard. But some of the timely usage of buffer stocks, given the type of what we hear about El Nino, etc., calibrated imports of pulses and edible oils, and somewhere I would think very strongly on anti-hoarding of any kind and smooth movement of food and fertilizer. All of this can help deal with any inflationary pressure that can come in. And I end with, of course, clear communication. It's extremely important. If people believe supplies are uncertain, panic buying and speculative stocking, that itself can create price pressure. So the larger lesson is that inflation management at this point in time is not just a monetary issue or anything like that. It's all about energy security, logistics efficiency, agriculture resilience, supply chain resilience, supply chain coordination, and so on.
Right. I actually wanted to continue with that line of thought on inflation, but you've brought up an interesting point with respect to panic buying. Before I come to you, Mr. Mukundan, on inflation, let me come to you, Mr. Dubey. On that one specific issue, panic buying, we're seeing images that come up on our feeds of long queues outside some vending stations, some retail stations. Are you witnessing that? Are you seeing that? Is there a case here where you are seeing increased instances of panic buying, of hoarding? Is that taking place?
I think we live in an age of social media and instant communication. And so what you'll see are very sporadic, limited incidents of this happening. And there is ongoing monitoring by the ministry, literally on an hourly basis. So what happens is that if that happens in a certain pocket, you will immediately see a response and stocking to support that situation. And typically, you will not see the same images on the next day at that location. So there will be these one-offs, but the supply chain and the availability of product, the entire industry led by the public sector is working at its best, and the ministry is enabling and supporting this. So I am not particularly disturbed by that.
Is there a case, Mr. Dubey, where perhaps bulk buyers are moving towards retail stations and that perhaps is leading to such images, such situations?
Again, that is the case, but that's again very sporadic, and there is a difference in the pricing, as you know. Now, there are two channels. There is the retail channel, and then there's the direct channel, which is typically used by the industry. And there are times when, because of that difference, you will have some demand moving to the retail side as well. But again, I think, as Mr. Mukundan pointed out, we need to look at a little bit of responsibility over there. The other thing is that when things are normal, the direct channel actually offers some discounts to the industrial customers. So again, this is a tough time, but I think it's a bit more temporary. The second thing is, as I mentioned, the state governments have provided a permitting system, and more will do it, and they're also monitoring this. So again, these are one-offs, it's sporadic.
Right. Right, so tough times again that we are looking at. Mr. Mukundan, speaking of tough times, I just want to borrow from what Mr. Banerjee had been talking about. He talked about how, of course, in the near term, there will be inflationary pressures. We've heard of the El Nino. We've heard of lower than expected monsoons this year. Will that add to the pressure, add to the negative spiral, Mr. Mukundan?
So firstly, I think, let me just go back to what we heard from Karthika in terms of the sudden, sporadic, localized panic buying. I think some of the states have done a very good job. I can only tell you from the state, we have an operation in Gujarat. The government has actually taken the past buying average and has allocated very clearly the quantities, and most of us haven't faced any issues at all because it's based on the past buying pattern. So I think they've done an excellent job in terms of that. In terms of fertilizer, certainly I think the government fertilizer subsidy bill is going to go up. As you know, in India, fertilizer is at a fixed price. That is not a big issue at the time of the farm consumption. But certainly, government is going to have let's say, higher bill to foot in terms of the subsidy bill. In terms of the El Nino itself, it's going to come out and play. We'll have to wait for that to see. But good news is our reservoir levels are fine. I think we've got to say that we've got to get through the Kharif well. The issue will be for Rabi. I think we've got time to sort of prepare for Rabi. Kharif, I think more or less in terms of the reservoir levels and the areas. So there could be some areas where there will be some sporadic issue if El Nino does play out very, very strongly. What we are hearing is it's not going to be that strong. It's going to be a bit minor. So let's watch as it plays out. We have a playbook for this as a country, and we'll put out that playbook, I'm sure, district by district in a very micro way. We've been in this business. We know how to sort of manage this. In terms of food inflation itself, I think government is sitting on the good amount of food stock, and I think pulses is another area which Chandrajit spoke about. I think we've actually partnered with many countries to make sure those supply chains are smoothened out. So it is going to be something which India has to work as one team and deliver on that theme to how do we reduce the impact on common man, and at the same time make sure that we can move forward on our agenda to grow this country, get back to the same growth rate which we have.
Right. On that note, I'd request all of our panelists to do stay on with us. We're heading into a very short break, but we'll be back on the other side. We'll continue this conversation after this short break.
With.
And to
Welcome back, and still with us are Mr. R. Mukundan, Chandrajit Banerjee, as well as Mr. Kartikeya Dubey. Mr. Banerjee, let me come to you on a couple of operational issues that we've been hearing about for the last few weeks now. Labor availability, let me get your thoughts on that. From your conversations with the companies, are you hearing anything about labor availability? We saw reports of laborers, of workers moving back towards the villages, citing gas prices. Is that changed? Are there any concerns, challenges that have been flagged by the companies?
There are sporadic thoughts, or rather comments which come from here and there. Yes, of course, one hears them, but if you really see the practical results on the ground, and what do we see? It's really that there are many measures that the companies are already taking, and they would do it even faster, I would imagine. That is, how do we create better logistics, or rather support in terms of transports, mobility of workers? Some of the workers may return temporarily, of course, to their home region, especially if rural employment or farm activity picks up during the monsoon season. But then that should not be, that's something that we have seen in the past, but that should not be seen as a nationwide labor shortage or anything of that kind. But it's more likely to appear as localized somewhere labor stress. That's what my understanding, or what our feedback is. Our industry is also, as I mentioned, responding. Transport support is there. Canteen support is very important. That's been started off pretty well. Accommodation facilitation, that's something which is many of our companies are doing pretty well, and we keep hearing that too about it. But what's important is to see that we maintain a decorum and sort of a structure of timely wage payment and a strong, worker communication. And I also see government support that's doing really well. We've seen very strong network of public transport connectivity to the industrial areas, even affordable rental housing, something which has been happening. So I don't see this to be, any sort of section try to blow it out of proportion. We should handle it through better communication and more sharing of some of the best practices, both by industry and many interventions that have taken place.
So labor availability, not a challenge, Mr. Mukundan. What about then consumption? We spoke of inflationary pressures. Is there an anticipation? Is there a matrix where perhaps some of that translates into tightening of the purse strings, discretionary spends being deferred?
So I think we have to say that it's if you look at the basket of spend, I think certainly we will see squeeze on some of the, let's say, discretionary items, not for daily use. But I think those items which are for daily use, we would continue to see same demand growth, which is why you can see already that the FMCG sector is probably going to end up doing better. The ones which are into spend, which is including travel, tourism, may come under a bit of pressure because of the availability as well as the increase, let's say, in terms of the flights and other elements which come along with this. Hopefully, the situation should normalize fast because already we are seeing the back end of the crude oil pricing now dropping, and hopefully we'll be able to get through this quickly. In terms of labor availability, I think it's a multiple factor, Chandrajit has said. It includes the recent elections, people had gone and then they've come back. These are very temporary, very sporadic events. We haven't seen any major disturbance at all on that front. And industry is managing this well within the norms which we already know. So this is not the COVID redux today. So it is very sporadic. And we've been through this sort of situation in terms of inflation in the past. And we will get through this partly by industry trying to keep its prices under check at the same time. And this is where responsible behavior from the industry is very important. And we all must come together as one stakeholder to make sure that we can support as much as government is supporting in making sure the impact on the common man is minimized to the bare minimum.
Sure. I'll just come to our speakers for a final comment. Mr. Toubro, coming to you, at least on the oil side, what would your policy recommendation be in terms of how to address the situation?
So I think, first of all, we've been in a very busy period starting April because you have industrial demand and agri demand with the harvest season that comes at the same time. And the monsoons are maybe 3 weeks away. So I think that should result in some structural easing on the demand side as well. And the government has reacted within this crisis very quickly. They've worked on the excise duty side. They worked on the LPG to PNG conversion side. And then the larger strategic reform, agenda is now well underway, whether it's to do with storage, to do with EV, to do with CBG. And some landmark moves on upstream, including the amendment to the ORDA Act. So the next round of bids come up pretty soon in OLB10 as well. So I think all the big changes that needed to happen for medium to long-term resilience have actually accelerated during this period. So I think we have a lot of optimism that we have a good upside coming out of this, and then moving forward at pace to take care of the issues.
Mr. Banerjee, your word of advice, your recommendations to the government. We've seen support mechanisms like the ECLGS, but you've talked about targeted specific programs for the MSMEs?
Yeah, so MSME, I would think that MSME, small retailers, they are the first, obviously, to feel consumption slow down, the pinch of the consumption. Therefore, we must very strongly ensure that we are able to address that very strongly. The aim should be really to protect the strength through paying them on time, getting the payments done both by the large companies as well as even any payments coming in from the government. And so I think that is going to be one of the most important areas as far as the MSME is concerned, and when they get hit with consumption. But I also mentioned that the larger point, which yes, domestic demand, that continues to be our strength, and that's a major strength of ours. And the aim should be, how do we protect this strength through strong inflation control, as we have seen in the recent past, some rural support, MSME liquidity, and of course a strong confidence building to them. And many of it is based on, as I mentioned in the beginning, that let's look at some reforms that can be done in this moment of time. And we are in a moment of time where we should see much that the government could do. As you asked me to talk about it, we should see disinvestment going through. We should see many such measures, or rather reforms which we had not taken in the last some time, and it's now time for us to roll them out.
So looking at this crisis as an opportunity there, Mr. Banerjee, I'd like to thank all of our panelists for joining us. Mr. Banerjee, Mr. Mukundan, Mr. Dubey, for throwing light on the pulse of India Inc. in dealing with this challenge. But with that, it's a wrap on this special broadcast on West Asia tensions and its ripple effects on India Inc. More news and updates will continue right here.
now.
Good morning. We are here at the GMR Hyderabad Airport. We are joined by Mr. Saurabh Chawla, the Group Executive Director of the GMR Group. And this is just a day after the company reported its FY26 results, where the company turned profitable after a decade. And this was despite the fact that it was a very turbulent year as far as Indian aviation was concerned. It's a pleasure to be here, sir. Thank you so much for having us.
Thank you.
A lot of questions that we have for you, and a lot depends on FY27, especially given the base that you've now set and expectations are now high.
No, absolutely. It's wonderful to again chat with you. We are at an inflection point, despite a lot of geopolitical challenges that we have seen in the last 12 months.
We'll quickly touch upon that, sir. The first one, of course, you started off the year, you saw Operation Sindoor take place. In the middle of the year, you did see quite a bit of disruptions in terms of flight timings, flight schedules, aviation capacity. Two of India's largest carriers saw that, both Air India as well as Indigo. And you also, towards the end of the year, saw West Asia conflict that impacted air traffic across the world. Despite that, how did you manage to turn profitable? And going forward, do you feel that you've now set a very favorable base going into FY27?
So our planning always envisaged that we will be profitable during this fiscal year. And that was predicated on one aspect, which was the tariff of Delhi Airport. So as soon as that came, obviously our revenues went up sharply. And that was post the expansion of Delhi Airport to 100-odd million passenger base. So it was always there on cards. We never, give any guidance on revenues and profitability. So we just kept a positive perspective over there. From our perspective, we also plan for some of the black swan events. So whether it was the mishap in Ahmedabad or it was Operation Sindoor, due to which traffic came off, and then the Pakistan airspace has been shut. Because of that, we plan all those in our forecasting, and even today, as I speak, we are very confident that we will continue with this momentum going forward, despite these conditions still continuing in this current fiscal year.
You've said you're going to continue with the momentum, but I'm going to force you, and I'm going to try and quantify some of the numbers going into FY27. FY26, you've set a favorable pace, given the fact that because of so much disruption, PAX growth across quite a few of the airports was flat to marginally positive. Now, with this base and going into FY27, and we also know that you have two very big airports coming up across the country, what kind of passenger growth are you targeting? If you could break it down in terms of the airport-wise, that will be great. But overall, what is the group targeting in terms of passenger growth?
So organically, I think we should grow by about 4 to 5%, despite the current conditions. The first half will be softer than the second half. First half is continually being negatively impacted because of the geopolitical issues. But we believe in the second half, things should come back. And in that context, I think about 4 to 5% organic growth will be there. We have two airports which are going to go live very immediately. The brownfield airport in Nagpur will come into our portfolio, which will grow our PAX universe there. And of course, the opening up of Bhogapuram or Vizag airport, that will also.
A quick word on the capacity there and how much you all are expanding it by?
So in both these places, the PAX will be about 2.5 million odd each is what should get added in the current year. With respect to, and these will all come into play in Q2. So about a 9-month impact, positive impact will be there.
Okay, understood that. You also gave a very important update to the exchanges, to the investors during Q4, where your largest partner, Group ADP, was paring its stake to a level where both yourself as well as Group ADP will have very similar holding as far as the platform is concerned. Simplify that structure for us. Do they continue as partners? And how are you funding the stake buy from Group ADP?
So I think the press release by ADP is quite clear. They have categorically said that this is one-off transactions that they are taking, and by selling about 7.3% stake to the GMR family. The understanding with ADP has always been from day one is that at all points of time, GMR will be 1% higher in equity stakeholding, issued equity capital stakeholding. So that will continue. The Group ADP, in order to comply with this condition, had converted their equity into a convertible instrument called OCRPS.
Right.
And so by selling about 7.3% stake, they will be able to convert a part of their OCRPS to maintain that delta of 1% between the GMR and Group ADP. So they will continue to be a strategic partners. There is no nothing envisaged where they want to exit an investment or they want to dilute their involvement in a GMR.
So no change in operations. The shareholding remains as per what was the original agreement. And a quick word on how that particular stake buy will be funded.
So it's the promoters who have bought it, and they have their own, resources to purchase that stake. Over the last, I would say, a decade, they have had the ability to monetize many of their assets and investments, and create enough cash reserves for themselves that whether it is entering into new businesses or buying stake back from ADP, they should be ready. So they have done it from their own sources.
So when we look at the airport business in India, I think we can now broadly categorize it into two key categories. One is the aero part of the business, which has a fixed return, and the other one is the non-aero part, which you've been very excited in past interactions with us. FY27, what kind of growth are you envisaging, especially with new airports coming in? And also a quick word, given that you have so much real estate across your various airports, any plans to monetize any of them?
So very clearly, I'll tell you, we are not too business-based. We are three business-based.
Okay.
One is the aero part, which is tariff-linked and gives a fixed, return on equity. And that's pretty much well understood. That's the utility part of our business.
Right.
The second, which now you can see the fruits of our strategy, is the non-aero part of it. Very interestingly, non-aero today as a platform, both from revenue and EBITDA perspective, is bigger than Hyderabad Airport as a utility business.
Wow.
Okay, so that gives you the consumer-facing consumer business that is there. The third business, which till date has been more as land monetization. So you basically you offer land to third-party developers who develop commercial properties or hotels on that parcel of land, and we get land rentals. Now that is the lowest margin business for any person.
Right.
The real business is when you develop properties on those, and then either you monetize them or you earn rentals on it. So as we go forward, that is where our focus would be, is to how to create a platform play on the real estate side of it. If you look at India, probably we have one of the most valuable land resources in the country. Land has certain attributes. It has, location is key.
Right.
Delhi, for example, Delhi Airport is now a central business district of national capital region.
Right.
With its own airport.
Right.
Okay, with 4 or 5 metros coming into that CBD. So if you go to Connaught Place, it's exactly the same thing as far as metro is concerned.
Right.
But Connaught Place does not have its own airport. We have our own airport, right? And it is sandwiched between an economic engine of Delhi and of Gurgaon, right? So it's very compelling, the real estate over there. The second is the land is owned by the respective airport entities. Hence, the title is clear, right? The third is we don't have to wait for approvals, because who's the master developer? The airport itself is the master developer. They give the approvals, they clear the buildings, they clear the designs. So it is inherent that we now start to look at becoming a developer ourselves and encash this check which is already embedded in it.
Can you put a timeline, or can you quantify the size of the opportunity, or all of these are still in the works?
So, I mean, it is already there in public space. We have land resources in Delhi of, yet to be developed of almost 100 acres.
Right.
We have land resources here in Hyderabad of almost, which is not yet been monetized, is almost 1,200 to 1,300 acres. Goa, another 200 acres. Bhogapuram, once it becomes live, another 200, 230 acres. So there is enough land available for us to actually develop in perpetuity. That is the kind of land resource we have. How do we make a business model of it? How do we extract enough value so that our equity shareholders derive the benefits of this over a period of period of time is what we are really working on. And I think in next few months, we will articulate it to the marketplace. Hopefully in the first quarter call itself of fiscal 27, we'll be able to articulate as to how we are modifying our business model to create this third very valuable
and glimpses
vertical.
of what you plan to articulate during the call you've already given us. And we hope to get some more details out of you soon.
We will. Once it is finalized, once we present it to our board and the board clears that strategic plan, obviously we will surely come back to you.
to turn over.
Going back into passenger growth and going back into India's aviation story and the growth story especially, it's always been seen as a structural growth story that air traffic in India is bound to grow higher. But going into FY27, there have been a couple of pain points. Number one, we've actually seen capacity cuts announced by two of the largest carriers. They're actually facing constraints in terms of getting slots at airports, across different airports. And another worry has been air traffic passenger growth in India actually continues to be around the pre-COVID levels. Is that a bit of a worry, or is it due to a lot of unseen circumstances that have transpired over the last couple of years?
It is the unforeseen circumstances, especially over the last 1 year. It's the airport story or the infra story is highly correlated to what happens in the economy. So if you grow at about 6 to 7%, your infra grows at about 1.5 to 2x of what your country's growth is. So we, over the last, I would say 6 months, because of these sometimes unfortunate events and sometimes geopolitical issues have got impacted, but we are not a quarter to quarter, we're not even year to year story. We are actually a decadal story, right? And most of our investors look at that as to at what point of time are we in our business model and in our model to create cash flows. So if you look at Delhi, for example, Delhi, we have already done our largest capex ever, right? To create 100 million capacity in Delhi. Now, Delhi can go up to 130, right? But small capex is required over the next, maybe next cycle, tariff cycle. So we will do that to grow into that. But those are very small capexes that will grow. So during that interim period of time, as the traffic is going 5, 7, 10%, it starts to generate significant amount of cash, which does not need reinvestment in the Delhi airport, right? So where does it go? It goes back to the shareholders after meeting with all its obligations to the debt holders. So we are at all our airports, including Hyderabad, although Hyderabad will, in a period of time, grow its capacity from the current 34 million to almost 80 odd million passengers. It will. We have already submitted, in our tariff proposal, but the master planning is right now underway. So once the traffic at Hyderabad also starts to, or is growing, which continues to grow and reaches its capacity of about 34 million, we'll have to put capex to work. But because it's infra, because it's tariff regulated, the cash flows begin as soon as the project is completed and tariff is notified, right? So it's a very interesting play in India. We are still very early stage as a country to create these kinds of infrastructures. And airport in a regulated form is an extremely successful story of creation of infrastructure in our country.
Well, you spoke about your obligation to the equity holders, you spoke about your obligation to the debt holders. A quick word as far as balance sheet growth is concerned. Now, given the fact that 2 new airports are coming, we understand that will impact debt. Going forward, how are you looking at managing debt? What kind of ratios do you look to maintain? What kind of discipline do you look to maintain?
So you're absolutely right. With 2 new airports coming on board, and potential new airports getting privatized in the future, the debt levels will go up. But the key metric over there is what is my net debt to EBITDA multiple. Ideally, I would like it to be about 3.5 to 4. But during the growth times, maybe 5.5 to 6. So there will be sometimes as we acquire assets, it comes along with EBITDA. The debt levels will go up, but the multiple level will go at a much, much lower pace. So as long as we meet that discipline, that there's a cash flow supporting that debt, and the growth of the cash flow is much higher, the debt levels will automatically come down. So that's why if you look at it, today GMR Airports is rated A+ by GAL. It's a simple reason for that. Look at Delhi airports, it's rated AA, right? You look at our Hyderabad airport, it's AA+. Now these are very highly rated, metrics from rating agencies. So debt itself is not an issue. Yes, maintaining a discipline of net debt to EBITDA is something that we need to be steadfast on. That's all.
You spoke about new opportunities coming up. What are the new opportunities coming up in terms of privatization? How aggressively will you be bidding in for new opportunities? And during those periods, would we see some fluctuation in terms of balance sheet discipline?
Not really. The government has been indicating for now quite some time that they will be privatizing, 5 medium airports with a smaller airport attached to those 5. So about 10 to 11 airports will come for privatization, and we look forward to participating in those. There have been some, conversations in the public space that they would not like to have more than 2 airports go to one operator, so that they have more participation in managing these airports. So we are quite happy with all these conditions as such. We'll be very disciplined. We cannot compete on cost of capital with the foreigners. Right. The country risk is high. You've seen what has happened in our currency. So we cannot ever compete on cost of capital. But we can compete on efficiency. We can compete on managing risk. So our preference would be more of greenfield airports than brownfield airports. But having said that, we will surely, in a very disciplined fashion, bid for new airports in the forthcoming privatizations whenever the government of India, articulates.
So, and finally, given the fact that you're a regulated entity, there are a lot of litigations ongoing in terms of tariff structures, in terms of asset-based calculations. Where are we on currently? Any risks on the horizon? And in case of favorable outcomes, you also believe that there are significant benefits that shareholders can accrue?
No, absolutely. I think these are historical litigations that have been there in their final, I would say, stage of adjudication, right? So they are right now with the Supreme Court. And hopefully, I think in the current fiscal year, at least one, if not 2 of them, do find a final decision by the Supreme Court. And we are very confident that we will be in the positive on these adjudications, because the lower courts have given a positive dispensation. But so we are happy that we are at that inflection point. But having said that, we also need to be cognizant that any such positive decision that comes will get reflective in future tariffs. It's not going to be an immediate windfall of cash that will come. It will reflect in future tariffs, which will again impact a positive impact on our long-term valuation.
Understood. Well, thank you so much, sir. Thank you so much for joining us immediately a day after results. Historic year, you've turned profitable on the bottom line.
Yes.
And I believe you are one of the key men responsible for getting that done as well. So congratulations, sir.
Thank you.
And we hope that this particular journey continues.
Thank you so much. Thank you so much. Thank you so much for having me over, and look forward to interacting with you in the near future.
We believe you're coming out with a presentation soon on a changed business strategy or a new business strategy. So I think that is something that the street will watch out for.
We are designing a new business strategy, which I said that the third vertical of real estate will form a bedrock of that strategy. Still under evaluation, still under discussions. We will take it to our board, and based on board's wisdom and approval, once they clear it, that's the time we will come and guide the markets and our investors.
Thank you so much.
Thank you so much.
Thank you.
All the best.
Thank you.
Hello and welcome to Commodity Champions. I'm Manisha Gupta, and the whole world clearly is watching out for what's happening in West Asia conflict. There is an expectation of a peace negotiation coming in very soon. But what it has led to really is the crude oil prices surging by nearly 70 to 80% in 2026. And that has led to countries getting introspective, looking into renewables and self-sufficiency when it comes to energy. Energy security clearly is top of everybody, on top of mind for everybody. And that's exactly what we're going to be discussing with our guest today. Joining me now is Siddharth Bhatia, who's MD and CEO at Oyster Renewables, and Sandesh Naik is CFO at AB Energy. Gentlemen, hi, thank you so much for joining in. Siddharth, to you first. And there's plenty happening in sense of investments, capacity scaling up. What is the latest that you have at Oyster Renewables happening for the country?
Hi, Manisha. Thank you so much for having us on this. At Oyster today, we are building capacities which are both wind and solar hybridized to power up the industry and commercial users in the country. We have achieved critical mass of almost 1 gigawatt, and we are scaling up our way to 3.5 gigawatts. And I think very correctly, you have pointed out that while the conflict in West Asia has escalated to the degree it has, every country around the world is looking for energy security, and renewables plays an extremely important part to ensure that there is a layer of energy security with wind, solar plants coming up soon. We look at a target that the government has set for us by 2030, which is close to about 500 gigawatts, and being a net zero country by 2070. We at Oyster are ensuring that we work tirelessly to achieve these targets and scale up the capacity available within the country.
Siddharth, you have big numbers planned for investment by 2030. How are you looking to raise that money? Are you getting in strategic investors, looking to tap debt markets, equity? What is the plan from here?
While we currently are well funded to achieve our vision of 3.5 gigawatts, we are constantly working a lot with institutions, financial institutions that would play a very important role in providing the debt for these projects. We also are looking at various options to ensure that we get in the best rate, whether it is international funding or funds coming in from overseas, looking at the green energy space within India. So a good mixed bag of opportunity as far as the finance is concerned. And we explore everything to ensure that we are the most efficient business out there.
Sandesh, getting you in this conversation as well, and clean energy is yet another thing that the 2047 Viksit Bharat roadmap does talk about very clearly and loudly. How are you looking at that one, and how are you aligning yourself with that?
Yeah, so basically, India is the world's fastest growing renewable energy sector right now. And considering the current situation right now, where there is a huge energy demand, whether it's on because of this data centers, we're talking about AI or EV, the hybrid projects which are right now going on, the battery energy storage which is coming into. So yeah, we look as a great opportunity for EPC players to tie up with many of developers like right now, as Siddharth Bhatia was also talking about the same growth which they have the targets around 1 gigawatt. Similarly, there are several developers with whom we can get into tap. We can tap to the market, and you can see that growth opportunity over here in this market at this point of time.
Sandesh, you're working closely, especially with those orders coming in from Uttar Pradesh. Do share on what exactly is that? How are you scaling that up? Are you in conversation with various other states too?
Yeah, so if we talk about the numbers, last year by March 26th, we were able to commission around 125 megawatt of projects. This year for 26-27, we plan to achieve around 225 megawatt projects, which are right now under execution. And by next, in third and fourth quarter, we should be able to add more 200 megawatt of projects in this year. And it will be mostly from Uttar Pradesh and Madhya Pradesh, yeah, of course.
Siddharth, the West Asia conflict has hit people in various different ways. So when it comes to managing the supply chain volatilities, whether it's about solar modules or wind turbines, how much of that currently is imported, and what kind of concerns are arising from there?
No, so I think while the West Asia problems have escalated, all commodity prices across the board have increased, whether it is sourcing from within the country or outside the country. I'd like to pause here and also give a massive applause to the government for starting a Make in India movement almost about 10 years ago, which has allowed for this sector to thrive as far as the manufacturing facilities are concerned, right from wind players that existed for many years within the country to developing an entire new market when it came to solar panel manufacturers and all the other allied equipment. So while there is a bit of a pushback in terms of supply chains being disrupted, we relatively have our supplies protected from some of the local manufacturers as well. This does, however, impact some of the costs due to the commodity prices going up. But we at Oyster had gone ahead just before this crisis and had locked in most of our supply contracts. Hence, the volatility has not hit us as yet, but only for projects that we are looking at in the near future. Some of that volatility would be a part of our entire CapEx plan.
Sandesh, a similar question to you with how are you looking to deliver cost-effective power or solutions to your clients? And the other thing really is about on how you have the larger corporates and PSUs now entering this space as well. Is that making the competition difficult?
The market is so big that right now there is no feeling of a competition, or there is a shortage of the work with an EPC contractors. So as what we try to do is we keep adding our services. So we add value to the services. We are not like a traditional EPC contractors, and that's where our USP is. So like just to give an example, we add land aggregation as part of the EPC services, which was never the part of an EPC contract in their services. Robotic installations, which we are getting into, base installations and commissioning, which we are getting into. So all these services and make us more competitive in the market. And of course, we are very much ready right now to cater to the demand which we are getting from the developers and the large-scale utility projects as well.
Sandesh, maybe not a competition really, that's perhaps is not the right word, but when you talk about pricing power, the kind of negotiation that they're doing, the pure plays, the agility that perhaps those bigger PSUs have.
See, the biggest challenge for an EPC contractor is a time gap between the contract what they get and when they are getting the procurement done. If we are able to handle it delicately, diligently, and minimize the time gap, the EPC contract should be able to match the pricing as well. That should not be a problem.
Point taken. Siddharth, how are you looking at various subsidies? You mentioned already on how the government is doing a great job of that, but in your field, you have to work with states and the center as well. And then, of course, the policies differ between the center and state sometimes, maybe lesser now, but how have you been dealing with that?
So you're absolutely right. Between the center and the state, there is a gap. Usually the state takes some time before it catches up to what the policy has been set by the center. And there is a time lapse usually, which causes a delay within our projects. So what we have done is we have gone ahead and chosen states that have a favorable policy. Not only do they have a favorable policy, but they ensure that they have a one window clearance as far as the renewable energy sector is concerned. So we are aggressively working in states like Madhya Pradesh, Gujarat, Andhra Pradesh, and now one of our biggest states that we are focusing on is in Maharashtra as well, now that their new energy policy has been announced. So what we ensure to do is that we work in a favorable environment. We are a part of various groups where we have a voice on policy advocacy, where we ensure that we are able to at least put in our issues up to the correct stakeholders so that some of that is taken into consideration.
A final question to you, Sandesh, then how are you looking at scaling up going forward with the kind of solar demand that we seem to be getting into the country, with the kind of subsidies, push, maybe more awareness that seems to be seeping in?
Yeah, so if see, we have already some more verticals in our kitty. Like earlier when we were into an on the solar EPC contractor, we have now entering into P2C as well, where we have our own subsidiary catering to rooftop solars and all. And the policy is really support very well for the rooftop projects as well as residential projects are concerned. In addition to that, we are also getting into this best, like for an example, in Maharashtra, the projects are permissible only along with the best. And now we are ready to get into it, and that's where the best will come into the picture. We strongly believe the best is the future for these commercial CNIs and large-scale utility projects, and we are very much ready for that.
All right, so growth absolutely coming in for the sectors, whether it's about solar and renewables. Thank you so much, Siddharth and Sandesh as well, for joining in and introducing our viewers to what really is happening and what the companies like yours doing into that space as well. We will, of course, speak soon yet again, but appreciate your time today on CNBC TV18. Thank you so much. And with that, we'll go for a very short break. When we come back, I will get you a conversation that I have had with Marex on the shipping and, of course, the West Asia conflict that has had on imports and exports from India into various countries, especially the Middle East. Do stay tuned in for that conversation. Welcome back to Commodity Champions. There's been so much happening, first in the Red Sea and then in the Strait of Hormuz. To understand how shipping giant AP Moller Maersk is navigating these uncertainties, I spoke earlier with Bhavik Mota, who's Director and Head of Markets, West and Central Asia at AP Moller Maersk. Here's a slice of that conversation.
Yeah, I remember last time we met in January, I was pretty optimistic for 2026. And I said, let Red Sea be behind us and we'll see the change. But of course, world is very different. So if you look at the India trade performance right now, for especially the quarter that's just gone by, reflects two simultaneous reality. One, of course, on one hand, we have this disruption, as you rightly mentioned, new kid on the block, the Middle East crisis that we are faced with, creating clear pressure on the Gulf flows and some of the associated flows which are going via the Gulf. On the other hand, when you look at India's trade fundamentals, they continue to remain very resilient, diversified, but are becoming more increasingly adaptive to these changes. In reality, we are not seeing a drop in demand. So we are seeing good, robust demand to the markets we've been discussing, Latin America, Africa, North America, Far East, the new kid on the block, showing good growth. But when you look at the data, it's a bit skewed now when the March data is populated in Q1, all thanks to Middle East crisis. But overall, fundamental-wise, India is looking quite good.
So let's break it one by one and let's talk about exports first. And we have seen a definite decline into that one. If we take the Middle East market out, are we still looking at exports growing? And what is the whole data looking like?
Yes. So if you take the Middle East component out and you normalize the rest of the flow on exports, is looking quite strong. Of course, there are trade dynamics, what is changing and what we are seeing a bit of a reshaping of trade corridors and strategic adaptation, and some of them is also tactical adaptation. Case in point, at least the cargo which was moving into the Middle East, now the biggest reefer commodity that moves is meat. Now, meat is not moving to the extent because it's very costly right now to move it into the Middle East because a lot of cargo now has to move on the land and it's not cheap to move cargo on land in Middle East. So part of that meat is now going to Far East. So we are seeing a bit of shift of volumes that is happening. If you look at some of the other commodities which are must-have in Middle East, like rice, which is the staple, it's needed, it's moving in spite of the cost being high. So it's a mixed bag from a Middle East. Apart from that, if you look at North America, quite stable growth, especially into the retail segment. The only question now is that, and thanks to also the Russian waiver on the oil import, we are seeing a normal flow of retail cargo moving into North America. So very difficult to predict, but all things being equal, if Middle East crisis ends and also if we see that no new tariffs are coming in, we'll see a good peak coming into North America. So stable, expected also to improve. We're seeing very good growth on the segments if you go by on pharma. Phenomenal growth. Again, lot to do with westbound trade into North America and Europe. And of course, two-wheelers continues to grow very strong within the auto segment into Latin America and Africa. So very, very robust export outlook minus the Middle East. And some of these Middle East commodities have made their ways into the new corridors. So they're diversifying rightfully so to also realize their earnings.
But have the freight costs gone a lot higher? Because I was talking to some of these perishable commodity exporters, rice, for example, mango, for example, grapes, etc. And they said what the price were earlier and what the commodity is now available to Middle East is at a much higher price.
100%. So it's absolutely right. There is no denying the cost has gone up because compared to your full-fledged operations in Middle East, now you're completely isolated from the Persian Gulf. So you have only limited 2 or 3 ports, one in Saudi Arabia, one in UAE, where you do your export and import. That creates congestion. All of this crisis, the fuel prices have gone up significantly high, so the costs have gone up. So your ocean freight, the bunker element of the ocean freight has significantly gone up. That reflects into the ocean freight. And on top of it, because you're not accessing the Persian Gulf, and majority of the cargo is going to the Iran and Bahrain and Kuwait of the world, you need to do a road bridging. And they don't have enough capacity, supply, demand, and it's a very expensive value proposition to move cargo on road, and that adds extra pressure on the cost. So 100% right, the costs are going up, and it's not cheap right now to move.
So that is about exports, of course. So when it comes to imports in India, that number seems to be fine, especially when it comes to raw materials, etc. What are we looking at in sense of categories when it comes to imports, and how has that number stood out?
Yeah, so import for us, Q1, very, very, very good. Double-digit growth, and it continues to be quite resilient from that perspective. And it's pure reflection of India's manufacturing, expansion that is happening, and the pure consumption that we still have in this part of the world. Of course, now we have to see how the future inflationary pressures, whether the consumer demand and the buying criteria changes, very difficult to predict, remains to be seen. But we are seeing a lot of impetus from Far East. So we are seeing a lot of appliances, electronics moving in big numbers. We are also seeing a lot of PTAs, polyfibers moving from that part of the world. And of course, from the likes of North America and Europe, we see a strong surge of recyclables. Part of it is, of course, because Middle East is shut again for them as a market. So they also find alternative market on imports into India. And we are seeing a little bit of influx, more than the usual, on the recyclables coming into India.
You mentioned about Europe, you mentioned about Asia. How is India's trade with US right now? And the fact that we're looking at so many FTAs, tariffs is something that's taken a bit of a backseat. But then again, we do understand a lot of countries are restarting those negotiations with India. Has that already seen an impact?
Yeah, so to be very, very honest, the real impact of FTA yet to be seen. So a lot of discussions and a lot of narratives around that. But in reality, as I said before, the demand is quite stable, and the waiver on the Russian oil import tariff has really helped to normalize that outlook. The key is now, if the Middle East crisis gets over at some point of time, fingers crossed, and there are no new tariffs coming in, July, August is generally the peak. And when you talk to most of the big retailers, they're pretty confident that the peak looks quite good because they need to restock. Again, inflationary cost, if it goes very high, would be a different story. Buying criteria in US again can change, whether the big size retailer or mid-size retailers will win. But we are pretty optimistic that all things being equal, things normalizing, we'll see good growth coming in Q2 and Q3 of this year.
How are you also looking at India's exports on how they stand right now? Middle East is a concern. Yes. Is a lot of cargo going west or eastwards? Or do you think the trade within Asia seems to be picking up even more stronger?
It's both. I think Middle East, the good part about Middle East is when it really started the crisis in March, there were not too many acceptance points. So slowly and steadily, we're also finding new solutions for our customers to find a way to get into the Middle East. Not perfect given all the complexities that I mentioned, but the Middle East cargo itself compared to March is showing a little bit of increase, from India. Apart from that, as I said, alternative markets is mainly Far East. That's where the meat is moving. That's where a lot of these petchem volumes are moving and so on and so forth. So definitely alternative demand into Far East and little bit going into Africa, not so much. Some of the commodities like rice have found the alternative market, but rest all, it's pure demand coming out of those markets, which are Europe and US.
Let's talk about the Maersk presence in India as well. And I remember last time we had a conversation, there's a big amount that has been committed into India. What is it that you're looking at from the government when it comes to whether it's about accelerating port automation or workforce deployment here?
I think the biggest issue right now, and it's also the ripple effect of some part of it is because of the Middle East crisis, right? Because a lot of the cargo which cannot go into the Middle East, they have found a safe storage in Indian ports.
All right.
And with the demand in India growing, especially on the west coast of India, we are seeing a bit of congestion coming in. That is now compounded by also the trucking driver shortage that is compounding the overall issue on of that. So the biggest task is how do we resolve this issue? Because not only the costs are going up, it is also creating inefficiency in the system. So one of the things that we need to really resolve is how do we create a bit more space, and a couple of ports are coming up in the next couple of years that should ease the pressure on overall the port infrastructure, but we also have to resolve the issue around this whole drivers and trucking shortage that we are facing on the west coast.
Bhavik, in your initial comments, you said when we met last in January, you were very, very optimistic. As we look at or stand as the end of the May, how is the next quarter or the rest of 2026 looking to you?
Yeah, so next quarter, we are already into the second quarter, so to say. Middle East is, as I said, not back to normal. It will take a while before it
But as you pencil in a lot of things, are you penciling in normalization by fourth quarter of this year or not yet?
We are assuming that, but as I said, your guess is good as mine. So very, very difficult to predict. We are assuming hopefully it will end soon and hopefully in the next couple of months. But yeah, we see quite robust demand, as I said. Even on imports, what we are doing, because we do expect demand to continue very strong from Far East. We are launching in a new service starting next month because customers are asking for that capacity because they want a lot of the cargo from east and the south of China to move into the west coast of India. So that will really create a bit more capacity. That's been the need of the hour. So really there is a demand on import. That's where we are investing. North America and in Europe with the Gemini and the Meckel, what we discussed last time, continues to be strong. With the extra capacity, we've been able to fill the cargo. The demand continues to be strong. So all in all, very optimistic that we will see a good quarter 3 and quarter 4. Only disclaimer is, inflationary costs should not be beyond a point where it becomes unviable, and then hopefully, and the Middle East crisis should come to an end.
On that high hope, thank you so much, Bhavik Mota, for joining in for this conversation. Really appreciate your time here at CNBC TV18.
Thank you so much.
And with that, we'll go for a short break, come back with more conversations.
century. Overdrive this week, we drive the updated Honda City Hybrid to see if sedans still make sense in the Indian market. We get you up to speed with the latest news from this week and ride the new KTM 390 Duke to test its more refined character. Hello and welcome to Overdrive. I am Soini Dutt. Ethanol-based mobility is rapidly getting momentum in India as the government pushes for cleaner and more energy-secure alternatives to petrol. Hero MotoCorp has announced the launch of their first flex-fuel motorcycle for India on June 3rd, while Union Minister Nitin Gadkari revealed that Maruti Suzuki will unveil an E100 compatible flex-fuel car by June 5th. Closer to home, Tata Motors has launched the updated Tiago ICE and EV starting at 4.69 and 6.99 lakh rupees. The EV now adds up to 100 kilometers in just 18 minutes charge time, and that will be pretty quick. We'll also be driving it next week for more information. Globally, Ferrari has unveiled its first electric car, the Luce, while the EV packs in 1050 horsepower, 0 to 100 kilometers time of 2.5 seconds and a 530 kilometer driving range. Many fans criticize its styling, calling it a departure from its Ferrari traditional Italian flair. Now, Ferrari shares also reportedly fell by 8.4% on the Milan Stock Exchange, and that's quite a cost, wouldn't you say? But this week, our focus is on the updated Honda City with sharper styling, new tech, and improved ADAS safety. Let's take a look.
Now, one of the reasons the Honda City has remained relevant for so many years is that Honda has constantly evolved it to keep up with the market. We have another such update now. This is to the 5th gen model, its second facelift. Let's see what you actually get with it. The Honda City now resembles the Prelude Coupe from the front, at least, with the wide lighting and the full width signature. That is also still tastefully done. There are no fog lamps anymore, but the LED projectors are now twice as bright as earlier, Honda says. It's become quite aggressive, especially with all the chrome being removed and in this new black shade. Although we wish the wheels had grown in size, even though the new design does look good. At the rear, you have a more aggressive bumper to go with this theme and clear detailing in the tail lamps, which gives it a slight JDM feel. Now, in terms of what's actually new in the cabin, of course, the most apparent is this new 10.1-inch screen. How it actually is to use, I'll get to later. And you also have slightly different colors and materials happening in the cabin. I really like how this brushed kind of finish goes into this plain silver finish. It looks classy, I have to say. And this ambient lighting, unlike many other cars, it's actually visible even when the sun is out. And then as you'll see, some of the upholstery has been made of a lighter color. And then of course, this is probably the most liked. You now have ventilated seats. Now, like I said, you don't have the absolute top tier features here. I mean, as you can see, this is manually adjustable and there's only a single pane sunroof, for example. But this still feels like a premium stately car in that sense, because all the touch points are soft. The steering wheel is soft. All these bits here are soft. This bit here is soft. Even this panel here, where say your knee would sort of hit, that's also soft. So you have that experience of a sedan, that Honda City experience, which is always a premium car in a sense. That experience is still kind of continued in the cabin, even though you have a much stronger list of competitors that this car goes up against. The new 10.1-inch screen is an improvement in terms of responses, but it's still not the best. The angle and brightness make it difficult to read in sharp sunlight. But you have some gesture functions, wireless Android Auto, and the large real estate makes it easier to use on the move. It does feel a bit tacked on, but actually doesn't really interfere with the rest of the car's working. The part digital driver's display though is a good one. It's intuitive, easy to toggle through, and gives you good information on the move. Now at 2600mm, the wheelbase of the City is not quite as large as its rivals like the Skoda VW Twins or the Verna. But Honda does manage its space well, like I mentioned, and you see some of that here because I have a lot of knee room. This seat is set to my driving position. Yes, if you are closer to 6 feet, then this place might feel a bit tight, especially the headroom, because while the roof is sort of caved out a little bit, it's still not quite enough. But otherwise, in terms of comfort and just how everything is done up, you have that feeling, the seat back reclines to a good angle. There's a lot of soft padding, especially along the sides, so I can lean in softly as well. The seat has a lot of thigh support. It's maybe not as great as some SUVs that you might get, but it's fine. You're sitting low, but it's still there. And even the hump in the middle, remember this is the hybrid version, it's still not intrusive. So while this bit is slightly, protruding in that sense, you could do worse than this in this segment. So if I were to sit in the middle, this is what it feels like. And there are enough amenities. You have these AC vents, you have two Type-C chargers. This armrest kind of folds down like this, and there's this slightly different trait of how the armrest just flops down. So at least I can put both my arms at the same level, which is a good attention to detail. And because the fuel tank is here, I also have a kind of a footrest. So you can get quite comfortable. You don't get sunshades, you get a one-touch function for the windows. But a lot of you who really like this feature, you don't see this at all nowadays in cars of this price range. And it reminds you of sedans of old. And I personally really like this bit here. We do wish window shades and powered front seats were also added. The 360-degree camera has improved resolution and helps parking, but the blind view camera is still quite grainy. Safety is top-notch with a well-calibrated ADAS system and enough airbags. Now, when you have a sedan, a big part of the experience is the big boot. But in the case of this hybrid, the boot is not very large. The space is reduced by about 200 liters to 306 liters, and as you can see, it's still a very deep space. So I can really sort of push stuff inside, and you'll still fit a few of these trolleys quite easily and a lot of small bags. So at a pinch, a family's luggage will fit in it. But a big thing with Honda and with the City to an extent is how well the space is managed. So even though you have, this hybrid powertrain and so on, you still have the space saver wheel. And underneath this quite high floor, there is a lot more space, like this small bit here and so on. So you're not compromised in that way.
Well, we'll be back with the driving verdict of the Honda City. While you enjoy a quick refreshment during this short break, we'll see you on the other side. Keep watching Overdrive. You're with us on Overdrive. With over 27 kilometers to the litre, the Honda City Hybrid is offering a perfect balance between a practical family car to a premium driving experience. Now, Tuhin will tell us whether this is a sedan that you should put your money on in a country that is obsessed with SUVs.
Now I'm driving the Honda City in its hybrid form. As you can see, or here, the engine is not working. I'm just cruising along just on electric power. And to go with that, the whole experience is what you expect from a Honda City. So the steering position, the way the seats are, you have that slightly low set, sporty feel. So in that sense, if you like driving, it's good. But also if you are quite tall, say over 6 feet, if you have long legs, then this might be a bit cramped, especially this area here. Your foot might sort of scrape against this. For me, it's not really a problem. Now this hybrid powertrain, it makes 126 PS and about 253 Nm. So in terms of torque outputs, it's right there with all the other 1.5 turbos that you have in this segment. And the torque, it's not like that turbo kind of torque right in the mid-range. You have to sort of work for it a little bit. And you have that slightly CVT kind of behavior too, where, the drone comes before there's actual motion. But I have to say that it's very well controlled. It's only in some really, really heavy driving do you actually notice that delay. And more often than not in everyday driving, you have that, that linear steady pull. Yes, the engine is doing its thing in the background, but the electric motor is also constantly assisting it.
This Honda system works a bit differently from the Toyota hybrid system, but on the road you find that it can be more responsive since it's putting electric power to use, somewhat like a range extender below 80 kmph. And aside from the drone, it's also quite refined. It will still try to go into EV mode in low load situations, so great efficiency is possible. The hybrid is fairly quick and will do 0 to 100 kmph in under 10 seconds. Considering you have a certified efficiency number of over 27 kmph, the city hybrid may not be as exciting as a turbo petrol, but it does give you a compelling mix of performance and efficiency.
Now another slightly different trait of this hybrid system is that you get 3 regen modes. Now they work as they usually do in EVs, so you can go right down to a 6-7 kilometer crawl with them. They aren't as aggressive as, of course, you might find in EV, but it works on the basic principle as that. Now, if you want a bit more engine braking, say if you're going downhill, then you can put it in this brake mode where you get even more that engine braking effect, and the regen effect is also there. So, the car doesn't get away from you in those situations. However, I do wish there was a sportier mode that sort of gave you a bit more of that electric power in the mid-range, just made it a little bit more exciting. You just have this economy mode. So that is something that I feel could have been added. But the rest of the car has all those traits that make a Honda City likable, So it doesn't feel cumbersome, it doesn't feel heavy, it's not leaning and heaving like an SUV. It has this kind of lightness to it, to all the controls in a good way, even though this is the hybrid and it's about over 100 kgs heavier than the regular version. It has that kind of agility to it.
The Honda City has enough ground clearance to handle some massive speed breakers, as you can see here. You only need to be careful on steep slopes where the overhang can be an issue. The ride is a good balance. It stays steady and pliant over uneven surfaces, although you can get thrown around a bit over a sharp, broken section.
And there's actually some fun to be had, especially around, say, corners and so on, because you're sitting low, you have that good dynamic ability that the city, over the years it has gone softer, but it's never really lost that dynamic ability, I have to say. It's still there somewhere underneath. It still feels a good car to drive. And if you even aren't that interested in driving, if you are buying the hybrid version, for example, then it's still a car that's easy to drive if nothing else. Now, this car is running 16-inch wheels, and I do think they should really size up a bit, at least a size. And even at high-speed cruising, highway cruising, over the years it's become quite a bit more steady, quite a bit more stable in the straight line. But I really do wish there was just a bit more grip going around, especially at highway speed. But I have to say, one great thing about this, especially that this is a hybrid, is the braking ability. I'm quite surprised how direct and how feelsome the brakes are. You really can stop quite confidently.
We do wish some of the earlier sporting character of the City was brought back, and the infotainment was as well thought out as the rest of the car, considering the premium this hybrid version charges at ₹21 lakh ex-showroom. That being said, with this update, the Honda City now tries to do more to address the enthusiast crowd that now chooses sedans. The new features do more to keep the City competitive, and it's the same with the styling changes. The basic Honda City recipe of being an effective, functional family car remains unchanged, and this hybrid system is still a cohesive, responsive and efficient system that doesn't ask for compromises.
Well, it's time to take our final break here on the show. Don't go anywhere. On the other side, we'll tell you all about the KTM 390 Duke.
Back to your...
Welcome back. You're with us on Overdrive. The new KTM 390 Duke now comes with a 350cc setup, which doesn't focus on raw aggressiveness, but now it is focusing on engine reliability, smoother power delivery, and of course, everyday rideability. Here's Chris with more details.
We've seen Bajaj Auto and the affiliated brands go on a downsizing spree as far as the single-cylinder engines are concerned, because we've seen it happen with the entire Triumph 400cc lineup. We've seen it with the Bajaj Dominar, and now in effect we see it with the KTM brand as well. No more 399cc's, because that model is known as the Duke R. Well, this is the 390 Duke, in effect 2026 model. Yes, it is the downsized engine, 350cc's. Thank you, Indian government. While the downsizing of the engines might have been a good effort, because it makes the motorcycles all the more approachable to the common man. But when you think of a brand name like KTM, well, these motorcycles are all about that power and the power to weight and that instantaneous kind of acceleration and all that, the fun involved in, well, motorcycling. Now, does this downsized engine make sense in a motorcycle of this stature? You're about to find out. Now, the original 390 Gen 3 bike powered by the 399cc engine will continue to sit alongside this new variant for riders who still want the biggest serving of some 400cc orange pie. So you could think of this downsized 350cc version as the aggressively styled Street Fighter, just with a slightly lighter serving in size and a friendlier price tag for India. Everything remains the same between the models apart from the engine capacity, and obviously some internal bits too. Now, the LC4C engine on this motorcycle is the only thing that KTM have actually tinkered with, because that in essence is what essentially brings down the price and makes this motorcycle all the more affordable. Visually, you have a blacked out mainframe to basically visually identify that this is the 350cc model. Nothing else beyond that, honestly, because you still have the LC4C badging on the engine casing out there. Now, yes, there is a reduction in power and torque, obviously, because now it puts down a maximum of around 41.5 PS of max power, and in terms of torque delivery, a maximum of around 33.5 Nm. So, in terms of power and torque delivery, now this engine always had that lovely characteristic. It always loved to be revved, and it always felt a little more comfortable higher up the power band. Not so much so lower down the power band, and this engine, well, it kind of emphasizes that, because it still is rather uncomfortable lower down the power band. From around 2000 to 3000 RPM is where it kind of stammers a bit. 3000 to 6000 RPM, that's where you really feel the reduction in power. If you're used to something like the 399cc engine, you do feel that this motorcycle takes a little bit more of effort to actually reach that exciting kind of stage and level. That kind of feel that you want from a KTM 390cc motorcycle like the Duke. In terms of your mileage, well, that is going to be a lot more docile and a lot more easier to manage, but unfortunately we don't have that much time to actually check out how far it is more efficient compared to the 399cc engine. But from what KTM and Bajaj tell us, that they have tried to basically mimic what you got with the 399cc engine. So it should be pretty much on par, maybe around the 25 to 30 km per litre kind of area. So what KTM have done with this downsized 390 Duke is try to give you the max bang for your buck. But is it exciting enough for me? Well, no, it really isn't. But that's simply because I know just how brilliantly active and enjoyable the 399cc motor is. So, if you ask me, is this diluting the overall experience in a way? Well, yes it is. But is it boring? Strangely, no it isn't. It's just less exciting. It's the same presence, the right dynamics of what the now 390 Duke R is, just with some of the orange Austrian ferocity dialed down a bit. You still have the aggressive but not so tiresome rider triangle to deal with. You still have the agility to change direction quickly. You can manage tight spaces really well because the turning radius is quite nice. You can still brake late, the riding aids, all are in place to keep you safe and manageable. It still maintains that nice balance of sportiness and comfort when you get aboard. And like the R, this one comes with a good amount of features on there as well.
In terms of design and features, it is pretty much the same motorcycle that we've seen before because, yeah, nothing really tinkered with by the KTM Bajaj alliance. So you still have the nice alloy wheels at both ends, draped in the Apollo, the Alpha H1s at both ends, really nice tires on there. You have the same suspension setup, fully adjustable WP setup at both ends. You have a slip and assist clutch, you have a bi-directional quick shifter, you have a ride-by-wire throttle, so you have ride modes, you have 3 ride modes in fact, you have rain, street, and yeah, on this one you have track, so you have a lap timer on there as well. You have the IMU, which opens the doorway for something like cornering ABS, cornering traction control as well. So as a package, it offers you a lot. Yeah, you have the 15-litre tank on there. In terms of seat height, that still is a very approachable or very accommodating 800 meters off the ground. So yeah, shorties out there really won't find that to be an issue as well. Getting your feet planted on the ground, no biggie out there. So yeah, nothing to really write home about, but yeah, the only visual differentiation with this motorcycle from the 399cc model, or which is called the 390 Duke R now, is that mainframe, because now as you can see it's kind of blacked out. But on the higher spec version or the bigger capacity model, slightly bigger capacity model, well, your mainframe is in KTM orange. The main reason for all this engine downsizing business has to be because of the pricing factor. Now this motorcycle with the 350cc engine on there, it is around 60,000 less expensive than something like the 390 Duke R, which is basically the same motorcycle with the 399cc engine on there. We started off with questioning whether this motorcycle dilutes, well, the excitement that the Duke 390 is supposed to give you. In a way it does, but there is a reason that KTM still has both these motorcycles on offer. There is a reason why they are still exporting the 399cc motorcycles to markets abroad, because that kind of performance, that excitement is still there with that engine. It does still have that KTM kind of performance to it, but with a dollop of vanilla, I'd kind of like to think. It is a lot more sobered down, it is a lot more docile in that kind of respect. But yeah, overall, not too bad. It still is a very exciting package. It does feel like it does lack a bit of punch and excitement because it takes you a bit to actually reach that level of outstanding that this motorcycle was originally meant to exude.
Well, with that, it's a wrap on this week's edition of Overdrive. But remember, you can stay in touch with the team through our various social media platforms. You can write to us on YouTube as well. We'll see you next week. Until then, goodbye. Many thanks for watching. Drive and ride safe.
sharp sell-off on Friday dragged the markets lower, leaving the benchmark indices in the red for the week. The Sensex and the Nifty both ended with losses of nearly 1%. However, the broader markets continued to show some resilience. The mid-caps outperformed the benchmark, while the Nifty Bank too managed to close with some gains. Over the next 30 minutes on Editors Roundtable, we will decode all the action, the key triggers driving markets, and what investors should watch out for in the coming week. Hello and welcome to Editors Roundtable. I am Reema Tendulkar. With me are my colleagues Prashant, Nigel, and Aviation. Here with us in the studio is Ravi Dharmshi, CIO, ValueQuest Investment Advisors. Hi guys.
Hello.
Very tough Friday, particularly the last 30 minutes. And today is yesterday, marked 3 months since the conflict started.
Oh, yeah. Nobody thought it'll go on for 3 months, right? So that's the nature of the market. So, but I guess markets have been quite resilient, right? I mean, initial hiccups, but seems like we are back to normal. We started ignoring the war sort of news as well. Ravi, what's your call on the market now?
No, I think you're right. See, once market gets a sense of if you can quantify what is the risk, what market tends to react to is what is unknown and unknowable. If you don't know how long this conflict will last, the bombardment continues, the crude goes up 120, 130, you don't know where to put a cap on things and you can't quantify the risk. That is where the problem lies. But now some market has come to terms that, worst in terms of hostilities is over. The red line for US might be here and Iran might be here, and it might take some time to bridge that gap. But at least we are not going back to that kind of hostilities. And also, both of them want the Strait of Hormuz to open up. And there is a invisible line, essentially the midterm elections for US, where he basically needs to, the president needs to show a win. And for that, he needs to ensure that this conflict ends, because the longer it drags, it's negative for him also. And the bond yields have also started reaching the point from where he starts listening to it. So I do believe that the conflict, unless we see a new spike in the crude, which takes it to beyond $120, $130, I think we are for the moment done with this whole thing.
Otherwise, you're constructive, Ravi?
So you know what? It is a very, very bipolar market. If you see the index, you feel you're not going anywhere. On the bears feel it is not crashing in the way it should for the kind of crisis we have. The bulls feel it's not rising the way it should because we are in a cyclical recovery. You look at the credit growth, you look at the monthly sales number. The quarterly results were not bad. So everything economic-wise, we are on the cusp of a cyclical recovery. But because of the global uncertainty, we are kind of capped. So indices, the headline indices are not headed anywhere. But there is clearly a segment in the market where there's a bull market going on. And it is a stealth bull market because it is not coming on the radar. And we might categorize it as mid-cap. But even within that mid-cap, specifically where the bull market is going on are the industrials, the manufacturing-related stocks. And it is not only in India, it is happening worldwide. In fact, I do believe that we are in a global industrial, super cycle in terms of capex.
Actually, the list is long. I mean, actually about 10 names, right? There's an absolute bull market, all-time highs. The GE and the Hitachi and the CG Power is back to all-time high. Siemens, there's ABB, there's Cummins India, which has seen massive moves. The cables and wires, perhaps, I mean, they've not really, they're not started.
No, they have. Even they are at a new all-time high. You can
so this is the
check.
pack that you're referring to, right?
Yes. So this is, okay, let me just take a step back and paint the whole picture to you. This is but one segment. So, since 1990 to maybe till late, early 2020, the world was running on a principle of building cost-efficient supply chain. Essentially, the world was flattening. There was globalization happening. Suddenly, in the last 4-5 years, things have happened which have kind of turned it on its head. We are no more focused on cost and efficiencies. We are focused on resilience, redundancy, on safety, security, those kind of things. First, it was COVID, which kind of made us realize that supply chains are vulnerable. Then there was a semiconductor shortage that panned out. Then we saw Russia-Ukraine war broke out, which led to energy prices going through the roof in Europe. And then, of course, there was a tariff war, trade war, which made us realize that if you are too dependent on a particular country for your needs, then they can possibly weaponize it and use it against you. So there is a trend towards building this global supply chain resilience, energy security and independence, your own nation's sovereignty and security, and become part of the crucial technologies that are coming up, and you become part of that supply chain also. And this is what is driving the global capex super cycle. And that, I believe, is the whole world is. I mean, why is Taiwan, Korea, why are they doing so well? In fact, if you over there also, if you see, if you strip out Samsung and if you strip out SK Hynix and the likes of it, you will see that the rest of the market is going down. The foreigners are actually exiting in those countries also, in the other side of the market. Similarly, it is happening in India also. There is a pocket which is actually doing very well, and there is a other market which is nobody is interested in. And all this money is essentially drawing more towards US, because US is where the bulk of the action is happening in terms of the technology companies are out of there, and the hyperscalers are driving this entire capex super cycle. So I do believe there are two different sides to the market. If you are looking at indices, you will feel there's nothing in the market, and if you are looking at this pocket, you feel the valuations are going berserk.
But Ravi, because all the capital is chasing such few names, the industrials that you're talking about, stocks have doubled, valuations of 50, 70 times. Can you make a bullish argument from here on for these stocks that you were referring to?
So you, no doubt about it that the valuations have become expensive, and no doubt about it that market has recognized it is not an unknown theme anymore. However, I think where market might be underestimating is the length of the cycle, the kind of value and the the opportunity size, and how this value can accrue to few players. So you see, in this is a kind of opportunity where on every sector I look at, let's take the example of transformer. There are only handful of companies that can actually manufacture those high-end transformers, which is the need of the hour. If you are going to electrify, if you are going to move towards AI data centers, you need those transformers, whether it is medium voltage, high voltage, HVDC. There are only 2-3 players, and when that kind of a huge opportunity meets an monopoly or an oligopoly kind of an industry structure, the valuation tends to go crazy. And it has been so the case for the last 1 year or so, but I don't think we are at the fag end of the cycle. You have to focus on the cycle rather than the valuation. If you keep valuation as the decision point for entry or exit, then you will likely miss out on the cycle.
Even if you buy right now a transformer, 1 or 2 transformer companies, you will make money comfortably?
I will never say you should buy at this valuation, but at the same time, the cycle is not ending. See, the 9 lakh crore capex cycle in India itself is still ahead of us. Also, the entire data center capex build out is ahead of us. I think by 2032, I think almost 150 gigawatt of data centers will be built. Now, if you were to just when will those risks come about? Is if this everybody has so I think all hyperscalers combined have a operating cash flow of about $300 to $350 billion, and their capex this year is going to be $700 billion. So already they are going to start leveraging their balance sheet to fund this capex. This number from $700 billion goes to $1 trillion the next year, and it sustains for a 4-5 year period. Now, at some point of time, if they don't start seeing the return on their investment and their balance sheets are leveraged, and the interest rates go through the roof, that is when the bubble boom, current boom will become a bubble and it will start bursting. Are we at that point? I don't think we are at that point at this point in time, and a lot of the capex still needs to happen. The balance sheets will still probably get even more leveraged from here before we start seeing the problem. But yeah, I mean, that is a discussion probably for a later date, not today.
Okay, Ravi, let's talk about another theme then that you all have liked, the renewables theme. I mean, it's public knowledge in terms of the companies you'll have. But at one point of time, you all were the so-called lone warriors out there, because the street was doubting. There is module production, maybe there is excess. Then they were going to forward integration. There was cell production, but maybe there is excess. How are you feeling about this renewable themes with regard to the listed players here in India? Because suddenly there's a resurgence out there.
Yeah, so Nigel, I'm going to take a step back and again explain that first of all, in this larger global industrial capex theme, energy security and energy dependence is the larger theme. Within that, energy transition. So we are not only trying to become energy secure, we are also trying to move away from fossil fuel towards renewables. And in this renewables also, solar is but one part of it. There are many other things to it as well. Hydrogen, nuclear, wind, battery. So many other technologies will also come. It's not like solar is the only one. But solar definitely is the largest because it is the cheapest form of energy that humans have created at mass. So it will have the largest adoption. The size is huge. But the problem for this is that when this whole revolution started in India, we were completely dependent on China. Today, you take the same case for batteries, we are completely dependent on China. In fact, the entire world is dependent on China, not only us. So now one has to understand the strategic intent of the government. If you are trying to become energy secure and you are trying to become energy independent, then you are not going to start thinking that, if I buy this from China, then it will be cheaper. So I should rather import from China and do this. But if you do this, you are actually giving away the leverage that you have, and you are in fact going to become dependent on a rival nation for your supply chain, and that can be weaponized at some point of time. So you want to avoid that situation. So government, what it is doing is, it is keeping the profit pools protected. So they started with providing, ALMM to ALMM1, which is essentially only the local guys can sell modules. Then they give added incentives of PLI. They also added customs duty to make the imports expensive. Now that was the beginning at the module end. But if you go through now, their ALMM2 comes into effect. In fact, from 1st June onwards. Now, what that will essentially do is move the profit pools from only a standalone module guy to somebody who's integrated with a cell plus module. Then from June 28 onwards, this will move to wafers. So essentially government is saying, make your money in that window of opportunity when I'm giving you protection, use that cash flow, backward integrate, all the way they will go till polysilicon. So that is the way, that is the pathway that government has adopted in ensuring that we have a supply chain. See, an entrepreneur will not put money unless he has some kind of guarantee that they will make money. And we are not the kind of state like China is, where you don't have to consider the ROIs, or you don't have to worry about the land or many other things. So our entrepreneurs have to think about making money. Now, if they are given a window of opportunity to make that money and they use that to backward integrate, I think that's the right way to go about doing this.
I must say there are still, Nigel put it right, you were the lone warriors, it's worked out beautifully, but there are still those who are kind of on the sidelines, institutions especially, on this theme. And the worry, we hear it often enough with analysts, etc. also, that maybe overcapacity is the
returns,
in 2 years' time. And by the way, I got a call today and maybe I should put this to the management, and you're a shareholder. With regards to Wari, there was I think it was a news item that they're raising 7,000 crores.
10,000 crores.
And somebody called me and said, well, you should ask, why are they raising equity? They're not highly levered. They can raise debt. Why do equity?
So I think...
as I said, I should...
No, it's not a question for me, but as I understand, and I'll just answer it, not only for this company, any company, I think the capex is 4x, 5x larger than the equity raise that they are doing. So equity will still be only 20-30% of the total fund that will be required. It's a 30,000-40,000 crore kind of a capex plan that they have. So, I mean, but they are first raising the equity and the debt will come in later.
They have some ambitious plans that they laid out in the analyst meet, at least Wari, earlier last month. Ravi, stay on. We need to slip into a very short break. We'll come back and continue this fascinating conversation on Editors Roundtable with Ravi.
I think
Welcome back. You're with us here on Editors Roundtable. You know, one of the things, and we've discussed lots of stuff with Ravi in terms of what he likes, his bets, etc. But now this is not a bet, but this is a wish list that many have, especially the equity folk. I mean, all of us, that equities taxation perhaps should be reduced. I mean, this has, of course, been a constant demand since the time it was introduced back in 2008. But I guess it's gained more momentum with what has been happening on capital, with capital outflows, etc. So we had, you know, Bank of America's Amish Shah earlier today, and we put that same question to him. So just we want to play that soundbite out, and then we'll ask Ravi how he thinks about this question.
Has taxation lopsided allocations of retail savings towards equities? Completely yes. Has the capital gains discouraged foreign investors, especially when rupee is hurting, especially when, you know, earnings growth is low, valuations for India are high? So therefore, is India out of my radar as a foreign investor? The answer is yes. And given that large part of the rupee problem right now is also lack of capital flows, I think it makes sense for us to do it. So the answer that I'm trying to give is that, you know, logically, if you think about it, we must do it.
Ravi, your thoughts? Amish says we must do it. Logically thinking, we must do it. Your thoughts?
So, you know what? If this crisis has revealed, it is our vulnerability. And vulnerability is not only on the energy security and supply chain security, it is also on the fact that we are dependent on, you know, our foreign currency. And we have been kind of caught up in a downward spiral over there. FIIs are exiting, rupee is depreciating, balance of payments is going for a toss, current account deficit, fiscal deficit, both are ballooning up. And if we want to get out of this vicious cycle, then there is only one external injection that can help, which is essentially attracting foreign capital flows. So in terms of what is the need of the hour is very, very clear. We need to attract capital. Now, government can adopt any playbook they want, but essentially we need to attract $100 billion next year. That will stabilize the rupee. That will make our macros fall in place again, and we'll become an attractive destination again. Will they cut LTCG to attract FPI flows? I seriously doubt that. I do believe that their government is making a distinction between long-term, attracting long-term sticky money, and FPI flows are considered as hot money. And that is definitely not a priority for this government, as I understand. Now, I could be completely wrong, and I'll be very pleasantly surprised if it was to happen. But I think I will be more, you know, probably hoping that something on the bond market side, something on the attracting FDI in some of the larger sectors, like probably what they have done for data centers, where they have given a 20-year tax holiday. I expect, you know, at least $25–30 billion kind of inflow coming in for data centers. So those kind of more larger avenues will open up, and we have to take steps to attract capital. This will be a cherry on top, not something that I'm expecting.
Not the baseline, but you'd be happy.
Who will not be? I am anyway 100% invested in the markets.
You know, there was two on this question of how to stabilize things, and maybe it's already stabilized. We don't know. We'll be wiser in hindsight. But the fixed income guys were saying maybe we need a rate hike, and the counter to that is we're not a large foreign-owned debt market. This is an equity. I mean, it's an equity market, not debt market. I mean, when rates go up, it leads to selling, not buying. So I don't know if that does the opposite. So that's the other debate, which, I mean, the classical economics says increase rates. I mean, you know, bonds get firmer, rupee gets stronger, etc., etc. But I don't know. I mean, if that is something you've thought about or not, but at least on the fixed income side, we've heard that a couple of times.
No, I think, see, we have to think longer term, and I do think government is thinking longer term. And we have to correct this whole situation. Next time there's an energy shock, we should not be vulnerable to it, and we should not be vulnerable to capital flows going out. And how do you do that? First, basically, the biggest problems are we consume more than we produce, and we import more than we export. We have to correct those situations. So we have corrected to some extent on the electronics import side, but I think there's a lot more to be done on the energy side. Energy is the next big item. Gold, unfortunately we can't do anything about. Maybe we can do something to monetize the domestic gold that we have. We have tried and failed over there, but I think still more can be done. But on the energy front, I think that is where that is why I get that confidence that this energy transition theme, it is not only about moving away from fossil fuel to renewables, but it is also moving away from spending dollars to get our energy requirement. So we should have a domestically produced energy, and that is what will make our country far more stable and secure in the future. But that is a 10-year story. From a 1 year perspective, we need to take care of what is urgent and important rather than what is more strategic in nature.
Other theme which you've been very bullish on is the defense theme. I just put out some data. I was looking at for the last 4 years, the entire defense pack market cap has gone up by 6x, but the top line and bottom line has gone up only by 1.5 or 2x maximum. So, are you seeing that in many of these companies, market is overpaying the kind of valuation that they should pay? For example, today BDL was a classic accident for the day. For the 7th year in a row, execution has been a bit of a question mark on that company. How do you look at this opportunity? I understand, long term there is a big TAM, but near term, you think there is a pain?
No, so first of all, let's understand what this long term is. Because of the events that I mentioned, which is leading to this global industrial capex super cycle, defense or the security concerns are definitely a part of it. We used to have US security cover, the NATO nations used to have that. That is not available anymore, or at least it is available at a price. It is not available for free anymore. So in that kind of a case, Europe is rearming itself. Japan, which post World War II, had pledged that they will never rearm itself, is again giving a boost to its domestic defense this thing. So there is a new wave of rearmament that is happening across the world, and the skirmishes that have happened everywhere has made everyone even more sensitive to that fact that we are also still spending only 2% of the GDP, and the other nations are spending 4-5%. So we need to increase our budget also. So I don't think the defense capex cycle is over, but it might undergo a transition, or it might undergo some kind of a change. Valuations can ensure that there are no returns for a year or so, absolutely possible. I think the big change that is happening in India is that we are moving away from a PSU-led defense capex cycle to now more a private sector-led capex cycle. Now the private sector capex, private sector has been opened up to defense. If you see the last 2026 DAP, the defense acquisition policy, a lot of the R&D where the DRDOs of the world were monopolizing this. Now the private sector will be able to do that. And the way this is structured is that first the MOD or DRDO gives the order to the large system integrators, who in turn give the orders to the large, tier 1 vendors, sub-assembly guys, component manufacturers, and that is the value chain. So that value chain down the stream is where the opportunity is still opening up. So I don't think the defense cycle is over, but the large listed defense, PSU defense companies, I don't think can be a large multi-bagger from here. They will be a compounder at best.
There is a sign of things that I think the founder of Solar Industries got, I think, one of the nation's highest civilian awards, right? I mean, so
yes.
Which is quite incredible. We've not seen that.
Yeah, but I mean, that's a great example. But let me point you also to a fact that we've been tracking this company for the last 15 years, since 2010. It used to be an explosive company. Yeah. It still is an explosive company. It has a almost 1.2, 1.3 lakh crore kind of a market cap. The order book for defense is 7,000 crores, which is a big jump. But 7,000 crores and 1.5 lakh crore market cap. So the defense opportunity tends to come about slowly, but once it comes, then the runway tends to be much longer.
No, and just on this one only, I think 10 years ago, there were around 11 crores from defense, and in the coming year, they're talking about 4,500 crores of defense. So we'll have to see where this goes, but as you're saying, the defense book is just 7,000 crores, so thereabouts. Time to wind down, guys?
Yes.
Absolutely. Thank you, Ravi, for coming down to our studio. It's been a great conversation. Thank you.
Thank you.
Well, with that, it's curtains down on Editor's Roundtable. Thank you very much for watching.
To punctuate
We have with us a very special guest, the chairman of the Vedanta Group, Mr. Anil Agarwal himself. Mr. Agarwal, a busy day. Glad you could take out time to join us on CNBC TV18. Let me first talk about the one issue that's been on all of our minds, demerger. This was a big issue on the agenda. You seem to have finally crossed that threshold. Tell us one question that we're all asking. What's next?
Thank you very much for inviting me. CNBC is my favorite channel.
Glad to hear that, sir.
Board. Very nice. We have grown in our natural resources. Since I left Bihar till now, I only looked at below the ground. So we have developed very beautiful business, and it was very important to each business is so good, so that can be by itself, Vedanta by itself. So we have demerger has already happened. I'm thankful to all the regulator or whoever was there and the court and everybody. So we have 4 big company. One is the Aluminium Vedanta Aluminium.
Sure.
Which is a phenomenal company. This will be world largest company in the private sector. We started with the 1 lakh ton of aluminium production from Bharat Aluminium. Now we are producing 30 lakh ton and going to produce in 3 years' time 60 lakh ton. The lowest cost of producer. That story doesn't end there. We will create 1,000 industry downstream. We are creating an industrial park because aluminium users are tremendous. So all the downstream 1,000 industry will be developed, so people will come and set up the industry and we'll support them in every respect. Then we have oil and gas. Oil and gas, my heart and soul is there. India has tremendous reserve and of oil and gas, hydrocarbon, and we were the only people in India producing oil in private sector. It was not an easy job. We are looking for producing 500,000 barrel to spend $5 billion in 3 years' time, 3 to 5 years' time, to produce 500,000 barrel at the lowest cost. We will have producing sweet crude. We have a complete pipeline. We have every kind of opportunity. We have a tight oil. I have a shale gas. I have a shallow water. I have a deep water. I have a big block in the Assam northeast where the first oil was produced. We are in the process. We are looking for government to give us a lease, long lease. So we are comfortable because then we can make a big investment.
Okay.
So aluminium, oil and gas, power is very important. At the moment, our power company produce about 4,000 megawatt, going to produce 20,000 megawatt. For that, all brownfield. All brownfield. We are looking forward. One of the best company. We have all coal linkage. Coal is not going anywhere, and we should be very proud of our coal. Coal, we have coal. What India has is sulfur-free, and I have always been advocating that coal is not going anywhere. We are a poor country. We are going to make sure environmentally we 100% take care of that. But we will make a power company about 20,000 megawatt power plant. That's what we are looking at. We have a iron and steel company, which is a phenomenal company. It is around Tata Steel, Bokaro Steel. It has infrastructure. We have a gas pipeline to produce 15 million ton of steel. At the moment, we are producing 3 million ton. We have another million ton in Goa, so 4 million ton we are producing. And we are going to produce 15 million ton, all green steel, electrical steel, or special steel. So we are the largest producer of iron ore, we will 100% backup of coke and the iron ore. So looking forward, this steel company still has a great demand in India. And then we have Vedanta Limited, which will have Africa largest zinc company. Very, very, very proud of having a zinc company. We have a 65% of Hindustan zinc. We have a FACOR, which make we also critical materials. So this is a Vedanta Limited, again very flagship company. So these are the company demerger. All the share will be in the process of issuing. By next month, all these 4 companies will trade by themselves. It will have a very strong management, and this will be company which is what we require in natural resources in India, and we will proceed in that direction.
I don't want to come in there in the middle, but that's an important clarification that you're giving. Can we take it as a confirmation that perhaps by next month we'll see these individual demerged entities also being listed?
Absolutely. By next month, all the individual entity will be listed.
That's fantastic. You've given us a very comprehensive roadmap about how each of these companies in their individual spaces can grow up to be bellwethers. You talked about subject to support from the government, you're looking to make big investments. So tell us, can you give us some glide path, some indication as to what is the kind of capex that you're looking at, say, over the next 3 to 5 years?
They're looking to spend about $20 billion. And we have a very good internal profit generation in the company. Internal accruals are very, very good. Some equity, some debt we might have to take, but $20 billion investment will be there, and probably we will increase our production by 2.5 times of everything.
But you're saying mostly through internal accruals? Any numbers that your team has run by you?
No, we will be having about $10 billion EBITDA.
Okay.
$10 billion EBITDA. So I don't know that financial detail, but I was not ready. But $20 billion we spend. Fund will never come on the way. Government is with us, and this all will be India. And by this, I'm looking forward at least 5,000 downstream industry to come in with our product. For me, most important, which gives me joy, to develop the downstream industry.
You've talked about previously, we've heard you speaking when you say that Make in India push has been very good. It's yielded results when it comes to smartphones, electronics, even the defense sector, it's done very well in terms of indigenization. But that you classify as above ground Make in India. The question that you asked previously is, what about below ground Make in India? Again, tell us, is there a need for perhaps a Make in India push even for below ground resources that you manage?
What we're talking at is self-certification, what government... I'm very thankful to Prime Minister Modi, Amit Shah ji. They always think how the business can be developed, the employment can be developed. And what we are looking at, simple policy, trust-based policy, trust-based and court also has to... What Indian courts are there is worldwide, people are very proud of. It's very important. The time is the essence because India can't wait now. Time is the essence. All economic, whether it's a court, whether it's a regulator, more and more trust-based it be given. Entrepreneurs should be given a recognition. Manufacturing people must be given a recognition. You know, because they have paid the highest tax. You will not believe every year I'm paying 60,000 crore tax. When I set up all this industry, I raised $35 billion abroad and brought the money here and invested all the money in all these companies. So these are the... And it's not me. Every individual is like me. Because we have the DNA of entrepreneurship.
Right.
We have a DNA of the women working very differently. So these things were being encouraged nowadays. Tremendous opportunity. We will, as far as Vedanta is concerned, we are very clear how we demerged identity will work. Very strong management. For me, it's a very inclusive.
Sure.
Because for me, last person working in my company, I cannot ignore him. He's also very, very important for me. And I'm very proud of my people and my team. We are ordinary people. Vedanta means what? Ordinary. But we deliver extraordinary result.
Well, you are anything but ordinary, Mr. Agarwal. But let me follow that up with another question that's close to your heart, what's on import substitution. I came across some very interesting numbers. We have an import bill of roughly around $800 billion. Half of that are below ground resources which we end up importing. So whether that's oil, gold, bauxite, for example. So we're talking about nearly $400 billion every year. What is the missing from our picture? Take oil, for example. We've not been able to build up capacity here within the country. What is the rationale? What's required from the private sector, from the government?
We have to be very, very careful of the world. World does not want us to produce. They want India to be a market. Middle East, all world they develop 2 hours away to supply into India. The Gold Council, they just want to supply to the gold, whether it's a copper. We have a tremendous bauxite. I just read in the newspaper, you know, the largest company has gone to Guinea to produce alumina. Why? India has the largest deposit and the best bauxite because we have to simplify our policy. Land is required, everything to be digital. Seller is ready, buyers are ready. We have to address I'm just thinking big way, is our system.
Okay.
System. Our bureaucrat officers are very qualified. They are most intelligent people, but they have to let go. They have to rethink inclusive. How do we recognize is very, very important. Your government companies, what is it called? All the government companies? Public sector. Public sector, very important. Government has to take a decision. Everything has to be privatized.
Okay.
Everything has to be privatized. No one person will be retrenched. I can see 5 times more production can come up. It is very important that we take decision. In fact, I'm for gold company, nothing producing, copper company. I'm ready to take challenge on anything. Let the parliament decide and trust. And I will do everything for my country. So, and the court. Courts are, judiciaries are very important. Time is the essence. We have no other in the world. The judiciary, what we have, nobody has. But for the, to take country forward, to create job, to develop the economy, is very important. The decision, we don't waste time, we move forward. Where else we'll find Prime Minister like Modi, Amit Shah, these people, what they have done in West Bengal. West Bengal was the hub for the industry. Hub for the industry, what they don't have. It is all, everything, Bihar, this, you talk about Assam, these things, what they are addressing now, will develop.
You spoke of reforms. I want to get in your reaction on one particular aspect. You've previously spoken of how this 50-year lease that we currently have is not quite working. We need a lifeline. As long as the life of the mine is, that should be the duration of the lease itself. Are you calling for a complete overhaul of the current mechanism that we have for auctioning, for allocation of mines, of resources, of natural resources?
Beautiful question. No, government has all the powers. Give a long rope. What is this short leave, 50 years taking back? People will run away. Nowhere like this is in the world. You are unnecessarily hanging the short. Tata Steel, we will, huge plants are there. And then you make a policy that you'll take back the mine and you re-auction. Does it work? We have to come out with a long lease, whether it's oil, and there should be one policy below the ground. For the oil, you have a different policy, and for mineral, you have a different policy. Below the ground, simple policy. For us, only one objective. How do we stop import and start producing? And this can only produce by the private sector. It's very important. And public sector must be privatized.
Okay.
And the court must be very conscious that time is the essence, whatever it comes to, whether any NCLT or this, they're doing a fantastic job, but time is the essence.
Okay. Okay. You've mentioned privatization twice, so I'll just labor on that point. You talk about completely privatizing as far as all the PSUs are concerned. Will you be...
There can be exception. I'm saying generally. Because no democratic country government doesn't run the business.
So if the government were to take up on your suggestion, which is greater divestment, greater public sector assets put on the market, would you be in the market in line for perhaps some of these government assets?
My shop is open. I'm not going to go to hunt. Okay. But something comes to my shop. Any customer comes, any opportunity comes, for my shareholder, I will look at.
Fair enough. Just a couple more questions, Mr. Agarwal. One question is that you've talked a great deal about privatization. You've talked a great deal about regulatory reforms. One low-hanging fruit, to your mind, that you will recommend to the government can be put into action as early as tomorrow. What would that recommendation be?
Anything which we are importing.
Okay.
Anything which we are importing, and there is a black and white, there is nothing left. What entrepreneur can do, we have proven from, one example is Bharat Aluminium. One example is Hindustan Zinc. There are only two companies I have taken. Anything, and if you see the privatization of the airport has happened, privatization of anything, then you have trust. I really salute all my industry. They were from where to where, whether it was a telecom, whether it's airport, airline, any steel production, anything you entrusted to the or corporation, whoever trusted, they have delivered.
Sure. That brings me to my one final question. I'll end you by asking, we're living in tumultuous times. There's geopolitical sensitivities. There are factors, some beyond our control, some in our control. With all of these multiple moving parts, one commodity that you're bullish on for perhaps the next decade or so?
I'm very bullish on aluminum, copper, oil and gas. All three critical metal, very, very important. And fourth is, we can be the largest producer of arm and ammunition. The kind of factory we have, massive, if they can be modernized and privatized, we will be the largest producer of today's digital technology given. But we have to be, Parliament has to be together. Everybody has to be together, one way, one goal, to make sure that we will produce arm and ammunition here. And we run our, whatever strength we have, we leverage that 100%.
Fair enough, Mr. Agarwal. We'd like to thank you for joining us, for sharing time with CNBC TV18. You've given a lot of insight as to the recommendations for the government, but clearly close to your heart, import substitution, and of course, perhaps some form of regulatory changes as well. Mr. Agarwal, we'd like to thank you for joining us and sharing time with our viewers right here on CNBC TV18.
Thank you very much.
This week on Media Dialogues with Storyboard 18, we speak with Rana Barua, the executive leading one of the fastest growing agency networks in the region at a time of massive disruption across advertising, media and marketing. From AI and automation to talent wars, billings pressure and the future of integrated agencies, Rana joins us to discuss where Havas India stands in the global network, what's driving growth, and how the industry is preparing for its next big transformation. I want to dial back and look at Havas's growth over the last few years. Despite the headwinds, the challenges, it's grown significantly faster, I would say, compared to the others. So when you look at the network today, Rana, what does winning look like to you? What are you measuring? Where are the successes coming from? Is it revenue growth, billings, new business? What does success for Havas look like today?
Yeah, so you're right. Challenging times, turbulent times, I think that's like been the order of the day, especially in my 8 years. I've been with Havas. We had COVID, then we've had this entire war scene which continues from different parts of the world. But I think what in Havas what's happened which has helped us is that, when we started this journey, we knew exactly that, especially thanks to our chairman Yannick Bolloré, who actually said that India is going to be a center of excellence, a center of growth, and very clearly a position where he wanted India to come out of the size that it was, a much smaller space that we were in. But over the years, what happened is that, with the investments that started coming in, we naturally grew, which is exactly what you were saying, that we grew into a very large organization. We become, it's not about the number of people, it's just that we've got all the agencies and verticals. We grew both organically and inorganically through acquisitions. We've had strategic tie-ups, we've had alliances. So I think we played very smart to the strategy that we laid out for ourselves. We were clear that we had to grow. We were clear that we had to get a smart bunch of expertise, as we call it, just not agencies. We got the right talent. We got excellent leaders in the zone. So I think what's happened over the last year especially, and this is currently my 8th year of running Havas for the group in India and the region. What is clearly mandated, if you look at the kind of winning, as you called it, I think it's clearly bucketed under 2 or 3 ways we look at it. One is naturally we would love to win more new business or new clients, but I think we are also pretty particular about the clients that you want. You don't want a huge volume of clients. If you look at the group right now, and the last count we did, we have around 1,000 unique clients in the group. What I mean by that is that apart all the companies, when you kind of get all the clients in from each of the group, you realize there are many clients which are unique to either some 2 or 3 agencies or one particular agency, which basically means is that you've got enough and more clients in the group where you can win more business from. So that's what we call as organic growth, the power of integration, the power of the village, where we focus a lot more than ever before. We didn't have this story maybe a couple of years back because we didn't have so many clients to begin with. And with the position of strength that we've become, we've attracted so many more clients. So I think one comes from winning new clients is absolutely a fabulous thing to do, but the quality of clients has to be unique because we cannot manage volume clients anymore because of the scaled up version. So we look at clients which have a clear strategic value that we can add. We definitely look at within the group to see how can we grow from within. And sometimes what happens is, and you're aware of it, that sometimes a new client win takes a lot of time. It's sometimes easier to deep dive within and go to a client and explain to him or her what we offer, and you start getting more business. So I think these are the 2 key ways, for us winning is there. And of course, if you look at the challenging times, it becomes very, very clear that you have to be very clear on your top line, which is the growth that you're getting, and you have to maintain your margins. You'll have to keep enough for the rainy day. You don't know which way this thing will go. You don't know what will happen. I think we become very, very cautious about costs in all form, and which is good for any company which is either growing or is in a growth state.
I want to stay on this point for a little bit longer, because from what I'm hearing and what I know of how Aavas operates, although it is a global holding company by definition, it doesn't operate necessarily like one. Going back to your point about not chasing volumes, is that very fundamentally different from what you're seeing other holding companies do? You know, how do you see that? Will that continue? Given the strain on businesses today, given the strain on spending today, given the strain on consumer spending, do you see this strategy continuing year on year?
So, you know, you're right. So I think first, yeah, we are different in the essence that we are an entrepreneur-led agency, right, or a network. The Bollore family naturally manages us, which naturally allows us to act as CEOs, but we are part entrepreneurs. We take decisions, we take our own risks. Sometimes those work, sometimes it doesn't, but we are aware that we are acting like entrepreneurs. So you take certain decisions and you know, you go ahead and take all. In terms of clients, and naturally I'm not absolutely being disrespectful here or trying to say that we look at a certain size or kind of business. What I'm trying to explain to you is that this entire change that's happened, you know, when you see the entire change, it depends on the agency life cycle stage. So for example, if, you know, you have a media agency or you have a performance agency like Pivot Roots, or I have a experiential marketing agency like Showbiz, they're of a certain size and scale that they've become, where it gets difficult for them to pick up too many volume businesses because they've reached a stage where they have, you know, in a very mature cycle where they pick up large scale clients, they deliver on large scale events or whatever. So I think it's on the life cycle of these agencies. And again, I'm not defining any revenue by volume or value. It's about the client and the investment they want to do. Many a times what we are seeing, and you would have heard this debate forever, retainer versus projects. Right. You would be hearing this and all. You'll be surprised to know that, and this is something I'm tracking very closely, is that retainers or clients who want associations are coming back more, and projects which used to happen many more are probably becoming lesser. So
that's good news.
Yeah, it's great news. And I'm a big believer of long-term relationships and partnerships, because I don't believe you can build a brand in 3 months. If you have to do a job, it's fine. You can do a one-off campaign or a one-off show or a one-off you know, strategic advice, that's fine. But I don't think you can do that.
Where does India stand in Aavas's global scheme of things right now? Is it being seen as a more powerful growth engine going forward? Again, keeping the backdrop of everything that's happening right now globally, where does India stand?
As a network, they're very clear that India is among those 7, 8, 9 markets. That's good because they've seen results. They can see where it is headed, in both in terms of business, both in terms of the advertising media spends, and also as a country, you know. Yes, we may have a challenges of the conversion ratio going up. We may have a challenge about certain, you know, ups and downs of that, but it's still pretty much, it's not this way. It's still going this way. Even if it comes down, it's still pretty stable. So I think the India story is a long-term growth story. It's not going to disappear over the next decade or something. So that story, I'm quite confident about will remain. So I think if you look at the overall, you know, country, I think we've got enough space to keep growing. Yeah, of course. The scale is quite huge, but I think that story will remain. And I think we are far away from a bit of a saturation or a slowdown for a bit. The challenges will remain, but I think what is going to pull us through is the scale, the population, and the size. That will definitely remain our trump card for some time.
Trump card.
Yeah. Oh, sorry.
Good use of the word there. But of all the bets that you've made, say in the past 4, 5, 6 years, where is the proof of the pudding the best, right? Where are you seeing that payoff, that return happening already?
I think for us, naturally in India, I think I would say that so the few areas where we've done extremely well, I think is Havas Media, and globally, we've got a huge support from our global team, which is led by Peter Mayers, which has really supported Havas Media in a very large way. So we've seen the results in media, and especially with our acquisition of Pivot Roots, this whole combination coming together. We've seen some dramatic results and client wins across the last few years, and something that we are quite excited because the media group we were maybe in below 10 or something. We are probably in the top 6, 7 for the group, which is naturally a big thing to be happy and proud about. On the creative side, I think, again, very clearly the way we build this whole platform, again, very, very, aptly driven. If you see, it's run by Donna, Donna Murphy is the CEO of Havas, both creative and health. Now, the way we build this, again, is a very tight ecosystem of agencies that work together. So we've seen the Havas creative agency do well. Last year it won Cannes and everything. So it came back in a very large way. We have Showbiz, which has been an extremely smart investment for us, which is an experienced agency. And I think we did PR Pandit again, which was a very, very, apt for us, because not only is it well known, it also allowed us to get into the luxury world in a very aggressive way. So I think some of these investments have been, very, very beneficial for us. I won't say we've been lucky. I think we've been smart with our investments. And I think we've been lucky, I can say, is with those leaders, because the leaders are very good. They've helped us. So I think, one of my learnings on acquisitions has been, sometimes you get tempted with many. But what we now watch out for us is the leadership and the culture. That's important for it to succeed.
We'll stay on this for a bit more, because I know that Yannick has, in previous conversations, whether it's on interviews or conference calls, has been very vocal about strategy when it comes to acquisitions. When it comes to India, what is the sort of the vision that he has set out for you as leaders here? And I'm just keeping aside the other regions that we look at.
Sure.
Just specifically speaking about India, what does he want in the market here?
I think again, it stems from the point that I told you. It stems from the point that, is there enough, if I look at the entire opportunity that lies, is there enough space to grow? I think there's huge space for Havas to grow. I just gave you a list of X number of clients, that's unique clients. Can I double it? Yes. Can each agency grow more? Yes. So I think we are of a size and scale in India where we can only grow more and bigger. So I think that's one point that he's, always tells us that, Havas can grow bigger. And, if you look at, the numbers that India is producing, and, I saw the Q1 results, we are well above double digits in terms of growth. So that's a great place to be. And it's not a small base anymore. People can ask me, but maybe your base is small. The base has grown in the last 8 years. So we are on a pretty decent top line where we are growing at double digits, big means greater than double digits. So it's in a place where we can grow bigger. So that's one, I think. So that's one thing he's very clear about. And I think he continues to look at, building. We are trying to build, let's see how it goes. We're trying to build global center of excellences out of India. It's not because it's a cheaper market or a cost efficiency. Of course, it's efficient. Cost efficiency goes with India, right? But I think we can build better because we speak English. The talent is very much attracted to working at different working hours. So I think we're trying to build that in a larger way, because we're taking it step by step. If somebody had to ask me, but other networks have already done it, but they've been here for years. For me now, this is stage 2 of moving forward. So we are trying to build a global center of excellences. We've got something for Havas Media out of Bombay office. We've got something called POP, which is the production hub. It's a production hub in Chennai, which is got 150 odd people. We are trying to build something for health. Maybe we'll build it in somewhere nearby. We're trying to build something for design, again, which is for both UX, UI and design. So I think these are the next stages of growth that's going to come in terms of this. And I think, let's see, in terms of acquisitions, we continue to look forward for more.
Yes, and look at leaders as well, like you mentioned. Speaking about leadership, and before we get to AI, and I want to just keep it conversation, which is why I'm just picking on some of the things that you're saying. When it comes to, we've always seen how holding company leaders in the market, don't have perhaps as much autonomy as other markets. Have you seen that shift perhaps? I know Havas operates a little differently from, whether it's WPP or now Omnicom with IPG in it. Dentsu is another example. In terms of how leadership is allowed to function here, how would you say Havas does it?
I think, you're right. So let's be straightforward here. I think Havas works in a very different way, right? So I think the way Yannick's entire philosophy is, and along with Yannick, like I said, the two key people who, work with us very closely. One is Donna and one is Peter. I think it's a much flatter way of working here. So a lot of credit should be given to the leaders here. Why? Because they allowed me to work in a certain way in the last 8 years. I'm not sure whether the same would have happened if I was with other networks. The kind of decisions I've taken, or the kind of expansion plans we've done, the things that I've been saying, whether it's about launching a new vertical, whether it's an acquisition, even strategic alliances. We've done multiple strategic alliances with places where we need to get in. So you do work as a entrepreneur. You work, of course, you have your guardrails of what the Havas governance is. As long as you're within the entire guardrails and not trying to create something out of the box or something which doesn't make sense for the group, that doesn't happen. But there's far more autonomy here. And it allows you to, sometimes, just go ahead and take certain decisions, as long, like I said, it's thing. But it's definitely a much more faster, far more agile way of working. And I've
you
experienced
need that right
yes,
now.
100%.
And you absolutely need that
because you
right
can't keep
now, right?
waiting. You can't, if you have to build a business plan and get conviction and get clearance and approvals over 90 days, you probably have lost the plan. Here, decisions, as long as you're clear, you go into a business plan meeting, you say, okay, this is what I want, the questions will be answered. Sometimes, for example, there's something called acqui-hire that we do where we merge companies and all. We get decisions done in a month or month and a half. That's much quicker than ever before. So it's a much, much faster way of working here.
Going back to the point on AI, and we'll quickly take a couple of points on that as well. Are we moving the conversation now to, when we speak about AI today, within the advertising agency context, it's always essentially about cost efficiencies. Is that conversation moving to something else now, toward growth perhaps? Because AI will come. It'll make everything efficient. There will be redundancies, there will be layoffs, etc. But what next? How is it helping you grow the business? Have you seen any tangible proofs already of where it's making a difference, whether it's media planning, buying, creativity, any aspect of the business?
So I think two things to that. So let me phrase it in two ways. So I think in this year, around Jan or Feb, Yannick actually rolled out a new vision for this whole group. So it was very interesting when he rolled it out. He said growth powered by desire. So, you know, when we went through it, it seemed very obvious. But, you know, when you look at this whole vision statement, it basically said that brands which are going to be far more desirable, brands which would make the consumers far more engaging in terms of desiring them, are the ones which are going to grow faster. Now, which is true, because what we are seeing across the world is that when you start engaging or build a relationship with a certain brand, you start desiring it more. So that was one statement that he said. Now, the question is that why did this vision happen when you knew that you were building this whole world of AI and everything? Now, imagine I lay the statement in front of you, that growth powered by desire, and then you see the whole world is now getting into a world of AI. So we launched AVA, which is what we launched this year. The portal that I discussed about, the LLM portal, which allows you. Now, if you start filtering it and start putting it into a method to this whole madness, and you say, okay, these are the brands that I'm going to make happen. You may not be able to do it for all, but if you start putting the tools and all, you realize that AI actually allows you, and the way it's working, this whole tools work and all, and then, you know, we have a strategic operating tool, which, to answer your question, takes the whole thing together. It's called Converged AI, which kind of now then converges strategy, data, creative, media, the whole cycle, and brings all this method back to madness. It's not easiest, I will not say it's very easily done, but it's an attempt to get things in a more systematic way so that there is more method to this madness of how efficient can you run data, how can data feed into creativity, how can creativity then feed into a plan which makes more sense, or at least communication makes more sense, and then how does media get into it. So I think it's right now in a place where it's moving at a certain pace, but it's also forming a certain shape where we are seeing that there are certain conversations are coming back. You know, for example, one thing that's definitely coming back is, you know, in terms of intellect, do you have expertise? Superior expertise is going to become a need of the hour. So you can say, okay, this is not required, I'm okay with this, but I'm still going to rely on a person's expertise or knowledge. So I'm calling it, you know, this is something which I'm saying. I'm saying, earlier we used to say, gone are the days of generalist, you have to be a specialist. I'm saying gone are the days of generalist and specialist. You have to be a super specialist. So it's going to be a tougher fun for people like us, because just being a specialist is not going to help. You have to be super good in that bit to give a differentiated point of view.
Yeah, because AI has pretty much flattened all of that, right?
Exactly.
Democratized that specialism
Completely.
that's required. One more quick question before I close with the final question. You know, we've seen, of course, aggressive bets being made in influencer marketing. Gen Z, of course, we know the spending power there. There are all sorts of, you know, fantastical numbers when it comes to trying to, you know, speak about Gen Zs and their spending power and all of that. What are the investments that are happening, say, in influencer marketing for the group? Is that going to be a key focus going forward?
I think it's an important focus. It means there are two things in that. It's influencer and social. So I think it's hand in glove, because the influencer marketing person or whatever, the people are naturally in the social medias. That's where they're playing the game. So it's hand in glove in that. I think it's important for us to look at it. I'm definitely looking at it in many ways.
Acquisitions?
Both. Acquisitions, whether I can also have a partnership with something going, because I think that's the need of the hour. So I'm not going to shy away from the fact that clients are asking for it, because they're seeing success, right? So I think, you know, will it be sustainable? Will it be long term? Again, you know, like every single trend, it's the need of the hour. So I come from a belief that, you know, you shouldn't challenge anything that's the need of the hour. You should go with the tide. You know, if you have to partner a client, you work with it, and if it works for a few years, why not? So I think it's important that we adopt this whole model.
And they have a number of, you know, service offerings. I mean, lots of people providing that service, whether it's independent, smaller boutique shops, the larger agencies have made acquisitions as well. Do you feel that you are perhaps a little late to that party right now?
No, it's okay. You know why? Because again, it's very early days.
Very early. And we're finally seeing a little bit of maturity there.
Yeah,
right?
it's
people
very
asking
early days.
questions on ROI finally.
Yeah, so ROI is being questioned, but I think what has also happened is that, you know, you're right. You see, the point is that they are easily available. So if a client asks me for a question or a challenge, I know that I can get them on board tomorrow.
Right.
Now, whether I can manage them or not on something, that's something we'll have to figure. Because I don't think any agency can completely say that they're absolutely, you know, I've got these 1,000 people or something. You can't.
Right.
Because it can't be so exclusive, right? I know certain large clients have announced certain things about, you know, they're going to move the entire business from here to there. There are many of our clients all speaking the same language. So I think, can you do it as a homegrown model? No, it's not easy because these are all independent professionals. I think they're doing a great job themselves. But we have to be very smart about how to get them on board, whether it's a group of people or whether it's a company who can manage the whole thing, because it's managing. It's in a way, it's like what talent management was many years back. So you will have to have somebody who can manage. And I don't think the talent management people were ready for it. They didn't know that suddenly there will be a flurry of talent in this country or anywhere in the world who we need to manage.
Absolutely. Good message for us all. Thank you so much
Thank
for
you.
joining me, Rana. Lots to pick on, of course, for another conversation as well. Thank you again.
Thank you very much.
Global. watching us here on this very special show, India's Consumption Trends 2026 with Nilesh Shah. We're discussing a transformation that's quietly reshaping India. Because if you really want to understand a country, and India in particular, look at what it spends on and where that has changed. So let me quickly set this conversation up with some very fascinating data points. For years, food dominated India's household budget. Nearly half of what India spent went into food. But the share of that in urban spending has fallen from 48% all the way down to 39%. That's a complete rewriting of the Indian wallet. Where has this money gone instead? It's gone to mobiles, OTT, eating out, rent, experiences, and automobiles. In many ways, India's new essentials are data, devices, deliveries, and experiences. And perhaps no statistic captures this shift better than this. Apple India is now projected to generate revenues of 1.5 lakh crore rupees, which is nearly 2 times that of HUL. Over the last 5 years, Apple India has seen a revenue growth of 6.5 times versus HUL just 1.5 times, which raises an important question. Is India becoming a premium consumption economy? Even smartphone volumes, they're largely flat, but the premium share of smartphones has increased from 20% to 26% over the last 5 years. Urban wealthy incomes have grown at roughly 18% CAGR, whereas urban mass income has grown at just 6%, which means India's consumption story is increasingly becoming K-shaped, something that we speak about. Affluent India and mass India are moving very differently. We're also becoming an experience economy. Concerts, travel, dining out, OTT. Foreign travel spending alone over the last 8 years has increased by 450%. The Indian wallet is becoming increasingly premium, both digital and global. But beneath all of this sits another reality. India's data bill has grown much faster than our wage bill. That's not all. Retail F&O traders have lost nearly 3 lakh crore in the last 4 years, 91% of total losses. Digital fraud losses have exploded from 8.5 crore to nearly 23,000 crores as we speak. So while India is consuming more and aspiring more, the pressure on household balance sheets is also rising. Which brings us to the big question. Is this broad-based prosperity, or is India's consumption boom increasingly getting concentrated at the top? To take this discussion forward, we have a very interesting panel lined up for you. Nilesh Shah, the Managing Director at Kotak Mahindra AMC, Archit Varsne, who is the Research Analyst at Kotak Mahindra AMC. Along with him, we have Manish Khilnani from Bizom, and Arjun Vaidya, who is the co-founder and managing partner at V3 Ventures, known very well to be the D2C face of the country as well. Thanks a lot, gentlemen, for joining in. And, we've seen all the data. India's moving from just being a regular consuming economy to being an experience economy. Nileshji, I have to ask you this. From a listed company standpoint, what are the themes that you're looking at when you're looking to play this shift, and how much of that is already played out?
So one, we have seen that consumer staple is not growing as much as the consumer durable. This is also reflected into listed space, where consumption of staple is not growing and hence not getting same valuation as, let's say, consumption of durables. The second side effect I will call that investors continue to lose money in speculation, in digital fraud, in Ponzi scheme. And that amount over last 3 years could be upwards of 5 lakh crore. That is more than what you spend in a year on buying of consumer staple, from detergents to soaps to shampoos to perfume. Now, if there is a way in which we can plug that leakage, we can educate speculators not to lose so much money but spend money for their family, then suddenly we will see a trade where consumer staples, consumer durables will do better, and capital market related entities may not do as well.
Right. So, I just have to ask you this question as well. When we speak about consumption in India, the new age consumption, there are various listed plays here. You do have the platform players, you do have beauty and personal care specialists, you do have travel and tourism players, etc. as well. But oftentimes the growth, the potential is overestimated in the stock market. Do you think that is the case? Or maybe these guys will still continue to surprise positively?
No, I think these guys will continue to surprise positively because you can see on the companies which are driving the premiumization trend, whether it's within the Alcobev, you have seen a few companies who are doing very well on premiumization trends, or whether it's a footwear sector where you are seeing multiple premiumization play, where your ASPs or the footwear's ASP has been growing much faster. But on the other hand, the mass players are struggling. So I think this trend will continue, and possibly you will look forward that the premiumization plays will continue to do better, and mass segment may continue to impact. And just to put that into perspective also, right, if you look at the last 5 years data of urban wealthy income growth, it has grown at 18% CAGR versus urban mass people have grown at only a 5% CAGR. Similar trend is also witnessed in the rural India as well. Rural, if you look at rural wealthy people, they have grown at roughly 11 to 12% CAGR, and the rural labor class has grown at a 5% CAGR. And I think this differential will expected to continue as well in futures. And we think that premiumization as a trend will continue, and there will be few companies which will be beneficiary of that, and there will be few companies who will be at the receiving end of the debt. Yeah.
The K-shaped recovery, we're not sure whether that's good from a societal standpoint or not, even if it is from the premiumization standpoint. But, you know, I have to ask you this, Manish. You track the sales data of all the consumer companies very closely. What have been the major shifts that you've noticed over the last few years?
I think the biggest shift that we have seen over the last 5 years is this whole consumer wallet changing from largely pulses, going beyond pulses to categories which are far more aspirational, far more lifestyle based, far more wellness in general. Earlier, when we used to see a lot of your household spends were spent on pulses and basic essentials in general, today we see a lot of spends happening on premium personal care. A lot of them have spent on premium home care items in general, right? So those are a couple of trends. Premiumization for sure has been around for past couple of years now. Indian consumers are clearly willing to spend a lot more today. Specifically on, say, for example, the data that we recently saw is around dairy. Dairy has been growing at about 18 to 19% from past 3 years uniformly. Largely around products like your curds, yogurts, as well as value-added products in general, largely because of this whole protein favoritism in general. Premiumization has been growing largely around your healthy lifestyle changes in general.
Because the person who's been tracking all of this from the closest quarters is Arjun out here. And this is where it's important, because when you say that, you know, staples aren't growing and a lot of the larger players aren't growing, we are premiumizing, etc. A lot of the incremental share over the last, I think, 5 or 6 years has gone to D2C companies, new age companies, and you've been tracking that. Among the earliest investors, I remember in something like a Lahori Zira as well. So what have you noticed about India's consumption patterns, and more importantly, what is the next billion-dollar category according to you?
Look, I think firstly, I really enjoyed reading the report because that 2000 number was when I was in school, right, which was 48-50% GDP spent on food, and then to see it come down. The other very interesting stat was the iPhone stat. If you asked me 5 years ago, I would have still said India is an Android market. So I think there is change, there is aspiration. And I think that aspiration is coming out now in a lot of categories, not just in food. Like in food, of course, consumers are trading up. He talked about protein, etc., all of that. I've come on Mangalam's show, so I had to wear shoes. But I'm wearing shoes from an Indian brand that costs 6,000 rupees. When the business pitched to me 2 years ago, 3 years ago, I said nobody will buy it. But now whether it's shoes, watches, sunglasses, apparel, even personal care. I'm an investor in a bunch of personal care companies. India's always been a hot country. But sunblock and sunscreen has gone through a massive uptick in consumption. And that's because people care about their bodies and their selves so much that they're having this. So I think you're seeing the customer becoming more discerning. The customer with digital payment becoming a little bit more flexible on their payments. But the important thing to talk about with the iPhone stat as well is a lot of this consumption is also being funded by EMIs, right? And so it may not necessarily be just prosperity, but maybe when I went to the US, I remember growing up, I would only see loan ads on TV, and I'd come back to India and say, this is not the case. But today, a lot of the appliance consumption or the luxury consumption, even travel consumption is being funded by income that's not necessarily yours. So that could be something that in the future may be a problem for us as well.
No, that's a great point that you made, and that actually sets us up for the next question as well. Up until now, Nileshji, the going was good. As the old cricket ad said, when Yuvraj Singh said, "Jab tak balla chal raha hai, sab sahi hai." But now, the last couple of years, the market hasn't given the sort of returns that it did in the previous 2 years. No other asset classes have given those kind of returns. And there is this fear of inflation in the very near future. Do you think this premiumization trend, which has accrued over the last few years, will continue, or at some point it will start hitting demand as well? Because in the same report, we've seen savings come down and loans as a proportion of people's spending increase.
So undoubtedly, Mangalam, we are at a crossroad. On one side, EMI burden is increasing at a faster pace than the income. That's why savings on financial side are falling. But it is a case of P&L weakening, not the balance sheet weakening. Indians are sitting on the highest amount of gold. Gold now is 125% of our GDP, or even more. Will people convert gold for wealth effect or not? जब शेयर बाजार ऊपर जाता है तो रियल एस्टेट में तेजी आती है. गोल्ड के दाम ऊपर जाते हैं तो क्या होता है वो आज तक किसी को नहीं मालूम. So if households convert wealth of gold, silver for consumption, we will see demand continuing. But if they keep that as a holy cow, then we will see some moderation in demand because one, inflation will rise. Second, interest rate could rise, which will have adverse impact on the EMI burden.
Right, we take that point. In fact, you've given us a bit to think about. What we'll do is we'll take a short break, come back, continue this conversation with the expert panel that we have on consumption.
Free transit.
back. You're decoding India's consumption trends 2026 with Nilesh Shah. We have with us Archit Vaishnav. We also have with us Manish Khilnani and Arjun Vaidya. We've been discussing, how the setup has been so far. Premiumization is good, but you touched upon a couple of points. One, the fact that, currently there may be an impact on demand because of inflation. And secondly, a lot of this is funded by private credit. So let's discuss what could go wrong from here on. Because, as we speak, a lot of people, he was saying that, a stat that you had with the salaries of people and the phones that they have?
Yeah, I think back when I was running a retail sales team, I did an exercise, and that time it wasn't iPhones, it was more Android. But I had 22 sales reps, and I benchmarked their monthly salary versus the price of their phone, and it was 2.5 times their monthly salary spent on a phone. But India's leapfrog laptops and our entire lives live on our phones, so I guess people are flexing their phones or having expensive phones.
And what was your stat here?
I think, so about 4 lakh people use Bizom application every day for punching their orders. So we continuously also try and monitor what phones they are using, what is the battery percentage usage and stuff like that to ensure we optimize that. Right from 2018, we had looked at about 3% of users were iPhone users. Till 2026, we look at about 17 to 18% of users have been grown to iPhone.
6x growth.
Absolutely.
That's a 6x growth. And these are people who are actually funding this via EMIs, etc. Do you think that could at some point come and become a bit of a tension part for the market?
So in some sense, it's a cycle. More consumption will create more jobs, more demand, and so on and so forth. Overheating is not warranted because then the cycle breaks. Underheating is also not warranted because then the cycle doesn't gain the momentum. We need that perfect pace at which EMI burden is not crushing, pace at which consumption doesn't slow down so that no new jobs will be created. How do we achieve that equilibrium? For India, every problem there is a solution. We should explore it. The one solution which is important is the amount of losses Indians incur in speculation, in digital fraud, in Ponzi. In last 3 years, 22 to 25, collective losses, some reported, some unreported, is 5 lakh crore. This money in 3 years is more than what 145 crore Indians spend on buying toothpaste, shampoo, detergent, and perfume.
So basically you're saying that do not gamble, do not speculate, do not do anything. Just
spend on your family.
Spend on your
then
family.
Then consumption is perfectly fine.
That's interesting.
Good old Indian values.
I have to ask you this question because, you are tracking this space very closely. Everyone's talking about discretionary versus staples right now. Staples have underperformed for a while. And now with the inflation cycle coming in, a lot of people believe that maybe staples are the place to be. Where do you stand on that?
No, absolutely. While it doesn't, I don't want to choose between staples and discretionary, but I think both the segments will do well. There will be few companies within staples who will do well. There will be
what would they be?
No, I think I am not allowed to speak names, but I think there will be particular companies who are following the trend of, let's say, premiumization. There are companies who are following the trend of what he was saying, that face wash or sunscreens have taken up. So there will be few D2C listed or, let's say, beauty companies who are expected to continue to do well. And I think there is a separate section of the society. So to just give you two things in that perspective. One, so if you look at the tax filers' growth over last decade, they have gone from 4 crores to 8 crores, right? But if you look at the taxpayer growth, the people who have paid tax more than zero has been hovering around somewhere around 2.5 to 3 crores. So that means that same people are earning more, they are spending more, they are paying more taxes. And that also shows the trend that income growth is deepening rather than, let's say, widening or broad-based widening. The second important trend is also, just to put in perspective here, is that India's foreign travel spends over last 11 months have been 1.4 lakh crores. This is similar to the amount the whole building material industry in India have. So think about it. So
don't take a holiday now, instead paint your house is what you're saying.
No, I'm saying that
take holiday in India and paint your house.
It's not that Indian holidays are cheap either. But, I have to ask you this, since you're talking about premiumization, a lot of these new age companies, we've seen, beyond a certain point, beyond say 100, 200, some even 300 crores, they struggle for scale. And eventually they end up selling to some of these larger, incumbent players who then also struggle to scale that company up. How do you navigate through that?
See, I think when I was building 2016 to 21, that number was 100 crores. And we would get 100 crores like this thing that we would chase and not be able to get. That 100 crores now become 250, 300 crore. I think as the market cycle progresses, it is very easily believable that you will create 1,000 crore type companies. If you are taking a sliver of the market or niche in the market, don't expect to create a 10,000 crore business. If you're doing premium shoes or premium handbags or premium luggage or premium ice cream or some sliver of the market, don't expect to get 10,000 crores. But is it believable that the company can reach 500 crores, maybe 800 crores soon? Yes, that is true. On the point of getting acquired and then the legacy company not being able to run it, I think that is a function of this company or these companies getting the capabilities to be able to run new age businesses, which they will get. So I think when I sold my business, I thought 100 crore was the ceiling. 100 crores not the ceiling. The ceiling may be 300, 400 crore today. But 1,000 crores not so far away.
That's too small a check for someone like him to write, right?
That's why we are trying to write those checks.
You have those these companies which are doing extremely well. But they're well in their own right. The incremental share is what they're taking away from the legacy companies. But now a lot of these legacy companies are also getting into the same categories. You have Horlicks Protein, you have Glucon-D, which has come up with a sports drink, and you have Amul, which has gotten into protein, etc. as well. Do you think they will be able to now beat the new age companies?
I don't think so. It's new age versus old age company. It is smart entrepreneur versus dumb entrepreneur. They could be present in both the sides. Point is, how will you communicate with consumer? There was a time when having your product across shops was the cutting edge. Now the world is moving to digital, especially in newer product. Will you have communication to talk to millennials, to Gen Z, or will you treat them as your old customer? Product innovation, communication, digital, all those things will decide whether new age company wins or old age company wins.
So if you had to bet on a couple of themes from this space, because he's not giving me any names, you can give me some direction. I'm not asking you for names.
So essentially one play is that which are the companies which old age company will be interested in buying out. A strategic buyout will always be at a much higher than the market valuation. So think from a buyout point of view. The second thing could be some of those categories where margins are very high. For example, perfume. Now, traditionally, it has been a category which has been dominated by multinational company. They charge higher premium. But we have seen in some of the food businesses, local companies have outwitted multinational company. Could there be a local company in that space which can do better than the multinational company?
Titan having a...
I'm not recommending.
No, I'm just thinking what you're saying. But just a final point from all you guys. Consumption is a function of the income that people make. If not an income, it is probably potential future income, which is why EMIs, etc. On the one hand, you've said that people should stop speculating, and that's one part of the income, which is perhaps can be driven towards consumption. But on the other, there is artificial intelligence, because of which employment is not increasing at the pace one would expect. And a lot of the IT jobs are not seeing the kind of income growth at the pace that it was earlier. Do you think that could impact consumption, premium consumption at the urban end at least?
So my feeling is that if you look at IT engineer at entry level salary, that has grown at 1.5% since 2000.
Yeah.
There's hardly any big handle difference between what you get in 2000 joining an IT company and 2026. The jobs are coming from the Global Capability Center. Now, if we can leverage AI in GCC, we'll end up creating far more higher paying job than what IT sector is creating. So AI is an opportunity of a lifetime or a threat of a lifetime. I'm not sure which side India is leaning towards.
All right, just as we wrap up, let's ask everyone for their final word, a one-word answer. What do you think is the next billion-dollar investment idea in India?
D2C brands.
D2C brands. Which sector, which category?
Yeah, I think health, wellness, sports, nutrition, lifestyle, that's fragrance, sunglasses, watches, etc. And pets is going to be big, but it'll take some time.
All right. What's the one category where you've seen the maximum growth in the last 2 years?
Wellness, pharmacy and wellness is something which
pharmacy and wellness. What about you?
I think Alcobev is one of the premiumization trend which is happening, creating a particular D2C brand. There is no one present. It can be a billion-dollar opportunity.
A D2C brand in Alcobev. This is so interesting. Wellness, pharmacy, and then from Dawa you've gone to Daru directly. What about you? I'll give you the last word.
I'll back my analyst.
analysts. All right. On that note, ladies and gentlemen, thank you so much. You're decoding India's consumption shifts and trends in 2026. This is the start of a conversation as we progress towards 2026. Look at the next few years. We'll continue to have these conversations periodically. Thank you for watching.